sell-off. Don't know if this will continue or people are just going to buy it up. I have no idea, but CNBC CEO Elon Musk stock price is too high. Shares tanked more than 7%. And then when I read that, I went to Elon Musk's Twitter page. Tesla stock price is too high. IMO. And then a lot of people are freaking out. They're like, they're like saying that that Tesla, like somebody hacked Elon Musk tweet, and they tweet that. So it was tweet from an iPhone, which is, I don't know if that's, maybe he was forced to say that. I have no idea. But Elon's PR team been saying this for a while now. It has hype. It dropped $15 instantly. This is kind of like stock market manipulation, but he's manipulating the stock to the downside, so it's not really manipulation. I don't know at the end of the day. I don't know what's going to happen. I don't know if the stock price will drop further. I did buy a put option for fun, like a quick put option, like 2 contracts, just in case it actually dropped. But we'll see what happens. Right now, it's starting to bounce back, so that people are buying it. They don't care what he has to say. They're still buying it, rich people. So Tesla stock is recovering. I have no idea what's going to happen, but he's gone off the deep end, man. Should I buy stock? Tesla Roadster Founder Edition or better? There's some tweet
economy. Remember, they're buying the oils, they're buying the airlines, buying the cruise ships. Well, I see this as a buy opportunity for the likes of Clorox, Colgate-Palmolive. They both report tomorrow morning. Procter and Kimberly, 2 stores that have already put up excellent numbers. But tonight I've got a new one for you. It's one I haven't talked about at all, and it's just as much of a household name as the rest of them. And it's called Reynolds Consumer Products. It came public in January. Now, you know them as something that, look, if you pull open a drawer, I know, you pull open a drawer in my house, in the kitchen, there it is, it's the Reynolds wrap, right? And then you open underneath.
Oh, that's a Reynolds.
There it is, it's the hefty bags. And then the disposable cups got them. Easy full, I don't use that stuff, but it's theirs too. Reynolds debuted at the end of January without much fanfare. The deal was sweeping well received. When the pandemic hit, the stock rolled over from mid-February to March, like every stock did. Well, since it's roaring back, climbing from $24 back up to $32 and change today. So could this really more room to run? I have to tell you, I think this is exactly the kind of company that should be able to thrive in a tough economy where millions of Americans are stuck out of work. And where are they? They're at home. On the other hand, the stock's already rebounded substantially from its lows, and this is a news story, so there could be some hidden pitfalls that make the stock less attractive. And that's why tonight we're going to play a little belated game of Know Your IPO. Yeah, we interview so many people lately, I haven't had a chance to be able to fit this in, but that's okay. Dealing with Colgate tomorrow and Clorox tomorrow, if they're not perfect, this one comes down. So maybe we got to take a real hard look so we can buy it. Let's start with the financials. As consumer packaged goods plays go, Reynolds, it isn't much of a growth story. Their annual sales have been stuck at around $3 billion for the past 5 years. In fact, they were down more than 3% last year. How about earnings? The company's net income jumped from $68 million in 2015 to $302 million in 2017, before plunging to $176 million in 2018. The earnings recovered to $225 million last year. That's some impressive 28% growth during a period where revenues were shrinking. Reynolds made it happen by finding ways to cut costs, dramatically boosting its gross margins. Wall Street likes that. You got to remember, the last few years have been a slog for most of the consumer packaged goods industry. Everybody loves Clorox now that COVID-19 has turned our world upside down. But not long ago, they were struggling to do it too. So they got aggressive about margin expansion, cutting costs. Reynolds has followed the same trajectory. All right, how about the balance sheet? Reynolds Consumer Products used to belong to Alcoa. I remember when it was just Reynolds itself. Alcoa sold this division to a private equity firm in 2007. Now, we always want to be careful with PE-backed IPOs because they usually have a lot of debt. They layer the debt on them. Reynolds is no exception. It's about $4.2 billion in total debt, although they pay down a decent chunk of the proceeds of the IPO. Fortunately, none of that debt comes due anytime soon. And now that Reynolds is public, I bet the company uses considerable cash flow to gradually clean up the balance sheet. It's good. Now, the bull thesis here is pretty straightforward. Reynolds is the dominant player in nearly every category where it competes. They have 94% market share in freezer paper, 64% market share in that aluminum foil I talked about, 59% in wax paper, it's ours too, 51% in parchment paper, 43% in foam dishes, 22% in outdoor trash bags, 22% in party clothes. And when they're not number one, well, they're number two. Like in regular garbage bags, where their Hefty brand has 20% market share, up 2 full percentage points last year. That kind of share take is almost unheard of in the consumer packaged goods sector. We've been hearing that Clorox was desperately fighting for share of trash bags. Well, now we know it was Reynolds they were fighting. On top of that, Reynolds gets 45% of its sales and about a quarter of its profits from private label. Those are the knockoffs, the store brand version of these products. We know consumers flock to private label during recessions. They always have. Actually, branded stuff starts to feel too expensive. But Reynolds wins either way. Plus, they're the exclusive private label supplier to Amazon for this stuff, which I think could be huge in a era where people are increasingly buying household supplies online rather than going to the store. Remember, Amazon was a miss on the bottom line. The top line was extraordinary tonight. So let's understand, we're not talking about anything wrong with Amazon when it comes to selling Reynolds products. Best of all, this one's blissfully uncomplicated. It's an extremely low-cost, vertically integrated producer, sells roughly 98% of its merchandise here in the United States, not worrying about the dollar, makes it more attractive during this period of turmoil in the global economy, and maybe down the road it means they have a lot of room to expand overseas. High-quality American consumer products still tend to be pretty darn popular in the rest of the world. Now, we know Barclays, very good house on these particular stocks, this kind of stocks, has been pounding the table on this one. They published a piece arguing that Reynolds could have best-in-class earnings growth over the course of 2020 and 2021. I thought the projections seemed pretty convincing. Plus, obviously, Reynolds is perfect for this moment. Their categories, trash bags, food bags, disposable dishware, aluminum foil, they're all on fire. Millions of people are forced to stay at home and cook for themselves, as we heard from Campbell's Soup last night. According to Nielsen data, remember Nielsen, incredibly important for rating things, trash bags are up 15% over the last 4 weeks of the data. That's extraordinary. Food bags are up nearly 37%. Disposable dishware is up 8%, and aluminum foil, get this, it is up an astonishing 44%. Those are insane growth numbers. Obviously not sustainable, but let's take them together. The whole industry is seeing huge volume growth, and Reynolds in particular has real pricing power right now.
I'm going to pause on Kramer. I'm going to focus on this a little bit more on this Elon thing, but this video I found, I don't know if I'm too impressed
TK with. Today is down. Pressure, a lot of pressure on the tanker market. Fro is down 2.4%. North American tankers. Oh, by the way, I'm making another video over tonight.
Yeah, not loving that one, so. See what else we got. Oh, they're not letting me scroll. It's interesting. I can scroll there.
Steady income.
Let's check this one out.
But first, if you like being glued to your monitors, staring at charts all day long, working way too hard, then this is not for you.
Today for the Bitcoin price. This is crazy, guys. Look at this. Elon Musk just tweeted out that the Tesla price is too high in his opinion. And from this, a crazy discussion about the Bitcoin price here between Elon Musk and the Bitcoin handle emerged. We will tell you exactly what happened there, what Elon Musk's opinion is, and what our own interpretation is about that. And also, guys, here about the Bitcoin price, just something crazy happened here on the daily candles between the, in our opinion, two most important moving averages. And the last time this happened here, guys, the Bitcoin price skyrocketed 140% here back in 2019. We will tell you exactly what it means for the Bitcoin price right now and what we are expecting here for the price of Bitcoin in the immediate short term. Guys, make sure you take a seat, make sure you smash up the like button right now to at least 3,000 likes. In the last videos we always hit 3,000 likes, so scroll down, press the like button right now. Thank you very much. And that being said, welcome crypto friends and welcome back to German Crypto. My name is Chris, and as always we are really pumped to go straight into the content. Alright guys, so first things first, we are here on the 4 hour candles of the Bitcoin price, and we want to talk about the price of Bitcoin before we go into the crazy thread here on Twitter between Elon Musk and the Bitcoin handle. And as you may remember, Bitcoin just skyrocketed up here to 9,500 US dollars, above the $9,000 level we mentioned in our many of our last videos here, and then we had this crazy retracement. So the question right now is this a reason to freak out? Are we going to go all the way down here to find the previous price levels again, or is that just a healthy retracement and the Bitcoin price is due for a higher upspike here in the immediate short term? We want to talk about that. And first of all, I wanted to put some emphasis on the magnitude of this dump here, which was just like 12% within a matter of like 12 hours. This is actually crazy, but if you take into consideration what happened beforehand, after we broke out here and we confirmed the breakout out of the bump and run reversal pattern we mentioned actually back then here in this video, well guys, then this dump seems to be just very healthy, and it seems like a necessity for Bitcoin right now. So in our opinion, we are still extremely bullish for the Bitcoin price, even if we go down to the $8,000 levels, because guys, if you pull out the Fibonacci retracement level here only on the micro time frame here from the swing high to the swing low, then you can see that we are right now hugging the 38.2 retracement level. And the most important thing here is, guys, after we dumped down, look at this, we actually had a strong bounce here back exactly, but pretty much exactly to the 61.8 level. And this is the key level we are watching right now, because if the Bitcoin price goes up once again, we do not want to see a double top. We want, with the next attempt, the Bitcoin price to break out of the 9,060 US dollar level, which is in fact also the CME gap, the previous one, which we now close. We want the Bitcoin price to go above, hold above, and then search for higher price levels up to the 10,500 US dollar price level we mentioned actually as the target here of the bump and run reversal pattern, since it is the high of the bump and run reversal pattern here. 10,500 US dollars is the target we are looking out for after we are breaking the 9,060 level the next. Well guys, but if we are going to be rejected here on the bearish flip side, this would be a sign for us that this golden pocket right now is too strong and that we need a higher retracement here for Bitcoin. And this retracement could, in this bearish scenario, we mentioned the bullish scenario before, which is a little bit more likely here in our opinion, this bearish scenario could bring us all the way down, actually not that far down, to the price level here of 8,100 US dollars, 7,950 US dollars, back here into the golden pocket. And I actually think a retest here of this price level wouldn't be all too bearish, especially here if we are bouncing from there and going up, because guys, this golden pocket level here is in perfect alignment to what we consider the most important price level, guys, because right now something happened here on the daily candles. Let me go over to the daily candles and let me pull out the 100 and the 200-day moving average. The yellow moving average being the 100-day moving average, the blue one being the 200-day moving average. And right now something happened. Look at this. We had the golden cross here, and then everyone was waiting for the next death cross to occur. But if we are zooming in here, guys, let me do that here right now for you. You can see that this massive pump here prevented the death cross from happening. And as you know, with golden and death crosses between the 200 and the 50-day moving average, they are not all too significant, right? Well guys, the death and the golden crosses between the 100 and the 200-day moving average, they usually do not fail as to be a very bearish and bullish indicator here whether we are talking about the death cross and the bullish cross. So far, we have the bullish cross here, the golden cross, and the death cross was prevented from happening here. And this happened, guys, actually one time before here in 2016. You can see that we had this golden cross here emerging, and the Bitcoin price had a very nice pump to the upside. We went down, but then look at this. We had this crazy pump here, actually preventing the next death cross from happening. This took us all the way up to 20,000 US dollars. And the most important thing to monitor right now is here the last golden cross, which happened actually approximately here at the price level of 5,800 US dollars. It took us all the way up to a 2.4x 140% to 14,000 US dollars. And guess what? Just out of fun here, before we go into the tweet of Elon Musk and the Bitcoin handle, if this would happen again, of course there is no certainty, but if this would happen again after we had this golden cross here, approximately at a price target of 7,500, 8,000 US dollars here in these areas, this would take us pretty much exactly to the all-time highs of 2017 to 20,000 US dollars. Of course, this takes some time. Of course, this is not about the next week, the next month, but after the halving, this is of course the next price target to look out for here in the mid-run. But now, guys, let's go to the breaking news, because everyone who is on Twitter probably saw here Elon Musk tweeting out that the Tesla stock price is too high. And guys, guess what? We didn't only get this crazy conversation here between Elon Musk and the Bitcoin handle emerging afterwards. We will come to that. Also, the Tesla stock went down 12%. You can see how much of an impact he has here on the stock price of his own company. And this tweet went absolutely viral. Let me actually give him here a like and some love, and let me give some likes here also on the Bitcoin handler's answer. And what happened here afterwards is this, guys. So he said the Tesla stock price is too high. And look at this. The Bitcoin handle tweeted out, the Bitcoin price is too low in my opinion. Elon Musk liked that, and then he was answering how much for some anime Bitcoin. You know that Elon Musk is a geek. He is a geek like most of the Bitcoin guys, like I am, and that's why he's treating this crazy stuff here with the anime Bitcoin, which already goes to show that Elon Musk has a strong connection here also to Bitcoin and the Bitcoin price. And many people out there are actually already speculating that Elon Musk is holding much more than this small amounts of Bitcoin he was already disclosing. But there's a fact that he is holding Bitcoin. So he was asking how much for some anime Bitcoin. And then the Bitcoin handle, and this is the most important or the most interesting thing, they came out and said the same cost as Wizard Bitcoin. 1 BTC equals 1 BTC. This one here is taken from this old Bitcoin forum, and Elon Musk was even answering to this here just 7 hours ago, and afterwards the Bitcoin white paper was posted to him. And the impression I have here, especially with Elon Musk so actively engaging here with these Bitcoin tweets, liking these Bitcoin tweets, I mean, guys, this is actually crazy. And what I think here is they are exchanging these anime things, these wizard things. Many people don't know who owns this Bitcoin handle. And of course, guys, big disclaimer, this is only a conspiracy theory, but I do actually think that this Bitcoin handle might belong to Elon Musk, because we always see these crazy engagements here, and also the humor is the exact same, and of course also the humor here is the exact same. I want to know from you guys, and this is a fun poll. Click the poll here, which is popping up on top of the screen right now. And do you think that the Elon Musk here actually holds this very mysterious Bitcoin handle? Let us know in the poll, which is popping up on top of the screen, yes or no. In our opinion, this is actually very crazy here. And when you see what kind of impact Elon Musk had on the Tesla price to go down, you might also speculate on him having some impact on the Bitcoin price going up with these crazy tweets, guys. Let us know in the comment section what you think about that. Make sure you smash up the like button on that video, guys. We have been hitting 3,000 likes so many times in the last videos. Let's make it this time again. We are really grateful for your support, guys. And of course, if you want to support us even further, and if you want to take advantage of this crazy volatile situation, we have a very special deal for you guys. Only if you're an experienced trader, you can get up to $1,612 completely for free here on our trusted exchanges on Bybit and on Phemex. On Bybit, we do the more higher volume trades. On Phemex, we do some shorter time swing trading here, and you can get up to $1,500 for free on Bybit. Bybit, $112 for free on Femex by clicking these links, putting in your email address and your password here on the landing pages. You can get an account within 20 seconds here very, very easily, and after 0.2 Bitcoin deposit, you can get up to these amounts here completely for free and trade with a free margin, guys. Thank you so much for the support. Thank you so much for watching, guys. And also, guys, do not miss out to click the subscription box right here or right there, and also the Bybit.
What is the biggest and most profitable market you can think of? How about this one? Current world population, 7,779,691.
Tutorial, which is popping up right here. And as always, guys, as always, bye-bye.
So, I mean, so you talked more about Elon with Elon, you know, about with the Bitcoin rather than his, you know, tweet from the other day. So, hopefully that'll stop there. So, you know, I wish Elon would address it himself. For right now, I'm going to put on, it looks like this is kind of an earnings call summary from Tesla.
Elon Musk spoke at Tesla shareholders meeting on Thursday, where he made several important statements. Let's consider each of them in detail. Tesla's shares recently grew for 8%, and Elon Musk's fortune automatically increased by $2.3 billion. Now, the total revenue of Tesla's founder is about $37 billion. Not bad, right? But what allowed Tesla shares to go upstairs? Elon answers himself.
Q1 ended up being a strong quarter despite many challenges in the final few weeks. This is the first time we've achieved positive GAAP net income in a seasonally weak first quarter. Even with all the challenges, we achieved a 20% automotive gross margin, excluding regulatory credits, while ramping two major products. We've obviously learned a lot here. After the Model 3 ramp from 3 years ago, our new products get ramped faster and become profitable sooner. In Q1, we produced more Model Ys in the first quarter than Model 3s in Fremont in the first 2 quarters. Thus far, the Model Y ramp has been even faster than the Giga Shanghai ramp in Q1. Most surprisingly, in other words, we are ahead of the schedule that we were ahead of already. Model Y was profitable already in its first quarter of production, something we haven't achieved with any product in the past. Regarding Autopilot, we released a new software update for traffic lights and stop signs to early access users in March, and to all US customers with full self-driving package just last week. Our cars will now automatically stop at each stop sign or traffic light until the driver gets a confirmation to proceed. We are collecting data from over 1 million intersections every month at this point. This number will grow exponentially as more people get the update and as more people start driving again. Soon we will be collecting data from over 1 billion intersections per month. All of those confirmations are training our neural net. Essentially, the driver, when driving and taking action, is effectively labeling reality as they drive, and making the neural net better and better. I think that this is an advantage that no one else has. It's very difficult to have a search engine that competes with Google, because everyone is training Google all the time with their searches. So when you search on something and you click on a link, you're training Google every time you do that. It's just very difficult for any new search engine to compete on that basis. All of those confirmations are training on neural net, and soon cars will be able to drive through an intersection without a confirmation, as well as to make turns, and we really feel I feel extremely confident that it will be possible to do a drive from your home to your office most of the time with no interventions by the end of the year. We can almost do this already with the leading edge alpha builds that I'm driving in the car. We increased the range of Model S and X yet again, this time to 391 miles for Model S and 351 miles for Model X. The real Model S range is
Come with me, my love. today I knew you were my pet. I wanna tell you how much I love you.
Human plasma can't be made in a lab. It has to come from you. And when you donate plasma at BioLife, it'll be used to make life-changing medicine for people with rare diseases. Donate plasma today at BioLife. Schedule an appointment at biolifeplasma.com.
miles. But when we did the last EPA test, unfortunately the EPA left the car door open and the keys in the car. So the car, and they did this overnight, and so the car actually went into waiting for driver mode and lost 2% of its range. And as a result, it had a 391 test. We will redo the test, and we're extremely confident that we will achieve a 400-mile or greater range with the Model S. The true range of the Model S for the past two months has been 400 miles. So we're not stopping now. We'll always continue pushing for improved range over time and improving handling, acceleration, and all the little details that make Tesla special. For Model Y, we introduced the revolutionary two-piece rear underbody casting that we're going to be making a single-piece casting later this year. Essentially, the rear third of the body is cast in a single piece. No casting of this size of complexity has ever been done before. I'm very excited about this approach, as it allows us to reduce the weight, the cost, and improve NVH. It's better in every way, essentially. For Model Y, we also introduced a revolutionary new heat pump, which allows the car to have a higher range. So the Model Y has remarkable range, on par with, in fact, it's probably slightly better than, I guess, the Model 3. It is especially excellent at low temperature driving. We're getting from customers who have received the Model Y thus far has been universally positive. We are absolutely continuing our Model Y capacity expansion at full speed at both Giga Berlin and Giga Shanghai. And here in Fremont, when they will let us continue. Localized production in China and in Europe will bring the cost down, making our parts even more competitive over time. Many other companies are cutting back on investment. We are doing the opposite. We are absolutely pedal to the metal on new products and expanding the company. And we're really looking forward to being in sometime next year a truly global manufacturer with major factories in North America, China, and Europe, and a capacity of well over 1 million units a year. So there's a tremendous amount to look forward to, and we can't wait to tell you what's going to happen. It has caused us to look closely at our cost structure and to be more efficient as a company. One always has to do that in a crisis. To think about our core beliefs and what do we want to do, and we came to the conclusion that the right move is actually to continue to expand rapidly, continue to invest in the future in new technologies, even though it is risky. And we've talked to some of our key investors, and they support that approach as well. There's clearly an uncertain future ahead. It's a bit of a bumpy road, but I think the long-term prospects are extremely good. The Tesla is the only car that you literally order it in less than 5.
Do you know what this is? Because believe it or not, this weird little blue tool actually sells thousands of units right here on Amazon for $19.99. And you can buy them right here for $1.97 per unit. And with over 82% of households having an active Prime membership, can you guess what this little bad boy makes every single month selling on Amazon? Well, if we pull up data from Amazon, you can see right here that this little
5 minutes on your phone, you can order a car and have it delivered to your doorstep with all the paperwork and everything done. Trying to communicate to people that this is something you can do, because normally buying a car is quite a pain. For most people, they would rather go to the dentist than buy a new car. For Tesla, it is completely as easy as ordering something from the Apple App Store or ordering something on Amazon and just it's a car. We don't want to preempt Battery Day exciting news for that day, but there will be a lot of exciting news to tell, and I think it'll be one of the most exciting days in Tesla's history. And we're just trying to figure out the right timing for that. We think probably the right timing will be probably the third week of May. Not giving a firm date, but we think that probably that's the right timing. And depending upon what we're allowed to do, it'll either be in California or Texas. There's also a tremendous amount of untapped potential in the fleet out there that could upgrade to turn on basic autopilot or full self-driving, and that's something we will enable, just as a simple in-app purchase, or as we were talking about earlier. It's always difficult to predict what the macro situation is going to be in the absence of some massive force majeure event, like quite massive. I think 50% is the likely number. It's possible that it's 40%. I would be very shocked if it's less than 40%, even with force majeure, short of World War III. I think we will announce the next Giga possibly as soon as a month. We may announce this as soon as next month. That could happen. It will certainly be within 3 months, and possibly 1 month. And that would be in the U.S. As for how many will be in 5 years, I don't know right now what that number would be. We were actually gaining tremendous momentum with the Solar Roof before COVID, and COVID essentially shut us down, both from the ability to install and the ability to get permits. The permit offices were closed, and we were shelter in place all over the place. So we obviously cannot install if you can't get permits and you can't physically do it. It's physically impossible. But I think the long-term trend for Solar Roof is extremely good, and I'm confident that, let's say within the next year, or maybe even by end of year, we should be installing at a rate of 1,000 a week. Perhaps not in the middle of winter or something. It's like it's taking seasonality, allowing for seasonality. It's hard to install on roofs that are covered in snow and ice. But like in say spring, we actually have demonstrated the ability to hit 1,000 a week burst build rate for the solar glass roof already. So that's not a problem. And internally, we want to have at least 1,000 solar roof in.
Every single Sunday, I send out a watch list for free of the absolute best stocks that are coming up over the course of the week. For example, 2 of the stocks on my recent watch list spiked 126% and 231% after.
Install teams we see demand is good, production is good, so it's really all about the install. We're also seeing a lot of interest outside of North America, so we do expect this to be a product that is international, and actually seeing a tremendous amount of interest from China on the Solar Roof. Personally, extremely excited to build a kick-ass HVAC system that also has sort of hospital-grade particle filtration, basically HEPA filtration that filters out viruses, bacteria, pollen, fungi, and also neutralizes silicon alkaline gases. That is quiet and efficient. And these are all things we've achieved in our cars. In fact, I don't know if a lot of people realize, but the Model S and X are the only cars in the world that have a hospital operating room grade HEPA filters built in. They're very big. So it's not like Model 3 and Y they're no slouches. Model 3 and Y are also they're way better than any other cars, to the best of my knowledge. They're not quite as good as hospital operating room, but they're extremely good. Way better than any other normal car. These actually have a big effect on health, even in normal, just day-to-day living, is reducing particle count. Air quality is incredibly important, even in a non-COVID situation, it's extremely important. If you're condensing water, why not also have it be a water source? If you have water, you possibly could then heat the water and have a water heater as well. It could be a hell of a product. And we just have to, Tesla, we have a tendency to bite off more than we can chew on the product front. We've got to make sure we have a lot of irons in the fire here for new products, the Cybertruck Semi, new Roadster, the Gigafactories in various parts of the world, and spooling up Model Y and Autopilot and the Solar Roof. And overarching goal is to help accelerate the advent of sustainable energy. And the 3 elements of that are sustainable power generation, then you've got to store the power, stationary storage, and then you've got to have electric transportation. But we don't have, like, say, specific market share goals or anything like that. It's just to the degree that we can accelerate the advance of sustainable energy, we think that's a fundamental good for the world, and we want to do that as fast as possible. But it's not, like I said, market share growth, it's goal in and of itself. It's just, the faster this happens, the better off the world is. We are a bit worried about not being able to resume production in the Bay Area, and that should be identified as a serious risk. We only have 2 car factories right now, one in Shanghai and one in the Bay Area, and the Bay Area produces the vast majority of our cars. All of S and X, most of the 3, and all of the Y. The extension of the shelter-in-place, or frankly I would call it forcibly imprisoning people in their homes against all their constitutional rights, that's my opinion, and breaking people's freedoms in ways that are horrible and wrong, and not why people came to America or built this country. It will cause great harm not just to Tesla but to many companies. And while Tesla will weather the storm, there are many small companies that will not. And all everything people have worked for their whole life is being destroyed in real time. And we're going to have many suppliers, and are having many suppliers that are having super hard times, especially the small ones. And it's causing a lot of strife to a lot of people. I think it's high time we invested in infrastructure in this country. We have a lot of crumbling highways and bridges, and frankly, when I visit China, I see their infrastructure as being much better than ours. It's great. Europe has better infrastructure. It's really quite sad. The U.S. infrastructure, especially sort of roads and highways, is where it is today. And our airports, in a lot of cases, are an embarrassment. And it's not just a question of money; it's a question of will. We really need to be thinking about what is the transportation of the future, not the transportation of the past. If this was 1920, do you want to be investing in steam engines or internal combustion engines? Obviously, that's not steam engines. This is the time to think about the future. I think the people are going to be very angry about this, and are very angry. If somebody wants to stay in their house, that's great. They should be allowed to stay in their house, and they should not be compelled to leave. But to say that they cannot leave their house, and they will be arrested if they do, this is fascist. This is not democratic. Take costs out of the car and make the product better. We want to take costs out of the car, figure out how to make it lighter, simpler, and so we want the car to just incrementally improve as well as incrementally lower in cost. Marginal cost of that car to be comparable to the Model 3.
I just want to make a quick point. So, I'd like to know how long does he think that the infrastructure problem in America existed? I think we could all agree that we needed to look at the infrastructure for quite some time. Again, growing up in New Jersey, when I was really, really young, I remember going over the Tappan Zee Bridge and being able to see through to the water, in certain areas where the deck had degraded that badly. I know certainly they're building a new one. I don't know if it's open yet. Maybe it is. And we've had, certain other areas. I think we had something like 20, I don't know what the percentages are, but, bridges that are just barely usable. I think the I-78 and Garden State Parkway interchange had some famous pictures of a corner of a bridge just basically hanging on by a thread, and maybe not even. All the concrete had eroded away, and I think maybe it had some rebar. In other words, it was just in really, really bad shape. And it is a shame that any of that stuff exists, because we could have people that have had, jobs. And, I don't know much about infrastructure bills and how much they're susceptible to corruption. I'm sure everything is largely susceptible to, corruption and funds not ending up where they should. But you can't get, you can't let these roads and stuff get in the shape that they're in without addressing it. the shame is that Trump ran on that. And I'm not, trying to advocate for Trump one way or the other, but he talked about that. And you're not, this should have been looked at. A major airport bill should have been passed a long time ago. An infrastructure bill is something that both sides tend to like. I mean, especially, in my opinion and experience, the left, because you're creating jobs, and you're creating municipal jobs, expanding bureaucracies, and that's typically something that the left side likes. And as far as the spending goes, I mean, that's something that's always debated on either side too. But at this point, Trump's not going to be able. He can't run on that this time around. And if he does, and he tries to, and who knows what kind of the campaign issues are going to look like in a few months. But I sure hope he doesn't go up there and start talking and talk about airports and stuff, because it's something that there's a lot of things that got done, but that should have been a no-brainer. I know Trump talked a lot about on day one, and a lot of these presidents make these promises on for day one that aren't kept. And Trump, maybe he'll find a way, and that'll be part of your stimulus here. I mean, when you had stimulus under President Obama, largely you saw all these signs along the highways, the Recovery Act. So, I think that that's something that needs to get done, and that should be done and not pushed back, is major spending on roads, it's, bridges, etc. And you're going to have to look into as well, a lot of these cities, and we had it in Tampa, and I'm sure anywhere, a lot of these cities had major cutbacks in public transportation. Bus routes cut back, eliminated. So, you want jobs. If you're going to have to spend to stimulate, all right, just create jobs. Reinstate bus routes, all right? You're spending, you're putting money in people's pockets. So put them on the buses. Easy thing there. And that's not like running airplanes around empty. Okay, you fly empty airplanes around, you're losing tens and hundreds of thousands of dollars. Millions. You're not losing millions per flight, but you're losing tens of thousands of dollars per flight flying these empty airlines around. That's not the case with bus drivers. All right, and those are union jobs for the most part. A phone call here, so we'll restart the video.
Once we have reached like 10 or 20,000 units or something like that. Before we release any functionality, it goes through extensive testing, and of course we have a simulations team that has a very good simulation of the real world. We run any code changes through a factory test and simulation. Then we have a global QA team, which I'm on actually, and we test the releases in the real world, find real world path, the differences between the real world and the simulation, which is very many because the world is very complex and weird. And then we release it to a small group of private beta testers within the company, then to a larger beta audience, including people outside the company, then to early access, Tesla owners, and then finally a broader release. There are many stages that these things go through. So by the time something is going to wide release into the US, it's gone through all of those stages, and the software that's at the very early stage is much more advanced than what people are seeing. Essentially we need to figure out, get very good at complex intersections, get very good at complex turns in intersections, and things like busy malls in a parking lot, or office park, or special events and sporting events, that kind of thing. Autopilot's engineering team we just have an extremely talented group I'm deeply involved with the team, so we talk every week and meet every week when we can. Because now physical meeting is difficult. Now, after that functionality is released, there's still another step, which is to improve the reliability of it once it's released. So you can have full self-driving with human that's supervised by the driver, and then we keep improving the reliability to the point where it no longer needs to be supervised by the driver, and we provide a vast body of data to regulators to show them the specific needs, and then presumably the regulators, depending on which jurisdiction it is, would give approval for fully autonomous cars that can drive with no human on board. Everything I've ever said would come true, did come true. It may have come true late, but it did come true.
Elon prepares 5G networks, then his own Starlink project. This is a very interesting fact, isn't it? In the near future, Tesla's collaboration with Qualcomm, Intel and Huawei is possible, because today they are leaders on the market of 5G modules. And what do you think about this? Is the interaction of Tesla and Starlink possible? Write your thoughts in the comments below. Subscribe to my channel iGadget Pro.
I was just trying to look for what I was going to put on while I run and go get a replacement to my phone that was stolen a week ago, 8 days ago now. So got to run out real quick. I'm going to come back and look at OPK, Oscar Patrick Kilo. Look at that chart, because that's probably a stock I'm going to look to trade when I come, when I get back. So what I'm going to do here is put on a little options trading video. For beginner traders, options is not a bad thing to look at. But there are trades that you don't stay in. You have to get out of them. It's for swing traders, options are not a bad deal. But you have to watch out for the time decay. So which one? Yeah. So again, they don't want to let me scroll on this page.
If you're the type of trader who has done everything out there and still can't find consistent results in your trading.
My name's Adam, otherwise known as In the Money, and today I'm going to teach you how to trade options in Robinhood. I know firsthand how frustrating it can be looking all over the internet trying to piece little parts of the puzzle together, trying to form the bigger picture of what options are, but not being able to do so. So if you're trying to get the full picture in one go, in one spot, then by golly, you've come to the right place. This video is all chopped up into sections, and at the end of each section there's going to be a list of questions, and those questions are there just to make sure that you're fully tracking with the important topics of each section. So if you want to make sure that you are fully tracking everything that's going on, you can kind of quiz yourself, and the answer to those questions are in the description below. Grab a pen, grab a paper, grab a snack. Highly encouraged. Let's jump into it. So to get to a page like this, you're going to want to search up a stock. You can do AMD if you want to follow along. So search up AMD in Robinhood and tap on trade, then trade options. It'll pull you up to, I think it says discover. Go up to the top and tap on any of the dates up there. And it'll take you to a page that looks very, very similar to this one. The numbers are going to be different, but the layout itself is going to look very similar. And what we're looking at here is 4 different call options. So there's a 49.5 call, there's a 49 call, 48.5 call, and a 48 call. So these are 4 separate call options. And if you have your phone open, you can scroll up and scroll down, and you'll see there's a lot of different call options. These are not the only 4. There's a lot of other call options, but these are all that we need to learn and understand the basics of these options. What is a call? Well, it is a contract between a buyer and a seller. And in pretty much every example today where you're going to be the buyer of these call options. So we buy these call options from somebody. We'll discuss how you do that in a little bit. But when you have this call option in your possession, it gives you the right to do something. It gives you the right, but not the obligation. In other words, you can, but you do not have to, buy 100 shares of the underlying stock at a strike price. And I know that might sound a little confusing, so we'll break it down here. So AMD is our underlying stock. It's called the underlying when you're trading options on a certain stock. So it gives us the right to buy 100 shares, right? It gives us the right to buy 100 shares. But not only that, it gives us the right to buy 100 shares at a strike price. So let's say we have this $48 call here. $48 is not how much you pay for the call. $48 is this call's strike price. So if we have this call option in our possession, we can buy 100 shares of AMD for $48 each. Okay, it's not $48 for all 100 calls, it's $48 each. So great, we're buying 100 shares at the strike price. And this process of buying those 100 shares at the strike price is called exercising your call option. You're exercising your right to buy those 100 shares. So we have just exercised our call option. Now this is pretty sick because the current trading price is $48.75. So we are buying shares for a cheaper price than everyone else is buying at. So if we wanted to, we could buy 100 shares at the strike price and immediately sell them back to the market for the current trading price. But it's just like trading stock. It's like you got in at $48 and now you want to get out at $48.75. You're going to make a profit. So we bought 100 shares at $48. Now we're going to sell 100 shares at $48.75. So if you think about it, we're making a 75-cent profit per share of those 100 shares. So we make a profit of $75. So this process of exercising your call option and making a profit is the case for any call option whose strike price is less than the current share price. If you think about it, if your call option has a strike price lower than the share price, you're buying at a cheaper price than everybody else is. So you can buy at a cheaper price and sell at a higher one. So if it has a strike price below the share price, you can make a profit. And the lower the strike price is relative to the share price, the larger that profit is going to be. So call options whose strike price are lower than the current share price, where if you exercise, you would make a profit, those options are called, those options are called in-the-money options. Call options, specifically regarding calls. We'll get to puts here in a little bit, but we're going to talk about calls first. So these are in-the-money call options, and in fact, everything lower down below that would also be in the money. But what about options where the strike price is a share price? So let's say there's a call, I'm not saying it's possible, but there's a call that has a strike price of $48.75. Well, you buy 100 at $48.75, and you sell immediately all those 100 at $48.75. You've gained nothing, you've lost nothing. So you just break even. So those kind of call options, these ones right here, are called at the money, or ATM. You'll see it abbreviated. And how about these ones that are above the share price? You can see the $49 is higher than $48.75. Well, you're buying 100 shares at a higher price than you can buy out at the market. Why would you want to do that? You just buy it at the market. It's cheaper. So if you exercised it, you'd buy at 49, sell at 48.75, you'd actually be at a loss. So you never exercise this kind of call option. And this is the case for any call option whose strike price is higher than the current share price. You don't want to buy at a higher price than the market's already trading at. That's stupid. You'd lose money. So these options that you would most certainly never exercise are called out of the money options. Out of the money. So OTM. And you can see I kind of color coded it here. In the money, or they're awesome, super cool. At the money, who cares? Out of the money, no good, garbage. Okay, so now we understand that a call in the money call option is great. You can buy 100 shares at the strike, sell at the current trading price, you make a profit. All right, so I'm just gonna highlight this a different color here. We're gonna keep looking at this $48 call. So how do we get these call options in our possession? Well, you have to actually buy them from the seller. You have to buy the right to exercise, and you can see how much you have to pay down here. If you're looking at this $48 call, you can see, or 48 strike call, we can see that it says $2.74. But that does not mean that you're paying $2.74 to buy this call option. Not at all. It is $2.74 per share of the 100 shares that the contract controls. So if you remember, you have the right to exercise 100 shares, you're paying $2.74 per share of those 100 shares for that right. So more realistically, just cutting through the jargon there, more realistically, you're paying $274 for that call option. So if you want this call option in your portfolio, the ability to exercise at $48, you have to pay $274 to get it in your portfolio. We pay a debit. It's called paying a debit. of when you pay something out of your account, it's always a debit. When you receive funds into your account, it's a credit. So now we have this $48 call in our possession, which is fantastic. This $274 is going to change. It will not stay constant. You can kind of see how it will change with the other call contracts that are less in the money. So this one's a little less in the money. It's $247 total. This one's out of the money. It's $224, $201. So you can kind of see the pattern. The further out of the money or the less in the money you are, the cheaper those call options are going to be. And this is because the further in the money you are, the bigger profit you can exercise for. So they're going to be worth more. The less in the money they are, the cheaper they're going to be. Because you can either exercise for a smaller profit or no profit at all. So as the share price moves around, making these call options less or more in the money, the price right here is going to shift around. Just like a share would, if you're trading AMD shares, it's going to go up and down, and you're going to buy at one price and sell at another. So in this case, let's say that we bought this $48 call for $274, but then all of a sudden this stock price, and we'll change it to blue to keep it kind of consistent there. This stock price jumps up to, let's say, even further than that. Let's say it jumps all the way up to $50. All right, that's a current trading price. This 274 is not going to be 274 anymore. It's going to change. You will not see it like that. It will not be 274. It will change to, and I'm kind of making up a number here. It'll change to something like, let's say $400. So that now people are buying and selling this call option for $400, and you can sell this call option for $400. So if you paid a debit at $274, but now you can sell this call option back to the market for a credit of $400. You paid $274, but you received $400. That's going to give you a total profit of $126, if I'm doing that math right. So you can see that even though we have the ability to exercise, we didn't. And we can buy and sell options for the price that they're worth and make a profit or make a loss. You never have to even exercise it. And there's a real good reason why you would never want to really exercise them anyway. And we'll get into that in just a second. All right, we're going to call it for this section. So I want you to check yourself here and make sure you understand a few things. I want you to understand what a call contract or call option gives you the right to do. I want you to understand what a strike price is and how that relates to that definition. I want you to understand what premium is, why it's written as $2.47, for example, as compared to $247. I want you to understand what in the money, at the money, and out of the money is, and which ones are good and which ones are bad and why. And then I also want you to understand just what underlying means. If you can understand all those concepts, you are well on your way to getting a grasp on call options.
Hi there, I'm Jeff Bishop. I'm the co-founder of RagingBull.com. I'm one of the top real money options traders in the entire world. I want to share with you today something that I was told many years ago, and that is, if you want to be in the top 1%, you cannot do what the 99% are doing every single day. If you want to get rich, you need to make new choices in life. You need to take action, and you need to make a new direction, and you absolutely can do that. Now, I've taken 20 years of my best options trading secrets, and I've rolled them into one easy to follow handbook called the Option Profit Accelerator. Now, I want to give this to you today absolutely free. There's no credit card needed. I'm not going to ask you for any information other than simply an email where I can send it to you right now. I want you to get your hands on this and start making better trades today. I don't care if you're brand new in the market and never traded, or if you've been trading for 20 years, it doesn't matter. What you learn in this book is going to make you a better trader, and I'm confident you will make more money. So get your hands on this right now, and let's make money together.
Hi, my name is Tim Sykes. I'm a stock trader who has turned roughly $12,000 into nearly $5 million, trading all over the world. I love being able to work from everywhere, and I've been all over the media because, frankly, I have a rather big mouth. I love talking about this stuff.
My next guest is living the life that most people dream about. At 34 years old, he's a multimillionaire who enjoys traveling around the world. Please welcome Tim Sykes. Welcome to the show, man.
Thanks for having me, man.
Good.
Appreciate it.
My guest is Timothy Sykes, the multimillionaire stock trader and entrepreneur.
With veteran trader and penny stock investor Tim Sykes, and they are both joining us right now.
And every single Sunday, I send out a watch list for free of all the hottest stocks in the coming days. For example, 2 stocks. One spiked 126%, one spiked 231% in just a few days after being featured on my watch list. And every single week, I'm going to be sending you the top 3 stocks. Now, there are thousands of stocks out there, but I narrow it down to find you the stocks with the biggest and best potential. After signing up on this Sunday free watch list, you're never going to have to pay for it. Understand that. Why am I giving it away for free? Well, I want to provide you value. I want to find you the hottest stocks in the market every single week. I want to show you what I can do so that eventually you can sign up for my premium services too. I love it. I want to give you value. I want to show you the hottest stocks every single week, and I want you to be prepared ahead of time like very few people are. Enter your email below. I will send you the hottest stocks to trade every single week.
Let's go ahead and look at this $48 call today. I like the $48 call because it's in the money. So we are going to be looking at this $2.74 of premium. This premium, we've talked about how it makes sense. This option is more valuable because you can exercise it for a larger profit as compared to like the 48.5 call or the 49 call. But we can actually tear apart this premium and figure out exactly why it's priced like this. We're not going to look at the formula like the Black-Scholes model that would very specifically mathematically describe why it's priced like this, but we're going to look at it from a very conceptual standpoint. And this conceptual perspective on how premium is priced is very, very useful when you're actually trading options. So this is not just some theory. It's not just theory. We're not just studying theory here. It is very practical, I promise you. All right, let's take a look at this $2.74. Remember, that's per share, $2.74. This can be divvied up into 2 different categories. One is called intrinsic value. The other is called extrinsic value. Intrinsic value is a portion of the premium, and it is just whatever profit you can exercise it for. So we're looking at this $48 call, right? We buy 100 shares at 48. When we exercise, we sell at 48.75. We make a $75 profit, just like we said earlier in the last section. Okay, so we can say that 75 cents of premium is due to intrinsic value, which is how much profit you make when you exercise the option. So 75 cents is intrinsic value for this call option, this 48 strike call. And we'll write it here. And how about extrinsic value? Well, this is whatever's left over. So we have 75 cents for intrinsic value. So we subtract that from 274, and we're going to have $1.99 worth of extrinsic value. And this extrinsic value, what that is value given to the option because there's time left to maturity. In other words, there's time left to expiration. There's time for this option, even if it's out of the money or in the money, there's time left for it to get in the money or for it to get deeper in the money. Remember, the more in the money it is, the more valuable it is. So there's some value given to this call option because there's more time left. It doesn't have to stay it doesn't have to be, $1.75 in the money. It could be much, much deeper by the time we reach January 31st, theoretically. The share price could jump up to $55 and then it's way in the money. So there's some value that's given to it based on time to maturity. In addition to this extrinsic value is not just time to maturity, but it's also implied volatility. And I'm just going to briefly gloss over it. We'll get to it more in a second what implied volatility is, but you can think of it as the volatility of the underlying stock. Does it bounce around a lot, or is it very calm? If it bounces around a lot, that's great for call options because your loss is limited to the amount you paid for it, but your upside is uncapped. It can theoretically go up forever. So volatility is very good for options. So that volatility of the underlying stock is also priced into options. You can think of implied volatility. Volatility is only important if there's time for that volatility to act. Okay, so hopefully you can see how that's kind of combined together. So this is extrinsic value. So let's pop back over to intrinsic value here. This 75 cents that is intrinsic value is going to change. And it makes sense why it would change because this call options not going to always be only $1.75. It might be more, it might be less. So it'll change. It could be, it's just whatever you can exercise it for, whatever profit you can exercise it for. And that number is going to change. Out of the money options, you cannot exercise for a profit. So they have no intrinsic value. And I'll write that here. And intrinsic value is IV. A lot of people use IV for implied volatility, but that's not really correct. Out of the money options have no IV. They do not. No intrinsic value at all, because you cannot exercise for a profit. So this part of the premium is going to fluctuate. This premium over here is also going to fluctuate based on if implied volatility increases or decreases. And we'll get to that more in a moment again. But think about it as if implied volatility increases, extrinsic value increases. They are positively correlated. If implied volatility decreases, extrinsic value decreases. And again, we'll get into implied volatility in here in a second. I just have to mention it here. Time to maturity, on the other hand, has a different effect on extrinsic value. And we're going to say extrinsic value decays as time passes. So as time passes, this number is going to shrink. Literally every day. You pay to play every day. You buy in at 274 and ignoring implied volatility, if the stock trades sideways, you're going to lose money. If the stock trades sideways, for a little bit, this is going to drop down to 198, which means this is going to be worth 273 and you're going to lose $1. Maybe a little bit later, it drops down to 197. This will just keep bleeding off all the way up until expiration date, at which point you've either got to make it or break it. You're either in the money or you're not. And this process is called, call it time decay. It's also called theta decay, which we'll touch on here in a moment. But just know that when you buy options, the stock can trade sideways and you're losing money. Okay, so just kind of recapping what we have here. Part of this premium is literally whatever profit you could exercise for. So $75 worth of that $274 you pay is the amount you could exercise for. The extra $199 that's left over is due to time to maturity and implied volatility as a function of each other. The more time you have till expiration, the more time you have for that volatility to take effect, the more valuable your option is going to be. So both time to maturity and implied volatility are good for options. You want more time. They're going to be worth more. It also means you're going to be more expensive. So if you flip between January 24th, February 7th, February 14th, you'll see that these numbers increase the further out your expiration is, because there's more time to maturity. You can actually see what we're talking about be shown on your app when you select that further out application. So they're going to be more expensive because there's more time for them to get in the money, which is a good thing. But that means there's also more money to bleed off. So if you bought an out of the money option with a far out expiration date, that will just bleed off. If you never get in the money, it'll bleed off to zero on expiration date. You're done. There's no money left. But of course, that's with call options. That's the max you could lose. You can never lose more than the amount of money you put into it. So at expiration date, nothing terrible happens. The worst thing that can happen is that it expires worthless and you don't have any money left. If it expires in the money and you have the capital set aside, it'll exercise automatically. So those are like the two options you can think of happening. This is why you would never exercise this $48 call, or very rarely would you exercise before expiration day, when you have all this extrinsic value left. You may get up to expiration day and all this extrinsic value is gone and you have intrinsic, at which point you might as well just sell the option, but you could exercise it as well if you just have intrinsic value left on the last day of expiration. Because if you exercise, you'll make $75, or you could just sell this option, which is now worth $75, and make $75. There's really no difference. But let's go ahead and, just so you get the idea in your head, let's go ahead and exercise this option. So we have this $48 call. We exercise it. We make our intrinsic value. We make $75 because they're equal to each other. This $75 from this $75 profit you make from exercising is built into the premium, and we call that part of premium intrinsic value. So they have to be equal. So $75 when you exercise it. However, you lose the extrinsic value. You lose $199. Once you exercise, there's no more time. You just gave up all your time. If you exercise now and there's still a few weeks left until January 31st, you gave up all that time. So you give up extrinsic value. There's no time to maturity as a function of implied volatility because there's no more time for time to maturity. The contract's gone. You've used up your right. It's disappeared. So extrinsic value disappears. So you lose $199. So if you gain 75 but lose 199, you're going to be at a loss of what? 75 minus 199. You are going to be at a loss of, we'll do it in parentheses, 124. This is why you can't just buy the $48 call and exercise it immediately. You would be at a loss. So why exercise it? You wouldn't. You'd only ever just sell the contract back to somebody else. Don't exercise it. You give up all that extrinsic value. There are certain examples where you will exercise. They're so rare that it's not worth talking about right now. Summary time, boys and girls. So when you buy a call option, you are paying this premium right here, this $2.74 per share. So you're paying $274 to buy this option. That premium of $2.74 can be divvied up into two separate categories. One is an intrinsic value. The other is extrinsic value. Intrinsic value is whatever profit you would get when you exercise the option. If you have a ticket that says get $10, use at the snap of your fingers and get $10, that ticket is going to be worth $10. So that's essentially what's happening here. This call option is a ticket to at least $75. So it's going to be built into the price of that call option. So whatever profit you get when you exercise. With out of the money options, there is no intrinsic value because you cannot exercise it for a profit. Extrinsic value is a premium built into a call option based on time to maturity and implied volatility as a function of each other. The more time you have till expiration, the more valuable your call option is going to be because it has more time to get more in the money. And in volatility is going to determine how likely that potential is that it gets deep in the money. If there's low volatility, it's less potential, so the option is not going to be worth as much. If there's higher volatility and there's more time, there's a higher likelihood it's going to swing deeper in the money. So it's going to be represented as a more expensive call option. Most of the time, you would not want to exercise your call option because when you exercise, you do technically give up all of your premium, but you also make $75 just by exercising it. So really all you're giving up is extrinsic value. And you don't want to throw that money in the garbage. That would just be throwing it at the seller's pocket. You don't want to throw it away. So you almost would never exercise. But exercising options is where this premium comes from. The ability to exercise is what drives the value behind call options. Oh, mamma mia. And lastly, while we're here, I want to touch on where you see to break even percentage. This just means the stock price has to increase by 4.08% for you to break even. Here's the dealio. I just went on a rant that it was just too much. It's too much information, I think. But I was talking about the to break even percentage. And I'm just going to tell you what it is. If you want to learn more about it, I'm throwing a video up in the corner that I went into great detail about it. What it is, go away. Thank you. What it is the percentage the stock price has to move up because you have calls, you're betting on the stock going up for you to break even by expiration date. When you buy this call, you are at break even, essentially. You buy at 274, you could theoretically, we're kind of glossing over some things, but you could theoretically just sell for 274. And so you're at break even. But as time goes on, the extrinsic value decays off and that option becomes less and less valuable. You better hope the stock price goes up so that the value of the option increases to counteract this extrinsic value decaying off. Okay, so today your break even's right where you bought in. On expiration day, your break even is going to be 4.08% in the upwards direction, which is going to be the stock price of $50.74. I don't want to go any more into that because it is kind of a big topic. I guess my questions to you now to check yourself are, what is extrinsic value? What is intrinsic value? Why do out of the money options not have any intrinsic value? When there's more time to maturity, are contracts more or less valuable? And when implied volatility increases or decreases, does the value of the options increase or decrease? All right, I think that covers it for this section. Let's take a look at why volatility is good for options and how you can use it when you're trading. So let's pretend we're looking at a stock chart here. Okay, it's wiggling around, it's doing its thing. And let's say we're just kind of breaking the rules a little bit here, but let's say at this point we would be at our max loss, or our contract would be worth $1. It's never going to be worth less than $1 before expiration. You know, at expiration, if it's out of the money, it'll expire worthless. Definitely want to sell before expiration. It'll never be worth $0 before expiration. So let's say we hit 0.01, so it's worth $1. And we'll say that this area, the white area, is low volatility. And all of a sudden, volatility really picks up and we get some massive swings, right? Huge swings all over the place. Well, this is good for options because your losses are capped. Even though volatility increases, once you hit this point right here, your option's going to be worth 0.1. No, it's going to be worth $1. It's going to be worth $1. Down here, what's it worth? It's worth $1. Down here, it's worth $1. If the stock went down all the way to like 1 cent, it would be worth $1. Okay, it's never worth 0 until it expires. But what about when it goes up? So let's say at this point, let's say when we bought it right, let's change our color here. Let's say when we bought it right here, it was worth $250. When it swings up here, it'll be worth $400. When it swings up here, it'll be worth $800. When it swings up here, it's worth a whopping $1,600. So even though volatility increases and the potential for things to go down increases, once it hits this point, anywhere below that, it doesn't matter. It's going to be worth $1. However, when it goes up to the upside, the further up it goes, the better. Your potential profits are uncapped. So that's why volatility is a good thing. And so when people expect stocks to be volatile, options are going to be more expensive. That's essentially, in the simple terms, what implied volatility is and why it is good for options. And it is also worth noting that implied volatility is extracted from options premiums. Think about it in this way. So options prices are based around how much people want these options. If there's high demand for them, options premiums are going to be inflated. And that's what implied volatility is. If people, buyers of these options, if they expect that in the future, this stock price is going to be very volatile, they're going to start buying up these options because they really want them because of the reasons we just discussed. And all these buyers are going to start moving in, and that's going to push the options prices higher. So implied volatility is just that. It's volatility implied by the options premium. So when all of a sudden the options premiums get inflated, but it's not due to changes in stock price, and it's not due to time to maturity or any other reason, then it can be attributed to this idea of implied volatility. People anticipate the stock being more volatile in the future. So how can you use this in your trading? So there's mathematical models that will extract implied volatility out of options premium. So they'll extract the volatility that is implied. And it'll be described as a percentage point between 1 and 100, where 1% is very low volatility, 100% is very high volatility. This percentage is going to move over time, and it's going to be graphed out. And I'm going to draw it down here. I'm sorry. It's going to be graphed out, and it'll look kind of like a stock chart, something like this. It'll have big drops at certain points with earnings plays, which is why you never buy options on earnings. Do not buy options on earnings. Please don't. Implied volatility collapses after earnings, and so does your options premium. So never, ever buy options as an earnings bet. I'm telling you as your mom right now, don't do it. You're going to lose your money. So it changes over time. So your options premium is going to change over time, which means that if you buy an option when implied volatility is down here, and then you hold it, and then you hold it and hold it and hold it up to this point, till you're right there, everything else held constant, you're going to make money because maybe you bought this option at $2.70 worth of premium, so $270. Stock trade sideways. You don't have that much time decay. It hasn't been that long, so that extrinsic value has not decayed off really, just hypothetically. Up here, it might be worth $290 in premiums terms, so $290. So you would make $20 just from implied volatility increasing. So the idea here is you want to buy when implied volatility is low because those options are going to be cheaper. And then hopefully in the future, implied volatility will be higher because people find demand for those options. Your options premiums are going to increase due to that increased implied volatility, and you can benefit, make some profit off of that. So it's not just stock prices. That's why if you buy an option, and even excluding time decay, the fact that your premium decays off due to the passage of time, excluding that, if you buy an option and the stock price stays flat, but implied volatility drops, your options premiums are going to drop and you're going to lose money. That's another reason why if it's trading sideways, you still might lose money. People ask that a lot. So a real key way how you can use this in your trading, because you want to buy when implied volatility is low and sell when implied volatility is high, is this idea of mean reversion. When you look at a historical implied volatility chart, it's going to look not exactly like this, but we're going to say it's something like this. You could really kind of put where the average is on this graph. It would probably be somewhere right in here. And there's this idea in all of nature and all of mathematics and in options trading that things will revert back to the mean. So when implied volatility is low, when it's down here, it's going to have a tendency to revert back up to the mean. When it's high relative to its history, relative to its average, it's going to revert back down. Then it's going to go back under, revert back up, revert back down, revert back up, revert back down. And where you want to buy are going to be at these lows, because then you're going to experience this inflation of your options premiums because the implied volatility increases. And so again, we're just looking at implied volatility being graphed out. It's a historical chart of that percentage I was talking about. You don't really need to know what the percentage is specifically. Just think of it as low or high volatility as a percentage between 1% and 100%. You can buy options when implied volatility is high, but you might actually experience a contraction in your options premium, and you might have a worse loss if stock prices go down and you have a contraction in implied volatility. Premium will collapse very quickly and you'll lose money pretty fast. So the best place to find an implied volatility chart would probably be marketchameleon.com, at least as a beginner. There's better and slightly more advanced ways to do it, but for your sake, as a just starting out, just learning, this is perfectly fine. So marketchameleon.com, let's look up AMD and go to volatility in the left and implied volatility. So here we are, and you can kind of see that idea where it goes down and up and down and up, and you can kind of see at what points are low just by eyeballing it. What points are low, what points are high. You might even look at this and say that's kind of high. So if you want to give yourself a real extra edge, look up these charts on marketchameleon.com. See if implied volatility is relatively low compared to its history. And if you think that the stock price is going to go up in the future, maybe using technical analysis, maybe with a little bit of fundamentals tossed in, then go ahead and buy. And then now you've given yourself an extra edge. So not only do you make money when stock prices increase, but you also make money when implied volatility increases. Got it? Cool. So at this point, you don't have to know a whole ton about implied volatility, okay? So there's a lot to learn about it, but you don't have to know a whole bunch as a beginner. What I want you to know, or the questions I would ask you to make sure you're keeping up, are why is volatility good for options? What happens to options premiums when implied volatility increases or decreases? Why is it called implied volatility? And to think about that one a little bit, it's a little bit tricky. Why is it called implied volatility? Really, I think those are the only three questions I'd really want you to have down to understand implied volatility to actually trade with it successfully. Keep in mind when you're looking at this idea of the reversion to the mean, you're looking at its own historical chart. There is no perfect percentage. Is it high or is it low? You're looking at, is it high or low relative to its history, because you want to have an idea of what the average is. So just keep that in mind. Implied volatility is going to tie into one of our following sections, but for now, I think this covers it pretty good. So if you understand those three questions, good on you. If you've made it this far in this video, you are getting an edge above a lot of other traders out there. So keep it up. I'm proud of you. It's a new day, so I'm wearing a new shirt. Hair's looking fresh. We are going to look at some option statistics that are very, very important to trading. So to get to this page, which is a list of statistics that pertains to a specific call option, what you're going to want to do is you're going to select a specific call option. So you'll tap on it. And then towards the left side, you'll see a bid and an ask price. And they almost look like they're a hyperlink. They're kind of highlighted a color. So you're going to tap on those guys and it'll bring up these statistics. And so we're going to break these down for you. And they're very important for trading. So we're going to break down most of them. You're going to ignore chance of profit and implied volatility. You just don't really need to know that right now. Plus, we've already covered implied volatility. This implied volatility pertains to individual options, but you can really just think of it as almost averaged. So implied volatility, like we said, is extracted from options prices. And so you can see the implied volatility that is implied by this options price. And each option is going to vary a little bit, but you can think of it as just applying to the overall stock, almost like averaging all of the options implied volatility. So you don't need to get into the details of that. Okay, so we're going to start off by looking at the bid and the ask up at the top here. The bid represents the buyers. The ask represents the sellers. Sellers want to sell at a higher price. Buyers want to buy at a lower price. It makes sense, right? Just intuitively. And you can see that represented here, where this bid price is $224 and this ask price is $227. So this represents where people are buying and selling at. And you can see how many people are buying and selling at because you can see the number right next to it. So there are 58 orders at the price of $224. Those are buy orders. There are 12 orders at the price of $227. Those are sell orders. That difference between the bid and the ask, that difference there, the really 3-cent difference in premium, that is called the bid-ask spread. So a seller has to either meet a buyer at the bid price, because that's where people are buying at, or the buyer has to meet someone at the ask price, or maybe they meet somewhere in the middle. But regardless, someone's giving up some money. So if I want to buy this option immediately, I have to buy at the ask price because that's where people are selling at. That means I'm buying for $2.27. And that bid-ask spread, that 3 cents, that goes to the exchange. The people who are meeting these buyers and sellers together get the bid-ask spread as compensation for uniting those two parties. So that goes to the exchange. So either the buyer meets the person at the ask price, the ask meets the person at the bid price, so they give up 3 cents and those 3 cents go to the exchange, or they meet somewhere in the middle. So you could, to buy and exit immediately, you would have to buy at the ask and sell at the bid, and you would lose 3 cents overall because you're paying $2.27 and then selling for $2.24. You're selling for 3 cents less, and then premium turns, that's $3. So you'd give up $3 to get in and out of this trade immediately. But these two, this happy little couple here, can meet somewhere in the middle. So for example, maybe the buyer puts in a order for $2.26. Well, the seller might be willing to move from $2.27 down to $2.26. And then all of a sudden you have this match together where someone's buying at a price and someone's willing to meet them at that price. And the seller is giving up 1 cent. This person is selling at a cheaper price. And the buyer here is giving up 2 cents. Because the buying price, the bid price is $2.24. So altogether, they give up 3 cents. And that 3 cents, like I said, goes to the exchange. Sorry, it's white on white. So let's get rid of this a little bit. So really all you need to think about is the closer you are to the ask price when you're setting a limit order to buy an option, the closer you are to the ask price, the more likely it's going to be filled, because then you're paying a higher price for it. Sellers don't have to meet you at such a low price. So if you want to get it immediately, buy at the ask. But keep in mind that if you buy at the ask, you're likely going to have to sell near the bid. So if the bid-ask spread is wide, which it can be, and we'll get to that in a second, you're going to be giving up a lot of money by buying immediately at the ask. So maybe set an order somewhere in between the bid-ask spread and wait for a seller to meet you in the middle. Now, when you buy an option and it's now time to sell it, you want to get rid of it, you have to sell closer to the bid. You have to sell at a more cheaper price, just like I said. So don't go trying to sell at the ask price. You're going to have quite a hard time doing that. You might set somewhere in the middle. And you can see what price is in the middle because it's called the mark price. And that is listed right here. And that's going to be the price that Robinhood displays on all of their options. So sometimes you might buy an option where the bid ask is really big, and when bid asks are very wide, they tend to jump around a lot. And Robinhood will continually show the mid price. So even if there's like no buyers, so let's say there's no buyers at all, it's going to be 0.00 on the bid side. And then on the ask, we'll write bid here. On the ask side, there might be one seller, but they're selling at a ridiculous price of like $200. Well, Robinhood, even though there's no buyers, Robinhood is going to show the price as $100. And so maybe at one point your option was worth, it was showing the mark price at like 50 cents because the seller was selling at 100. But now a seller's selling at 200 and there's no one buying. It's going to show 100 in the middle. On the Robinhood platform, it's going to say you made $50. If that's a little confusing, that's okay. I'm just saying the bid ask is going to jump around, and sometimes the mark price, which is not really a realistic price all the time, is going to be the price that Robinhood shows. So you might see an instantaneous profit, but it's not real because you still have to sell at the bid and there's no buyers there anyway. So the mark price is in between the bid and the ask, and it is what Robinhood shows as the price for the option. Even though realistically you may not be buying at that price or selling at that price, you might be buying closer to the ask or selling closer to the bid. The high and low, that's the highest price for the day, and that's the lowest price for the day. The volume equals number of contracts traded. The higher the volume, the better, because if there's people buying and selling throughout the day, you want to be able to buy and sell with them. You want to maybe be able to get in and out of a trade quickly. So if there's higher volume, like this kind of volume is good, 1,455, that's good volume. If there's higher volume, you're going to be able to have people that are willing to buy from you when you want to sell an option, and people willing to sell to you when you want to buy an option. If volume is very low, there may not be many people wanting to buy and sell options. You might have a hard time getting in and out of a trade. Open interest, which we're just going to call OI. And you can see that open interest is right here. Open interest is number of contracts open. So this is saying currently there are 4,114 of this exact call in existence. And they will go in and out of existence as a buyer and seller agree to create a contract, and then a buyer and seller swap sides and destroy that contract. This open interest is going to fluctuate. It's going to grow and shrink. The more open interest there is, it's going to be probably going to be higher volume. And the higher volume there is, the tighter the bid ask is going to be. So that's why it's really nice to be trading options when they have high volume, because that people buying and selling a lot is going to push that bid ask price closer and closer together. And when that's closer and closer together, you're giving up less to get in the trade. Because remember, you have to buy at the ask and sell at the bid if people aren't willing to meet you in the middle. So a tight bid ask like this, which is like 3 pennies, is great. It's not that big of a deal, giving up $3 if you have to get in and out very quickly. But if this bid ask is very wide, maybe 50 cents or $1 wide, because of the volume is so low, you're giving up $50 to $100 to get in and out of the trade quickly. So you always want to check this when you're going to buy an option. You want to make sure that the bid and the ask is tight. That's a real biggest part of all of what I've said so far is look at the bid ask. Is it tight? Are you willing to give up that much money if you have to get in and get out quickly? Think about it. All right, let's get rid of some of this. Okay, now we're moving down to the Greeks. And the Greeks are what is affecting the price of the options. And we've covered basically all of this as far as what you need to know. But this tells you how much certain things are affecting the price of the option. And it all makes sense here in just 2 seconds. We're just going to write it out here. So delta. This represents how much your options premium is going to change given $1 change in the underlying. So if this stock, if AMD goes up $1, that means that the value of your contract is going to increase by 50 cents. So you are going to make $50 if AMD goes up $1. Now you see how that's a lot of leverage. And that's the appeal of options, that they can give you a lot of leverage. This is almost like having, excluding other things, it's almost like having 50 shares of AMD, but you're only paying $227 for it. So that's leverage. And this kind of leverage might not be suitable for you. You may not be willing to lose $50 if AMD goes down $1. Okay, so it's up or down. It's positively correlated, which is why this number is positive. It's how much premium changes with a $1 move in the underlying. AMD goes up $1, you make $50. AMD goes down $1, you lose $50. Gamma, which we're not going to get into too much today, is how much delta changes giving a $1 move in the underlying. So delta is not constant. It does not say it stay at this 50 cents, which is why if you buy a further out of the money or further in the money option, they're going to have different deltas. In fact, those deltas are going to change between 0 and 1. So the further in the money you are, the higher your delta, the more leverage you have. However, if you buy maybe an in the money option for $100, but you buy 2 out of the money options for $100, so those out of the money options are worth 50 cents each in premiums terms. Those 2 out of the money options are going to give you an overall higher delta. So in other words, if you buy a couple out of the money options, they're going to give you more leverage than a single in the money option that's worth the same in premium. So just kind of writing it out as an example here, you might have out of the money options, they're worth 50 cents each. You're going to buy 2 of them, so you've paid $1 in premium. In the money, they might be worth $1 each, so you're going to buy 1 of them, so you're paying $1 of premium. However, the delta of each of these, just for example, is 0.3. The delta for each of these is equal to 0.5. However, you bought 2 of these, you bought 1 of these, so your overall delta is 0.6. Your overall delta here is 0.5. So even though you paid the exact same amount, if you buy 2 out of the money options, you're going to have more leverage than buying 1 out of the money option for the same price. However, time decay, which we're going to touch on here in a second, affects out of the money options much faster, and you're going to have a higher break even by expiration day. So they are, you're less likely to, in the end of things, make money. They're a more risky bet. If you're right, you can win big, but if you're wrong, you're going to lose big and fast. Even if the stock just trades sideways, these 2 are going to melt away. So gamma, how much delta changes given a $1 move up or down in the underlying? And gamma will change as well. But we're not going to get into that too much. Theta is how much you pay to play every day. So this is, and it's negative. So that means as each day passes, you are losing 7 cents, or, rounding up, 8 cents of premium every day. And that is actually going to increase. So every day, because of that extrinsic value that evaporates off, that value that's based on time to maturity as a function of implied volatility, that premium is going to start evaporating off as time goes on. And you can see exactly how fast it evaporates off right here in theta. This is called theta decay. So you lose, in real terms, $7 every day, and this will ramp up in speed as you get closer to expiration. In fact, the curve of, if you could graph it out here, let's say you bought in here, and this is the premium you paid, it's $2, and right here is expiration day. The value of your option is going to look something like this, where initially, when you have a lot of time left to expiration, the theta decay is going to not have very much effect on the value of your option. It's going to, stay relatively flat, might bleed off a little bit. But as time gets closer and closer to expiration, it's going to really, really ramp up. And you can see because the expiration of this AMD option I have selected expires in like a week. So you can see how as each day passes, a large portion, like $7 of that bid, that $227 that you would pay for now evaporates every day. And that's going to ramp up until expiration day. And then all that extrinsic value, that value based on time to maturity and implied volatility is gone. And your option's either in the money or it's not. It's either worth something or it's worth nothing. If it's out of the money, it'll expire worthless. So keep that in mind. That's another reason you might buy an option that's further dated out, is because you're going to not be paying as much to play every day. It's going to be trickling out very slowly. So when you combine buying out of the money options with a near expiration, you are giving yourself a lot of leverage. They're very cheap, so you can buy a lot of them, and you're giving yourself a lot of leverage if things move big fast. But if they don't move big fast, all of a sudden you're going to be down a lot of money, because that extrinsic value, which is all that constitutes out of the money options, is going to evaporate very, 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 very fast towards the end of its lifespan. Okay, so delta, how much the options premium changes given a $1 move up or down in the underlying stock. Gamma, how much delta changes giving that same $1 move. So delta changes by a factor of gamma. The more in the money, as with a call option, the more closer to 1 delta is going to be. The more out of the money, the closer to 0 it's going to be. With puts, you'll see that it's going to be -1 and 0, because with puts, you're going to be betting on the stock going down. So when you're betting on the stock going down, it's negatively correlated. So if if delta is -0.5 for a put, that means if the stock goes down, you are going to make $50. If the stock goes up, you are going to lose $50. So they're inversely correlated. Stock goes up, you lose $50. Stock goes down, you make $50. They're inversely correlated, negatively correlated. But we'll touch on puts more in a minute. Once you get calls down, puts is easy, I promise you. Vega is how much your premium is going to change based on a 1% move in implied volatility. So if implied volatility increases, you are going to make $4. So Vega, how much premium changes given a 1% move in the implied volatility? So almost like how delta is to the stock price, Vega is to implied volatility. So you can see there's a positive correlation, and that's going to be positive for both calls and puts. Implied volatility is both good for both calls and puts. Rho is a tiny little baby guy that barely moves the needle. It is, Rho has to do with changes in interest rates. When interest rates change, they're going to affect the value of your options. But it's so insignificant and not worth even bothering with that I'm not going to go into it. So don't worry about Rho. So these are the questions. This is kind of a beefy section here, even though we went through it pretty quick. It's not like the concepts, I think, are not terribly hard. There's just a lot of information here. So these are the questions that I would ask you to make sure you're keeping up. What is the bid price? What does it represent? What is the ask price? What does that represent? What is the bid-ask spread, and why is it important? What does Robinhood display as the options price? The bid, the ask, or the mark? What is volume and open interest, and how does volume affect the bid-ask spread? In other words, if volume is higher, does the bid-ask spread get smaller or bigger, and vice versa? And then basically run through all the Greeks. What is delta? What is gamma? What is theta? And what is vega? All right, if you have those down, good on you. I'm proud of you. Let's move on to the next section. So in this section, we're going to describe a lot of what we've already gone over, but in a visual kind of way. And then we'll also look at a certain type of diagram that is often used when explaining option strategies. So you'll see this diagram in the future when you move on to things like bull call spreads or credit spreads or whatever. You're going to see this diagram that we're going to talk about. So it's important to know. On the left here, we have a premium diagram. It's a diagram of premium. It's not like a very fancy diagram. And on the right, we have a profit loss diagram. So on the left side, this y-axis is going to be premium. And we're talking about calls. So it's going to be call premium, and that's going to be denoted as C. So we have call premium on the y-axis. And then on the x-axis, we have stock price. And we're going to denote that as S sub 0. So essentially, this blue hockey stick looking guy is your call premium given different stock prices. So basically, any stock price below this point, your call premium is 0. There's no call premium. You're at your max loss. Once you hit whatever this stock price is, you start making money, and your call premium goes up such that maybe right here it's $1, maybe up here it's something like $2. Okay, and we're going to leave one of those there because we'll need it here in a minute. And this is all on, I guess I should say, this is all on expiration day. Every bit of this This is all at expiration. So we're looking at, if you remember, this is after all that extrinsic value is gone. So we are looking at intrinsic value. So what is the intrinsic value of this option? What is the value of this option on expiration day, given different stock prices? And on expiration day, if the stock price is below your strike price, that means your call is out of the money. You can't exercise it for a profit. It's worth nothing. It has no intrinsic value. It's out of the money. You exercise it, you lose money. So there is no intrinsic value. So when it's below your strike price, that means your call's out of the money. So it's going to be worth nothing on expiration day. There's no intrinsic value. So we're going to choose a strike. We'll say strike equals 20. So that means that this stock price right here is $20. And after that point, you start making money. And if we're talking about intrinsic value, we know exactly what the stock price would be when you're making $1 in premium. It would be 21. Because if you're $1 in the money, you exercise it, you would make $100. $1 gain per share of those 100 shares. So if you make $100 when you exercise it, that means that the call must be worth $1 in premiums terms. So we know exactly what the stock price is when the call option is worth $1 on expiration day. So this is all a lot of what we've been talking about, just kind of drawn out. But any day prior to this, and this is at expiration, remember, any day prior to this, it's not going to look like this hockey stick right here. It's going to look a lot different. So let's say maybe a few months back, the premium's going to look something like this. So that instead of it being worth $1 when it's at 21, when the stock price is at 21, it's going to be worth something like, and we'll kind of estimate here, we'll say it's something like $4. We'll kind of scribble this out now, bring it up here. So strike is 20. So there's all that extra value given to this call option based on time to maturity and implied volatility. Whoa. And we call that extrinsic value. So the difference between these two is that extrinsic value, which is $3. So it has $1 of intrinsic value because that's what you can exercise it for. And it's now worth $4 at that stock price when it's 2 months earlier. So there must be $3 worth of value based on time to maturity and implied volatility. So basically, any of the area underneath this curve is extrinsic value. It is this value given to the option based on time to maturity and implied volatility, which will slowly decay off. So over time, as time passes and time goes on, this curve is not going to stay the same. It's going to slowly start shrinking down. So like maybe after another month, it's going to be right there. And you'll see that your call options value is going to decrease. So maybe now it's at 350. I'll get rid of that just to keep things nice and simple. And then maybe a little bit later, it's looking something like this until on the last day of expiration, it just is that blue hockey stick graph. All that extrinsic value is gone. You can either exercise it for a profit or you can't. So this process of the options premium decaying away, the extrinsic value of the options premium decaying away until all that is left is intrinsic value, the blue hockey stick. That process is called convergence. So there's intrinsic value at the bottom. If it's in the money, there's some intrinsic value, and it's going to be at the bottom. On top of that is extrinsic value, the value for time to maturity and implied volatility. And that's going to be decaying away as time passes. So it'll shrink down until there's no extrinsic value left. All that's left is that intrinsic value. If it is in the money. If it's out of the money, then there's nothing left. There is no intrinsic value. You cannot exercise it for a profit. So that process of extrinsic value converging on intrinsic value is very appropriately named convergence. On top of that, this extrinsic value is going to shift based on implied volatility like we discussed. So it might shrink down if implied volatility decreases, and you'll see that that causes a decrease in your options premiums. Now it might be $3 down there. If implied volatility increases, then maybe this line will increase like that. And now it's going to be worth more than it would otherwise. So maybe it's worth something like $5. So that yellow line is going to bow in and out based on expansion and contraction of implied volatility, and it's going to shrink overall as time passes inwards until it becomes that blue hockey stick, and that process is called convergence. Got that out of the way. So that's basically the concept we've been talking about, just kind of drawn out. So over here on the right, we have a little bit of a different diagram that you see often when you're learning new option strategies, like I said before. On the y-axis, instead of having the call premium, you have your profit or loss. So this blue hockey stick is the exact same over here, except for instead of looking at call premium, we're looking at how much money you've made and how much money you've lost. So we're going to say that when you bought this call, we're going to say the call premium was $1. So you paid $100 for this call. In addition, like we said, our strike price is 20. So we're going to put 20 right here. If you're out of the money on expiration day, you have lost everything. If you're in the money, there's a certain area where you make less of a loss, and then you start making a profit right over here. Ooh. So if you're out of the money on expiration day, your max loss is going to be whatever you paid for that option, and you paid $100. So you lose $100 if you're below your strike. Now, right here in the middle, right at the x-axis, it's not good nor bad. You are at your break even. You neither made money nor lost money. And you can see that because your profit and loss, as it's graphed out, crosses the x-axis right there. So this is your break even. Right there's your break even. You've neither made money nor you lost money. And I know exactly what the break even is because the break even is equal to your strike plus the premium you paid. Because let's think about it. It's kind of not super intuitive, but let's think about it. If we are at $20 and we exercise that option, what's going to happen? Well, we're going to buy 100 at 20, right? We're going to sell 100 at 20 because that's the current share price. We neither make a gain nor a loss. We're at 0, but we give up the call premium we paid. When you exercise that option, the value of your premium goes to the seller. You don't get to keep that money. So you get 0, but you also lose the money you put into it. So you're at $100 loss. Okay, so let's think about that then. How do we make up that $100? Well, we have to hope that that this gets $1 in the money, because think about it. If we can exercise at $20, but if the current share price is 21, we can sell for $21 each. And we are going to make a $100 profit. So if we make a $100 profit, but we give up the call premium, it goes to the option seller when we exercise, then that means that we are going to lose 100 and we are at break even. So we're talking about this in the context of if you exercise or not, but you have to also think about the value of your contract on expiration day is whatever you could exercise it for. So your break even right here at $21 that's going to be the value of your call contract. It's going to be how much you put into it. So if you paid $1 for this call contract, at $21 on expiration day, that's your break-even price. You are going to neither have made any money nor lost any money. You would sell it for just break-even. You could also exercise it for break-even, but what's the point? You might as well just sell it. And this is where the math on expiration day is very easy. If the stock price is 22, we draw a line up here, we draw another line in over here, we've made $1 in premium. I guess I make it green, huh? We've made $1 in premium. I don't have any questions. Make sure you're tracking. This is like extra. Like if you get this, then you really have a deep understanding of what we've talked about so far. If you don't really get what's going on here, but you have a more a practical, conceptual understanding of what we talked about, that's totally fine too.
If it were easy to make money in the stock market, everybody'd be doing it. They're not rich, and you know there's a reason why. I'm telling you, the stock market has changed my life, and I've learned some really simple techniques that can help you become consistently profitable. I'm Jeff Bishop. I'm the co-founder of RagingBull.com, the world's fastest growing stock market education website. I'm also the world's top real money live streaming options trader. I want to share with you what I've learned over 20 years of my best tips, tricks, and secrets all put into one course. This is my best-selling course. Normally, it's $49, but today, I want to give it to you absolutely free. Just give me your email address, let me know where I can send it to you. If you put these to work, you're going to learn how to make more money, be more consistent, and have new options in life that you never knew you had. The stock market has changed my life, my family's lives forever. It can do the same for you. So get started today. Get your hands on the Option Profit Accelerator. It's really simple. Enter your email, get it, put it to work. You can start making more money today.
This is $30,000 cash. Look, my parents thought I was selling drugs. I wasn't. I was day trading stocks. Listen, 90% of options, millionaires, trading geniuses, gurus, etc., it's all bullshit. I'm not a genius. I just have a consistently profitable system that just works in all market environments. It can be a bull market, a bear market, or shopping market, and I can make money every single day in every single market. How? It's simple. I want to teach you how to make money in any environment by following a simple, systematic strategy that takes all of the emotions out of trading. You'll love it. It's totally free, and I promise you, if you stick around to the very end of the training, you will become a consistently profitable trader as well. I'll see you soon.
So this section and the following section, we're going to be tying a lot of the stuff we've learned so far together and learning couple new things along the way. We're starting to move into the area of putting the bigger picture together, putting everything together and see what it looks like in the big picture and how it looks like when you're actually trading these things. So we're zooming out a little bit here. What we're looking at here is optionsprofitcalculator.com, which is where you can like enter an options trade and see what your profit or loss would be given certain dates and different stock prices. So you'll kind of see what I'm talking about here when we put one together. So if you didn't catch me there, I clicked on long call because we're talking about calls here. So we're bullish on the underlying stock. We're going to do AMD again, and we're going to buy an option. So it says buy, and the option we're going to be buying is a call. So we're going to choose an expiration date that's a little bit further out. And if you look at these at the money calls right here, so this one's worth 77 cents in premium. If we move it out to March 20th, it's now worth 458 in premium. So that extrinsic value has expanded because of the time to maturity and as a function of implied volatility. So you can see the bid, mid, and ask, and the mid is the same thing as saying the mark. It's the middle of the bid and the ask. So we are going to buy at the ask price because we want to get into the trade very quickly. So we're going to buy at $4.65 of premium. So we're buying the March 20th call as a 48 strike. We're paying $4.65 in premium, which is $465 total. So you can see the total cost is $465 right there. And we're going to hit calculate. So on the y-axis this time, we have stock prices. So right now, AMD is trading between 48.50 and 49. At the top, we have different dates. So here's January, February, March, April. So at what stock price and what date, what is your profit and loss going to be? So on the first day, if things bump up roughly 50 cents or so, you hover over that, we'll be at $49. The stock price will be $49, and we will have made 14 bucks. Pretty nice. You go up further. If today things really go up like crazy, go up to 54, you make $349, which would be awesome. So you can play around and kind of see like where do you think the stock price is going to be. You know, when you buy this call option, what's your profit loss going to be? But notice how, see this black line right in the middle? That's the current stock price. Notice how this red starts bleeding up into the upper half. So that if right here when you're making $14 today, if the stock price stays at 49 through January, through February, through March, all of a sudden you're going to be down $304. You're going to be down a lot of money. And that is because of that convergence, that premium decay. While your option right now is worth $465, as time passes, it's going to be worth less and less and less and less, so that if you sold it, you would be at a loss. So you're losing money, losing money, losing money. And that premium decays, all the way up until expiration day, where you're either in the money past your break even or below your break even. And you can see what your break even here is. It's $52.65, which is the current stock price plus the premium you paid. So if you look at our break even, you know it's in between these two stock prices. But remember that little region where I told you about where it's not, you're not at your max loss, but you haven't made profit yet? That's this whole area right here. You haven't hit your max loss until you hit that minus 100, which just means minus 100%. So that's that whole area there where you could exercise it, or you could just look at the intrinsic value, the value of the option. You could sell it for not a total loss, but for a significant, potentially significant loss. You won't really reach your max loss until you hit the strike of your option, which is $48. See how it's 48? We hit our max loss when we are at $48. We must be above that to have less of a loss, and we have to be past our break even to start making a profit on expiration day. But remember, at the very beginning, the very first day, your break even is right where you started. You buy in, you sell immediately. You would only lose whatever the difference between the bid ask is. But really, you're at your break even. But as time goes on and as that theta decay happens and that extrinsic value evaporates off, that process of convergence occurs, you are going to have to hope that the stock price starts moving up quickly. Now, we chose an option that's somewhat at the money. Let's choose one that's very in the money. So we chose a 48 strike one. Let's choose one that's all the way at $40. So it's much, much more expensive because it has more intrinsic value built into this premium. So we're going to go ahead and click on this guy. $990 is how much it would cost us. Hit calculate. Notice how the green doesn't leak up so much into this because so much of that premium is made up of intrinsic value and is not as much affected by theta decay. As we spoke about earlier, the options that have the highest amount of extrinsic value, which is the value that evaporates off, are going to be at the money. So if you go in the money, it's going to be significantly less, damaging. Theta is going to be a smaller percentage of the overall amount you paid for this option, so it's going to have a less significant effect on the option. So our break even is much lower, And our max loss is also going to be much lower because we're deep in the money. We hit our max loss when we hit our strike price. So in the money options are a lot less risky in that sense that their break even is much lower, but they're also much more expensive. So you have to keep that in mind. Are you willing to fork up that much cash? Look at the deltas. How much is the options premium changing based on $1 of the stock price move? Is your risk tolerance in line with that? You have to be thinking about this sort of thing. Now let's also play around with implied volatility, which you can do by hitting manual entry options. If we change implied volatility from 53 up to something crazy like 80, notice how the green starts dropping into the lower half. So if all of a sudden nothing else changes, but today implied volatility just spikes like crazy, which is good for call options and put options, you are going to make money even though the stock price hasn't changed. So right where a break even normally would be, we're up $173. The exact opposite would happen if implied volatility decreases. The red would start seeping up into the upper half. However, you have to keep in mind that your break-even stays the same. Everything on expiration day stays the same because remember, on expiration day, there's no extrinsic value left, which implied volatility affects. It's only intrinsic value that's left. Can you exercise it for a profit? Yes. No. Now let me tell you guys what a lot of people do when they first start trading options. They're going to choose an expiration that's very close to us. So a couple days out, they expire this week, and they're going to choose one that's way out of the money. So we'll do 50th strike, which is way out of the money, and they're going to buy a bunch of them. So they'll buy 25 of these. Just $475. It's pretty cheap. And if you look at it, if things bump up just a couple bucks, you've made $1,000. You've over doubled your money. However, they have to go quick. It has to move very fast. You only have a few days before all that extrinsic value, which these options are completely made of, evaporates. So it has to move very fast. And people do that all the time. And the problem is the stocks don't move that fast most of the time. So you can get lucky and you can make a bunch of money very quickly. But if you try this trading strategy, then it's not a strategy, you will lose money because you're always going to be trying to outrun the stock and you're not going to be able to do it. And not only that, people do this before earnings because they think, well, hey, if I want the stock price to move quickly, then I might as well do it around earnings calls where there's usually big stock movements, price movements in the stock price. However, leading up to earnings, implied volatility is increasing because there's an expected volatility in the stock because the earnings is going to cause a pretty significant movement in the stock price. So that's being priced into the options. People are paying more and more for them because they expect this large move in the stock price due to earnings. However, the day after earnings, implied volatility drops because that binary event has already occurred. It no longer is in the future. It's already happened. So implied volatility drops. In other words, people start paying way less for those options that they were paying for literally just a day ago. So let's go ahead and simulate that. We've bought all these out of the money options, so we're thinking, okay, the stock's going to move 10% on earnings. But then all of a sudden, implied volatility drops in half when we're down near, let's say, 16. Hit calculate. Now look at us. Look at that. The next day, it drops down. Even if the stock price goes up, we've lost money. And that's why options are so complicated sometimes. And that's why you don't want to do these stupid kind of things. If you want to be safer, learn about spreads, which you can find on my channel, but also buy in the money options. Even though they're more expensive, don't put all your portfolio in it if you can avoid it. But even though they're more expensive, they're going to have a lower break even. They're going to be less affected by theta, so time decay is not going to be as substantial. And overall, they're just going to have a higher probability of profit. All right, let's actually do a real trade here so you can see the whole process. Let's do SPY, which is the S&P 500 ETF. Talk about a bullish trend. So let's go ahead and look that one up. This ETF has insanely liquid options, so the bid ask is going to be pretty much always 1 cent wide, which is terrific. So we're going to buy it for a month out, roughly February 21st. And just because I don't have that much money free on this account, let's go ahead and tap on the 329 call and tap on its statistics. So we're looking at it. Bid ask is tight. It's 1 cent, which means we lose $1 getting it in and out immediately, which we're about to do. Volume is, of course, high. It's always high on this ETF. Delta is 48, so we make $48 if the stock goes up, 48 if it goes down, this ETF, I mean. So we're going to buy one contract, which is for 100 shares. You can see that underneath there. And the bid ask is 389 to 391. Let's go ahead and see. We can put it in for 390, which is the bid right now, and hope that the price of the option drops down so that 390 becomes the ask, which it just did. So let's go ahead and enter it. 390 is the premium we're paying, which is the ask, so we're going to get it filled immediately. The max cost is $390. Hit review, swipe it up.
I've told you,
order received. We'll wait a second and see if it gets filled. And it got filled. Look at that. So if we go back to our home menu, you can see this option is going to pop up here, hopefully in a second. There it is. All right, a SPY call has popped up. We have not made money. We have not lost money yet. It's just at $0 as a total return. And you can see what the last price was. It's $3.90.
Go ahead.
How much
give
money
it a
I put
shot.
into it?
Prove me
$3.88.
wrong.
Now go to
Prove me
total
wrong.
return. We're down $2 already. So let's say, you know what? I'm having a change of heart. Let's go ahead and sell. And we want out as fast as possible. Well, we can tap on that call, hit trade, hit sell. And we're going to sell one of them, and we have to sell near the bid price, or we have to hope that it pops up. The price pops up a little bit, so it's dropping a little bit. So let's go ahead and sell it. So I'm not spending too much money on this example. So let's do 384. I think that's fine. We'll send it off. So that's not super near the bid, but it's not exactly the bid, but it was close enough to the bid that someone either met me there or the price changed enough so that it became the bid price. So there you go. We went in and we went out, and I think we're down like $6. You know, whatever is worth it for this example. So that's what you're going to do when you buy options. That's kind of what it feels like to buy and sell options. And that's basically it. You take a look on Options Profit Calculator, take a look where you think the stock price would be, if it goes up or if it goes down. Are you comfortable with your risk and you think you'll make a good enough profit? Then great, go for it. Go on Robinhood, select the call, buy near the ask or at the mid or above. Or if you want the stock price to move down to you a little bit, you can enter a price that's a lot lower than the bid-ask spread and hope that spread moves down over time and that you get filled. But because options provide you with so much leverage, I definitely want you to check out my videos on vertical spreads, which I will put in the description below as well. Leverage isn't always a good thing because you can lever yourself straight into the center of the earth. At this point, I'm hoping that you have your brain wrapped around calls for the most part. And if you, at this point, have any questions about calls, you should ask me in the comments below. We're going to go on to puts really quick. Not a whole lot is different. The only difference is you're betting on the stock going down as compared to going up, really. There's a few other tweaks. But once you have calls down and you have it down pat, then puts are just going to come like a breeze. So here we are looking at a list of puts on AMD. Notice I have buy puts selected. And once you buy a put or a call, you can sell by choosing sell, call, or put and selecting the put that you bought. But it's easier just to do it from your home menu. It's also possible to sell puts and calls when you don't even already own them. And that's creating a contract. You're creating a contract and selling it to somebody. That's a whole nother deal, and you have to have quite a bit of money in your account to do that. But it is part of doing spreads where you actually don't need that much money in your account. So check out those videos that I have. They'll make you a better trader and you'll make more money if you learn them. So we have buy put selected. We're looking at 4 puts here. 1, 2, 3, 4. Notice the similarities. They do have strike prices, 50, 49, 48, 47. The only difference is, if you remember, calls give you the right but not the obligation to buy 100 shares at the strike price. The only difference is with puts, let me write that out actually. So this is for calls, they give you the right to buy 100 shares at the strike price. But for puts, this gives you the right to sell 100 shares at the strike price. Now you can own these shares already, or you may not own those shares already. So let's take a look at a put here. So we are going to take a look at this 50 strike put. And remember, the current share price is down here at 48.42. So if we can sell 100 shares for $50 each, and then we could buy those, so we'd be selling short. If you do not have the shares already, you would borrow those 100 shares automatically from your broker, and you would sell them and then hope to buy them back at a cheaper price. So if you exercise this put option, you would sell 100 shares at the strike price. And if you don't own them, you're borrowing those shares from your broker, which is called selling short. But if you already own the shares, it's the same deal. Those shares just disappear from your account. So you are now, let's say you don't have them, you're short 100 shares for $50 each, and you can buy back those 100 shares immediately at 48.42.
All they've done is make your life.
Since you sold at a higher price, so you received a lot of money, and then you bought back for less than you received, you're going to keep some of that money. So that's a good thing. And the money you're going to keep is going to be the difference between these two times 100, which is what? $1.58. Remember, that's in premiums terms, so you actually make $158. So in that sense, these, it's a little different than before. These ones are in the money. This is still at the money. These guys are out of the money.
I called you from the new phone. What do you
So it's just
understand?
flipped. When
I called you from the
you're
new
in the
phone.
money, you hope the stock price is
What are you missing?
going down. It's below your current strike price. You're out of the money, the stock price goes up.
Well, the
So it's
system
just
probably has
flipped.
to
You're betting on
update
the
it.
stock price going
The
down.
system has to update
You'll
it
still see if you
overnight.
look at the
I don't know
options
how I have to
Greeks
call
that
them.
theta,
This doesn't seem
theta
to
will
be
be
able to come
negative.
from the internet.
You'll see
Okay?
that
There's no
delta
switching of any
will be
phone
negative.
numbers.
Remember,
It's already
for
done.
calls, theta is
I
also
called you
negative.
from
For
the new
calls,
phone.
delta is
So
not
I-
negative.
so
It's
why are
positively
you making
correlated
things up?
because when with a call, you're betting on the stock going up, So as the stock goes up, the premium increases. So that's a positive correlation.
Right.
With puts, when the stock goes up, your premium decreases. So it's a negative correlation, and vice versa.
Switching phone numbers.
Besides really those two factors, calls and puts operate very much in the same way. It's just betting on the opposite direction. And one other small difference that's worth noting is that their break even is below their strike price, because you're betting on the stock price going down. So instead of your break even being strike plus your call premium, it's going to be strike minus your put premium.
When I click switch phone numbers,
because if you think about it, when you exercise, you're giving up that premium that you paid, and you better hope the stock price has gone down enough to make up for that loss of your premium that you paid when you exercise. So with puts, just think of it. It's the same as calls. Only difference is you're betting on the stock going down. Thank you for coming along on the ride with me. You definitely, if you made it this far, God bless you. You are a soldier. Check it out, dude.
Right. So as I said,
we've made it like through this candle is brand new.
I'll have to call them. Correct. I'll let you know what they say, and they're gonna hear a freaking earful from me. I'm going to offend them. All right.
So good on you. I'm proud of you. I love you. Catch you guys later.
You're in the right place if you came to learn about how to profit with options tonight. So that's what this webinar is all about here. So how to profit with options, and I'm really just going to be breaking down how this whole thing works with options, at least as best as I can during the next 45 minutes. All right. So let's get into the information. So here's what's on the agenda for tonight. I want you to walk away from this learning why option traders have a unique advantage over other stock traders. I also want you to understand and discover why trading stocks is more risky than trading options. So you may have heard that, I heard trading options is risky. I'm going to share with you tonight why it's actually the reverse, why only knowing how to trade stocks is more risky than trading options. And that's what you're going to take away from this training tonight. You're also going to uncover the secrets to growing a small account with as little as $500 using options. And maybe I shouldn't have put the word $500 in there, because the example I'm going to show you it's with like $3,000. But you can basically take that example down to 500 and say, if I had $500, what could I do with the same example? Does that make sense? So so that's what I'm going to share with you tonight. And if you got questions, hold them to the end, because I'm going to take some questions at the end, and I'm going to also give you an opportunity to partner with me and get some additional training if you choose to. So let's dive into it. And also this is one of my favorite parts. We're gonna cover how you can control expensive stocks like Amazon, Google, Tesla for a fraction of the cost, because most people don't trade the best stocks out there because they don't think they can afford them. But I'm going to show you how with options you can afford some of the very best stocks out there on the market. All right. Now, who is this webinar not for? So this is not for you if you're already a sophisticated investor. This is not for you if you already know how to make money in any market condition, which means you know how to profit no matter whether the market's up, down, sideways, or upside down. You already know how to make money. Then no problem. Go ahead and log off and get 45 minutes of your night back. If you completely understand how options work already, then this webinar is probably not for you. And if you are not open to additional coaching or training, then this webinar is not for you, because at the end I'm going to offer you an opportunity to get some additional coaching or training. If that's not something that's for you, this webinar is probably not for you. All right, so let's keep it moving. So let's go back. Why am I sharing this information with you? So if you don't know me already, I'm assuming some of you guys know me, but maybe you found me through YouTube, or Facebook. But if you don't know me, I've been trading for over 10 years. I've been trading since 2003. So I've been trading over 10 years. I grew a small account to a six-figure trading account with no formal education. And, you know, since then, I've made a lot of money, lost a lot of money, made it back, lost it. And people would always ask, what am I trading? What am I teaching? And so I started blogging about what I'm trading, and I started a website, and then people started following me on YouTube and started doing tutorials, and then I wrote a couple courses, right? So that's me in a nutshell. But why am I sharing this information? I truly believe with everything in me that if more people knew how money works, if they knew how the stock market worked, we would be in a better place as a society, right? I mean, just think about it. If you had an opportunity to provide for your family, buy a car, move into a better neighborhood, give more at your church, give more to the charities that mean the most to you, then we would probably have less people robbing, stealing, killing, less people having abortions. I know you're like, well, you know, whoa, he's getting deep on this webinar, but that's why I like to share this information, is because, you know, I was in the seats that you're in. I wish somebody would share it with me. I was on the outside looking in, wondering how does this whole thing work? How do people make money off the stock market? What are options? I didn't even know there was an option component to the stock market. And so now that I've been blessed with this knowledge, and it's not like it fell out of the sky as a blessing. I mean, I went and learned and studied and followed traders. And so now I'm in a position where I can teach it. And so that's why I'm sharing this information. So please take the next 45 minutes seriously, because I took it seriously preparing this information for you. And someone said that's noble of you to share the information. Hey, somebody's got to do it, or at least we all should be doing it, and we'd be in a better place, right? So let's dive into it. Why do option traders have a unique advantage over stock traders? So I want you guys to type in the chat box. What do you think? Why do you think option traders have a unique advantage over stock traders? So you're going to help me out with this webinar. I'm not just going to be talking at you. I want you to interact with me. So why do you think option traders have an advantage over stock traders? Just type it into the chat box. What do you guys think? And if you don't know, that's okay, but take your best guess, right? Roop says small equity. Dave says buying power with less risk. Actually, you're right on the money. Ethan says you can make money in an up, down, or sideways market. You've probably been following my stuff, but that's right, Ethan. Marcus says more leverage. Jason Shepard says less total risk. Alex says profit 100-fold per contract. Yep. Gabby says make money if the market goes up, down, or sideways. Where in stocks you only make money where the stock goes up. Wow. All right. So you guys are kind of already into my presentation. And this is make money in up, down. Keeps us more control. All right. So perfect. And so you guys, some of you already know, but first let's discuss how do stock traders make money. So if you don't know how stock traders make money, I'm going to break that down for you right now. So stock traders basically buy low and sell high. That's exactly what they do. So you can see here, if you're a stock trader, the only thing you know how to do is hopefully you buy something at $10 and you can sell it for $50 someday down the road, right? But that just means you only know how to make money if the stock market goes up, right? What's the problem with that? Well, most stock traders' mindset is they're going to ride every trade to the moon, right? That's how stock traders look at every trade. They look at it like it's green. They only see green, like this trade's going to the moon. This is the one trade that's going to take care of my family for the rest of my life. This one trade, that's how they think. One trade or every trade is going to the moon. But what is the reality? There's the stock trader's reality, right? They end up holding those stocks, riding them right into the ground, because we all know stocks do not always go up, right? And what goes up at some point usually ends up coming down, and most people just end up riding their stocks all the way down into the ground. So that's the real reality of the stock market if you only know how to buy stocks. Because we all know stocks can move in three ways. Some of you have already alluded to it, right? Stocks can move up. That's no surprise to anybody, right? Stocks can move sideways. Well, what do I mean by a stock can move sideways? If you buy a stock, for example, at $10, it moves all the way up to $100, then it falls to $50, then it falls to $40, $30, and it falls to $10 5 years later. That stock essentially just moved sideways because you bought it at $10 in 2005, and in 2010 it's back at $10. So you didn't make any money, it just moved sideways. So you basically wasted time. And then we all know that stocks can move down, right? So here's the question I would ask everyone that can hear my voice. If we know that stocks can move sideways and we know that stocks can move down, and we just covered that stock traders only make money pretty much one way, and that's if the stock goes up, wouldn't it make sense to ask yourself, well, wait a minute, if stocks move up, down, and sideways, and I only know how to make money one way, that's a 1 in 3 chance of making money. Let me ask you, are the odds in your favor or are they against you? You don't have to be a rocket scientist to know that if you only know how to make money 1 out of 3 possible ways, the odds are not against you. I mean, the odds are not in your favor. The odds are against you. Now, you might say, I could short some stock, right? And that's this slide right here. You know, shorting stock has unlimited risk. So if you're not familiar with what shorting stock is you saying, I'm going to sell something to someone that I don't have, and I'm going to hope I can buy it back at a lower price. So if I told you, hey, you can come buy my Apple stock today at 100. I don't own Apple stock, but I tell you, you can buy it from me at 100. Well, we enter that trade and you enter it short. You're short because you don't have the stock. You're hoping Apple falls down to something below 100 so that you can buy it. So if it falls down to 90, then you would actually buy the stock in case I come knocking on your door for it. I already agreed to buy it to you at 100. You bought it at 90. You'd give it to me. Well, what's the reverse can happen? Well, what if Apple never falls from 100? What if Apple comes out with a new phone and it goes to 120, 150? What if the iWatch is a big hit and it goes to 200? You have to still go buy that stock at 200 and give it to me at 100 because you agreed that I could buy it from you at 100, whether you owned it or not. So that's where the unlimited risk comes in with shorting stock. You're selling somebody something you don't own. That's not smart. That's unlimited risk. So again, I'm trying to prove the point that essentially stock traders can only make money one way, and that's if the stock goes up, buying low, selling high. So I asked, why do option traders have a unique advantage over stock traders? The answer is very simple. Option traders have way more tools to build their house with than a stock trader. Stock trader has one tool: buy low, sell high. Option traders, they can make money in a sideways and a down market, right? So what are the 2 tools, or what are the more tools? The more tools are simply 2 types of options called calls and puts. There's only 2 options that make up the options market, a call and a put. But man, when I tell you, when you can mix these things together, you probably can get 20 different combinations. So what do I mean? You could buy a call and buy a put. You can sell a call, you can sell a put, you can buy just a call, buy just a put. You can buy a call and then sell a call on top of it, and buy a put and sell a put on the bottom of it. That's called an iron condor or something. Like, there's so many different combinations that stem from just these 2 options right here, calls and puts. And I want to kind of give you a little insight into both of those tonight. So if you're taking notes, that's one to jot down, right? I need to understand what are calls, what are puts. So let's talk about what are calls. So calls are used for bullish strategies. So call is something that you can buy and control the stock for a certain amount of time for a certain price. So if you're buying a call, you're assuming the stock is going up. That's a bullish strategy, right? On the other end, there's what's something called a put, which is a bearish strategy. So if you're buying a put, you're basically saying, I believe the stock is going lower, and that's where a put starts to make money. And you'll see how later on in this webinar, puts can be used for a few other cool things that most people don't even know about. But the two types are call and put. Calls is a bearish strategy. Calls is a bullish strategy. Puts are a bearish strategy. Now, there is, once you get even more sophisticated, you can flip both of these around and kind of do some weird stuff with it to change the meaning of the strategies. But on the surface, if you're buying a call option, you're bullish. If you're buying a put option, you're bearish. You believe the stock is going to go down. All right. Now, once you understand these two, you have everything that you need, in my opinion, to build financial freedom for yourself. If you're just buying stocks, you do not have everything you need to build financial freedom, because we just discussed you have a 1 in 3 chance of making money. Well, what about the other 2/3 of the time, right? So, which those 2/3 of the time happen more often than you think. Now, have you heard that options are risky? You know, I see people say it all the time, or I see other traders who don't understand options because they don't understand it and don't know how to teach it. They say stuff like, well, why would you do that? Options are risky. Trade penny stocks, or, trade the Forex, or I don't know, all this stuff, binary, do all these different things. But normally that just means they don't understand how options work, because if they truly understood how options work, and I'm willing to have a debate with any other trader, that buying stock is always the risky position and not buying options, right? So trading stock has more risk than options. And don't take my word for it. I am going to prove it to you on this webinar, because my goal is to educate you. So whether you get continued training after this or not, you will at least be able to have an intelligent conversation with someone about why options are less risky and why stock is actually more risky than options. So let's dive into my first example here. So I'm trying to keep it really simple. So we're going to use just a made-up stock. It's called stock XYZ. Later on, we'll bring in some real stock and option examples in this webinar. But let's just say you're looking at stock XYZ and it's trading at $100. You could buy 100 shares of the stock, and that cost to you would be $10,000, right? 100 shares times $100 be $10,000 for you to buy 100 shares of that stock. Now, you don't have to answer this, but how many of you have $10,000 sitting around to get started trading? I'm gonna tell you, I didn't have $10,000 when I first got started. I got started with $500 in the stock market, and that's why 500 has always been my magic number. Now let's look at the other end of this. So you can buy the stock, 100 shares, $100, 10,000, or you can buy one $100 strike price option, right? So you might be thinking, what's a strike price? Don't worry, I'm going to cover some of that, or as much as I can, in this webinar. But you can buy one contract, which is a $100 strike price. So what that means is someone has agreed to sell you the stock at $100. So a strike is like that agreed upon price. So you bought a $100 strike, that's the agreed upon price, one option. An option controls 100 shares, okay? And then there's a time frame to the option. So in this example, I'm just using 30 days. And then I made up the price of this option. I just called it $5, right? Because you may be thinking, well, where do you get $5 from? Don't worry, I'm going to show you a real option chain. I'm going to show you some real option prices, okay? If you bought one option contract, the cost to you would be one contract controls 100 shares, so 1 times 100 times $5. So simple math, simple question. You can type this in the box. Would you rather control XYZ stock for $10,000, or would you rather control 100 shares for $500 for 30 days, assuming you know the stock is going to move within 30 days? You tell me, which one would you pick? Type it in the box. Ethan said, nope. I don't know if that's a nope. You don't want to spend the $10,000. Bob says the 500. Rupert says, I'll go with the option. Anthony, I'll go with the option. Dwayne says options. Alex says option. Sandra, $500, of course. Keisha says the option. Cynthia 500. C. Right. So everybody's saying the option. Laura, Jason, Wendell, Marvin, Nadine. All said the option. Marion says, or Marlon, I'm sorry, options every day, all day, right? So it just makes sense. But as we walk through the webinar, it's going to make even more sense, right? Because I want to show you the different potential that you have with options that you don't have with the stock. So let's keep going. Now, so earlier I told you, I'm going to share with you why a stock is more risky than an option. So let's say, same example, you bought 100 shares at $100, $10,000. On the right side, you bought one contract times 100 shares, $5, so that's 500. What if XYZ stock tomorrow falls $40 overnight? Well, on the left-hand side, you're going to be down $4,000, right? Because if it fell $40, you got 100 shares. You just lost 40 times 100 shares. That's $4,000. On the right side, if that option expires worthless in 30 days, how much did you lose? You lost $500. Just with this example alone, I will pose this question. Now, which one is more risky? Options or buying stock? Just off the sheer numbers alone, you can see that stock is more risky because you don't have a defined amount. Well, I mean, I guess if it goes to zero, that's your defined amount. But with options, we can never lose more than the amount of money we paid for the option. In this case, we bought an option for 500. That is the absolute maximum that we can lose. I don't know about you, but I feel good going into a trade knowing I've already determined how much I'm willing to lose, which is how much I paid for the option. I already have talked to myself and agreed that 500 is the most that I'm willing to lose. On the left side with the stock, it's unlimited, right? I mean, the stock could go to zero. Have you ever seen a stock go to zero? I can tell you a few. Kmart, Enron, right? Some of these stocks have went to zero. The company went out of business, right? And your shares went to zero. Well, on this side, your option, if it goes to zero, the most you'll lose is 500 in this example. Now, when I ask you, do stocks fall $40 overnight? If you don't believe me, I'll show you some examples. But options can also be used as protection, as income protection, which I'll show you in a second. Because if you're in a trade and you're making money, one of the worst things that you can do, and I see this happen all the time when it comes to earnings season, most people will hold a trade all the way up to earnings, and then the company may come out, announce bad earnings or something like that, and then everything that you've built up over the last 2-3 months, 6 months, the stock's down $40. We're going to show you how you can protect that income with options. So the way that you can protect it is by using put options. So put options gives you the right to put the stock to someone else at a specific price. It actually allows you to profit from the fall of a stock. Now, you couldn't do that when you were just buying the stock itself. If the stock fell, you just were out of the money that it fell. But with put options, it gives you the right to put it to someone else. So let me give you just a hypothetical example. If stock XYZ we just talked about was trading at 100, if I bought a $90 put, if that stock fell down to $50, because I had a $90 put, I have the right to put that stock to someone else at $90, even though it's trading at $50 now, because I bought a contract that says you agree to allow me to put this stock to you at a certain price for a certain amount of time. So on the flip, it allows you to protect your portfolio as well. So let me give you an example of how this works. So we still got the same XYZ stock trading at $100. You got 100 shares still, but this time the stock falls $40. On the right hand side, you own a $90 strike put contract at $3. So the cost for one contract times 100 shares is times $3 is $300, and we're going to assume that's a 30-day contract, right? On the left hand side, your account, if it falls, your account is down $1,000 here. Let me take a moment, slow down, make sure I'm explaining this right. If you have 100 shares at $100, okay, So you own 100 shares at $100. Once you buy a $90 strike price put, yes, that put costs you $300. If the stock falls $40, you will only lose $1,000 because your put kicks in at the $90 mark. So even though the stock fell $40 from 100 to 60, that put kicked in at 90. So all you really lost was the difference between 100 and 90. So that's $10. And that $10 times 100 shares is why it says your account is only down $1,000. I want to make sure you guys are following me on that. So type in the box. Does that make sense? If not, I'll explain it again. Marcus says it makes sense. Gabby says, yes, it's like insurance. Then it's absolutely like insurance, Gabby, which is what I talk about in my course. Wendell says it makes sense. Alex says it makes sense. Alex says, please explain it again. All right, so let me explain it again. Sheila wants to hear it again. Okay, C says, sorry, it didn't make sense. All right, so for all of you who said you didn't really understand it, I want you to think about it. Think about it like this. You bought the stock at $100 a share. You bought 100 shares at $100, right? If the stock falls $40, so let me clear some of this off the screen. Let me just go back a little bit. Think about this. If the stock falls $40, okay, how much is the stock trading for if it falls $40? If it's trading at 100, it falls $40. So you guys type in the box, how much is it trading for if it falls $40? 60, right? Marcus types 60, Laura types 60, Sheila types 60. All right, so that's simple math. You own it at 100. The stock falls $40. Now it's trading at 60. Okay, so if it's trading at 60 and you paid 100 for it, you lost $40. You own 100 shares, you just lost $4,000. Okay, now if you bought the $90 strike price put, what happens is the stock still fell down to $60, but you have the right to go to someone else and make them buy it from you at $90 because you have a $90 put. So if a stock is trading at 60 and you have the right to sell it to them for 90, that's a $30 price difference in there. So the stock fell $40. You can make 30 of it back because you can force somebody to buy it from you at 90 even though it's trading at 60. So you really only lost the $10, right? Because it fell 40, but you can make 30 of it back by forcing someone to buy it from you at 90 because you own that call option. So that's how your account is only down $1,000 because you made 3,000 of it back, which is $30 times 100 shares. So I hope that makes sense. I have to move on, but I hope that makes sense. I got a lot more examples to go through. You'll probably catch it on the next one if you didn't, but let's just pause real quick. Did that make sense? Keisha says, so they have to buy it from you at 90. Yes, because you bought a put option, which means someone sold you the right to put it to them at 90. So when they sold you a put option and you bought it, they entered a contract with you. And that contract says, hey, I have the right for a certain amount of time to put, that's why it's called a put, to put this stock to you at $90. Now, let me spend a couple extra minutes here. You may be thinking, why would someone sell me the right to put the stock to them at 90? Because the stock market has two types of people. One person thinks the stock is going up. One person thinks the stock is going down. So the person who thinks it's going up is saying, this stock isn't going to fall. This stock isn't going to fall. It's going to go up. So I'm going to sell them this contract and they're going to keep that $300. See, that costs $300. But who gets that $300? The person who sold it to you. So that person's thinking, I'll make a quick $300 because the stock isn't falling. You might be saying, I'm willing to spend $300 to protect my $10,000 investment. And then we let nature take its course. The next day, the stock fell $40. Somebody else asked, why didn't they just set a stop loss? Well, let me ask you this. How can you set a stop loss if the market is closed and the next day it just opens down $40. How can you set a stop loss if the market opens up the next day down $40? There's nothing you can do about that, right? So let's move on. Some people got it, some people didn't, and that's why it takes way more than a quick webinar to explain options. But I'm giving you a taste of the power of what options can do here. So let me show you an example. So someone said, why didn't they just set a stop? Well, follow me on this. Look at Baidu. Anybody ever heard of this company? A little company called Baidu. You can see on July 27th, Baidu closed at 197.58. Where did Baidu open the next day? Look at the second arrow. Baidu opened at 172 and it went as low as 162 on July 28th, the next day. All right. You can see that alone was over a $35 drop overnight, right? Maybe they had bad earnings. So you woke up the next day, that stock is down $35. There's nothing a stop loss can do to protect you from that, because the next day the stock is just down $35. But if you knew earnings was going to be released after the bell, the smart people, the smart traders like myself, I never hold stocks over earnings, but if I do, I'm going to buy some protection, because you could wake up the next day and the stock is down $35 and there's nothing you can do about it. Let's look at another example. Look at a little company called LinkedIn. Anybody familiar with them? LinkedIn on April 30th, 2015. Look at it. It closed at $252.13. LinkedIn opened the next day, which was the first day of the next month, May 31st. It opened at $206.86 and traded as low as $198.40, right? That's over a 50-point drop overnight. You think some people were sick about it the next day? That's an amateur. Think about if you had $10,000 tied up in LinkedIn and you said, oh, I'm just going to hold it over earnings. I know it's a great company. And then they have poor earnings. And then the next day you wake up, it's down $50. That is what the power of a put option can do. It can protect what profits you have. It can protect your portfolio from waking up and foolish things like this happening. And these happen every day. I shouldn't say every day, but it happens when there's a lawsuit. It happens when there's earnings coming out. It happens when, a new product is coming out and it's not as big of a hit as they thought. It happens if you wake up and find out the CEO's been stealing from the company and all of a sudden they've been cooking the books. So this stuff really happens. I'm just letting you know how you can protect yourself from it and protect your portfolio, especially around earnings season. But this is the stuff that other professionals don't tell you. This is the stuff that other people don't share with you. So Ethan said, what happens if the stock goes up and you have that put? Well, you paid $300 for that put in that one example. You basically lose your $300. I want you to think of it as insurance, right? So I talk about this in my course, but think about it like this. Think about options as insurance. You pay insurance every single month, but what happens if you don't get in an accident? Do they come give you a refund for your insurance? Absolutely not, right? But you had that protection in case you totaled your car. This is protection in case you total your portfolio. So I want you to think about it like that. All options are contracts that people use every day. They use option contracts in real estate. They use option contracts in insurance. Insurance company doesn't call you up and say, hey, I want to enter into an option contract with you. No, they say, we're willing to take on X amount of risk based on your driving record and based on your age and based on where you live. And for that, we want to be compensated X amount of dollars every month. And if you get in an accident, we will pay you. But based on your driving record, this, that, and the third, we don't think you're going to get in an accident, so we're willing to insure you. Same thing. Based on the stock chart, you should be telling yourself, do I need insurance or not? Do I need some put options? Based on if earnings is coming up around the corner, you should be asking yourself, do I need insurance, right? If I don't get in an accident and LinkedIn goes to the moon, I just spent $300, but I'd rather spend the $300 to protect $10,000. Same thing if you're driving a Cadillac or some nice car. You would rather spend the $175 with your insurance company than to get out here and crash the car tomorrow. And now you got to figure out how you're going to pay for a $40,000, $50,000, $60,000 car. So people pay for insurance for their cars, but why aren't you protecting your portfolio? Chances are you probably never knew about this stuff before tonight, right? Well, let's keep going. So let's talk about some of the secrets to, well, let me take a pause. Is this good stuff? Let me know. Is this helping, guys? Let me know. Type in the box. I want to make sure this is valuable and good information to you. Alex says yes. Gabby says yes. Dave says yes, sir. Jason, good stuff. Sheila says yes. Dwayne, Anthony, Marvin, good. Very valuable. Ethan says. Marcus says develop a new strategy. Oh yes. Caesar says it's making sense. SE, it says your name is, as someone new to this, yes, this is helpful. Awesome, guys. So that's always my goal, to provide some value and make it make sense. Let's talk about the secrets to growing a small account. All right, so there's 2 secrets to growing a small stock trading account. Number one, both of the secrets are using options, by the way, but there's 2 ways to use options. You can buy contracts in volume, meaning a high number of contracts. High for me is 5 to 10. And you're buying 5 to 10 contracts of low price stocks that move at least 50 cents to $1 within a 30-day time period. And I'll show you why that's important. The other way, use options to power up a small account. You can buy smaller contracts of high price stocks that are fast moving. I'm going to show you 2 examples of each. So hang with me here. So I'm going to walk you through what I mean in both situations. Okay. So here's this chart of a stock called SNV. What I call a low price stock is any stock that's under about $50. Sometimes I try to keep it under 30, but definitely under 50. That's a low price stock to me. Now, I want you to look at this stock chart, because if you took my foundations course, this is where the foundation starts to come into play. You have to be able to read a stock chart and determine where the stock is going before you can pick the right option. So I want you to look at this. If you can see this, like this big sell-off happen, and then you can see mid-August, right, which is not too long ago, about a month ago, because we're mid-September at the time of this webinar. So mid-August, you can see here, it had a big sell-off. But since from mid-August, it went from about $27 up to $30. You can see that on the chart, right? So that's about a $3 move. So I want to talk to you about what a $3 move could mean for you. And if you look back even further than that, you can see the stock's been in the uptrend. So you can see it's been moving at least a good $3, it looks like, every 30 days or so. Now, let's look at an option chain and talk about what option you should pick and what that can mean for you. So if you look at an option chain, you have the ability to control, you can see 122 days to expiration. I can buy an option to control this stock for 122 days, okay? 122 days, that's what, like 4 months or something? 4 months I can control this stock. If you look at the example I pulled up, I'm looking at the $25 call option. So that's what we call an in the money option, because the stock is trading at $30.82 right now. But I'm going to go in the money and buy a $25 call option. So for that, you can look over here at the price. Let me ask you guys this. How much do you think you should pay for that option? Because I did this earlier and I bet everyone gets it wrong. How much do you think that option should cost to buy the $25 strike price call option to control this stock for 122 days all the way out to January 2016? How much should that cost? Just take a stab at it. How much would you pay per contract? Alex said 450. Well, per contract, how much would that cost per contract? Rupa says 250. Marcus says 530. Okay. Marcus, you're close. You're close. Sheila says, don't know. Rupa says it's $2,500. Jamil says $5. All right. So let me break down how this works, guys. On the left, you see something called a bid and an ask. So bid means someone's willing to pay $5.30 per contract. On the right, someone's saying, hey, I want $6.40 to sell it to you. So that's what creates a market. Someone says, I'm willing to pay $5.30. Someone says, well, I'm willing to sell it at $6.40. And then at the very far left, you see something called last. That is the last price it sold for, which is $4.50, right? So you got what someone's bidding, what someone's asking, and then what the last person paid for it. But here's what the smart traders do. Smart traders look at the intrinsic value plus the time value. If you actually add those two together, you should actually be able to buy this for $5.85 because it has $5.82 of true value and you're paying 3 cents for time value. Now, that might not make sense to you right now because you're just learning options, but it's made up of two components, the true value and then how much am I paying for time. And so when you put those two components together, you actually should be going in and offering $5.85. But if you don't know that, you'll go into the market and you'll pay $6.40 for it and you'll overpay for this option. And if I'm a market maker, I'll take that trade all day because you just didn't know how to price out an option correctly. So there's a lot of little tricks and different things like that to understand that what's the right price to offer for an option. But again, if nobody shares this with you, you don't know, right? So let's move on with the example. So the stock is trading at $30.82. We just saw that from the chart. Let's just say you bought 97 shares. And the reason I picked 97, I'm going to assume you got $3,000 to work with here. So let's say you bought 97 shares. Cost of 97 shares at $30.82 is $2,989.54. Okay. Now, on the right side, the call option. So let's say you bought 5 January 2016. $25 strike price. That's the price we were looking at. Option contracts for $5.85. So I just showed you how I came up with that $5.85 number. The cost of that would be 5 contracts times 100 shares because a contract controls 100 shares times $5.85. It's going to cost you $2,790. So they're kind of close, right? You're spending a little under $3,000 for both of these trades. But let me show you where it makes a difference being an option trader. So assuming, this is all assuming you only have $3,000 to invest. For some of you, that's your tax return, right? You can get $3,000 from your tax return, which is coming up in 4 or 5 months here. So assuming you got $3,000 to invest. Now let's look at what happens if the stock moves up. So if the stock moves up $3, on the left-hand side, your profit would be $3 times 97 shares, because that's how many shares you own. So you would make $291. Woohoo! Congratulations, right? But look at the right side. If the stock moves up $3, because we bought a deep in the money option, that option is going to gain in value dollar for dollar as the stock would. So if the stock moved up $3, we have 5 contracts. So $3 times 5 contracts times 100 shares, because the contract controls 100 shares, we make $1,500 on the option side. And how long do we have for it to move $3? We got 4 months, because remember, let me back up. Let me back this up a little bit. Remember, we're looking at the 122-day expiration options, okay? If you're wondering where I'm looking, just there's this look up the yellows, yellow, look to the top where it turns gray, says to the left where it starts to turn gray, 122 days to expiration, okay? So I have 4 months for it to move $3 for me to make $1,500. Okay, let me go back to the example. All right, so let me ask you this. Would you rather spend $3,000 and try to make $291? Or would you rather put $3,000 at risk to make almost a 50% return? On the left side, we're talking about a 10% return, 291. On the right side, we're talking about a 50% return. Which one would you rather have? Type it in the box. You tell me. If anyone says I'd rather have the left side, log off now. No, I'm joking. I'm joking. But the point is, I don't know why would you not want the right side of the equation? Let me see. I got a couple questions coming. Dwight says, can you sell the option before 120 days? Yes, you can. You do not have to wait for 122 days. You just have control for 122 days. So you needed to do something within 122 days. But if it doesn't in 30 days, you can sell the option and get out in 30 days. So absolutely, you can exit that trade. Rupa Patel says, wow. Yeah, exactly. Blew my mind too when someone really showed me how this thing works. Sheila says the right side. Dave says, do you normally buy that much in the money? Good question, Dave. I do talk about this in the course, but I do go deep in the money on stocks under $50 because they don't move that much. So when it does move, I want to catch the bulk of that move in my option. So if the stock is a $30 stock like this, it may take a month to move $1. It may take 2 months to move $3. When it moves $3, I need to make sure my option is going to move $3, $4. So yes, I would go deep in the money. Now, if I'm talking about a Netflix or something like that, I might go out of the money because that stock can move $30, $40 in a month, and it'll kind of like swallow up my option being out of the money, and it'll put it in the money. But that's a whole nother topic. But hopefully that answered your question. Dwayne said, Dwayne, I would take the right side any day. Absolutely. C said that makes sense now. Good. 1500. Good to know you don't have to wait 3 months. Options every day, all day. Dave says makes sense. Rupa says, do options on commodity or currencies or indexes? You can do options on almost anything. I just trade options on stocks. That I don't really get into commodities and forex. Somebody else may, but that's just not my thing. But if it has if it has options, go for it. Cool. Wendell says makes sense. All right, so let's keep it moving. I hope you guys are getting a lot of value out of this, right? So let me walk you through one more stock chart, one of Tesla, right? So we did a low price stock. Let me do a little bit of a higher price stock like Tesla. Okay, so Tesla makes the electric cars. So these guys are trading at $253 here and 57 cents. You can see based on the chart. But if you look at where Tesla had its big fall in August, Tesla fell down to $200, and then in a month, okay, mid-August to mid-September, it's ran up $50. $50. So I'm going to show you how this would work on a more expensive stock like Tesla. So let's look at the option chain for Tesla. I would still look at a potential in the money option, a $235 option, but notice on Tesla, I can only control this one for 31 days. So stocks that move big and quickly, they get more expensive if you try to control this for 6 months or 122 days. This would get really expensive. So because these move faster, you only need to control them for a shorter period of time, or else these get really expensive. So in this example, you can see the bid was $23.80 and the ask was $24.55, and the last price sold was $24.05. You can see how I got it broken down by how much you're paying for time value and how much you're paying for true value. That's important for you to know and be able to read that. Now, let's do the Tesla example, very similar to the last example we just did. All right, so you buy 100 shares of Tesla stock. First of all, 100 shares of this stock, now that it's a big boy, is $253 times 57 cents. That's going to cost you $25,000 just to mess with a stock like Tesla. This is what keeps most people from playing with the big boy stocks, and the stocks that really could change your life. Most people don't even trade them because it's out of their reach. That's because they don't understand options. Now, let's look at the October 2015 strike, which is the chain we were just looking at, the option chain. That contract is going for $24.55, okay? So the cost of one contract to control 100 shares is now $2,455. That's a big difference, isn't it? Big difference. Do you have $25,000 to trade Tesla? No, but I bet most of you do have $2,455. Now let me walk you through the example. That's a $22,902 difference versus the person who only knows how to buy stock compared to the person who knows how to trade options, okay? Remember the chart of Tesla. It went from $200 to $250. That's a $50 move within 30 days, okay? Now, let's walk through it. The stock rose $50. Over on the left-hand side, you got 100 shares. It rose $50. You'd make $500. where in the world would you put $25,000 at risk just to make $500? That is not a smart trade. On the right hand side, you own one contract at $2,455, and if the stock rose $50, you would make anywhere between $4,000 and $5,000. The reason there's a price range is because the stock isn't as deep in the money, so it may not move dollar for dollar with the stock price. The option is not deep in the money, so it may not move dollar for dollar with the stock price. So let me kind of clarify that. If the stock moves $1, the option might move 75 cents, okay? So it's not moving dollar for dollar because it's not that deep in the money, but you could go deeper in the money, but it gets more expensive on bigger stocks. So that's why it says ideally you'll make anywhere between 4,000 and 5,000. Now there is something that you can calculate out that'll give you exactly what the option will move if the stock moves a certain amount, right? So I talk to you and show you how to calculate all that. But the point is here's the point. Do you want to put $25,000 at risk to make $500, or do you want to put $2,455 at risk to potentially make $4,000 or $5,000? It's a simple no-brainer. I know which one you would pick, and so that is that's the webinar, ladies and gentlemen. I do have an opportunity that I want to show you one of my new courses that's coming out. But before I get into that, let me just open it up for questions real quick, and then I'm going to talk to you about a course that I have that really teaches you how this all works. And whether you get the course or not, I'm hoping you got immense value out of this tonight. But in a minute, I'm going to open up the course and kind of show you what's in there and how I break all this down. But first, let me open it up and ask what questions do you have? Sheila said, is it a good idea to buy options on stocks under, I don't see the rest of your message, under $10? It just depends, Sheila. If a stock's under $10, it's probably only going to move somewhere between 30 to 50 cents. So now it's about volume. How many shares can you buy to make that 30 to 50 cent worth your time? Because a stock under $10 moves 10 cents a day, 5 cents a day. So it just really depends on your strategy and how many contracts you can buy to make that 50 cent worth your while. If you're buying 100 contracts and it moves 50 cents, well, that's going to be worth your while. If you're buying one contract and it moves 50 cents, I think that's like $50. Not worth your while. You're going to pay commission getting in and out of the trade. Not worth it. Howard said, what's the difference between in the money and out of the money? Howard, the in the money option is an option that has real value. So if a stock is trading at $100 and you go buy an $80 option, it has $20 in the money. Like, why would I sell it to you? Why would I enter an agreement to sell it to you at 80 when it's trading at 100? So that's an in the money option. If the stock is trading at 100 and you go buy a $120 option, that means you agree to buy, you have the right to buy it from someone at 120. Well, it's only trading at $100, so that's out of the money. It's $20 out of the money. So that's the difference between in the money, out of the money. Is there a limit on how many option contracts you can buy? However many you can afford. Can you quickly explain what you mean when you talk about deep in the money? Can you show the 2 secrets to growing small accounts again? All right, so I'll tell you what, some of these questions, Bob says, my biggest concern is with options is when I hear that most options expire worthless. Can you elaborate or explain? I mean, they expire worthless if you don't know how to read a stock chart and buy the right stock or buy the right option, right? So if someone is buying an out of the money option because it's cheap, that's not the right reason to buy that option. You need to have a foundation of looking at a stock chart and saying, where do I think this stock can go based on the chart, based on the momentum, based on where we're at in the overall market, and how long do I think it's going to take to get there, right? So I don't just pick random dates. There's a reason I pick 30 days, 122 days, because I have to look at a stock chart and say, what do I think this stock can do, and in what time frame? Does that make sense? I hope that makes sense. All right, so gosh, you guys have a lot of good questions. So I tell you what, let me switch screens and I'm going to show you guys what we have inside the Options Explained course, because basically everything you're asking, there's no way we'd be able to cover everything on this webinar. But let me just show you what's inside the course, and then I'm going to switch my screen here. So bear with me while I switch my screen. Now, someone asked, can I show the this trade secrets to growing a small account? So let me just flip back to that really quick and show you that. So there it is. If you want to take a picture, or I don't know, but there it is. So hopefully you can see it on my screen there. And I'm going to leave that up there for a minute, and then I'm actually logging into the course right now. And then I'm going to share my screen with you, and I want to show you guys what's back there, because there's no, a lot of the questions that you're asking inside the course. So let me switch screens here. So for all of you that are asking a lot of good questions, right? This webinar, there's no way that I could teach you everything on a 1 hour webinar, right? So this is the back end of the course. So module 1, we break down what options are in the different industry that use options. Module 2, in this option, we break down the foundational components that make up the building blocks of an option. So we talk about the time component, the intrinsic, extrinsic value, all that stuff. Module 3, we break down what are in the money call options. So somebody was asking, well, what's an in the money call option? We break that down, how to interpret an option chain. In module 4, we learn about in the money put options and how to interpret put option chains. Module 5, we break down how to use in the money call options as a buying strategy. And then in 6, we break down how to profit from the downturn of a stocks by buying in the money puts. And then under each module, so for example, under module 1, you'll see there's like 6 mini modules underneath it that really breaks down the whole process. If I go to module 2 and break down the option components, you can see here that I'm going to break down all the components of the option. So you're going to understand everything from A to Z by the time we're done here. If we go to module 3, you can see we break down call options, and it's called Options Explained. So you'll know how to use at the money, in the money, at the money, and out the money options to profit from it. I can't even talk, right? Module 4, put options. We're going to break down in, at, out of the money put options. And then there's module 5. We got call option strategies. There's a ton of strategies here. There's well, actually more than that, right? There's 8 modules on strategies, how to use it for income protection, how to use it for bullish markets, bearish markets, protecting my portfolio, protecting my stock. There's just a ton of buying strategies in there. And then in module 6, we break down all the put option strategies here. There's only 4 put option strategies, and we break down why. You can see there's real examples of where to look for, how to come up with, everything. There's bonus modules in here galore. There's a bonus module. I'll show you how to buy stocks at a discount. There's PDFs that you can download. You get my option cheat sheet worksheet. You get the option strategy and profit grid. You get the option formula worksheet, the option buying and selling rules, the option Greek quick reference. There's also a course in here on Greeks. So there's, everything you need on options, I broke down in this course, and it would be way too much to break down on this webinar. So someone asked, how much is the Options Explained course? Let me ask you this. Before I share with you the price, let me ask you this. What would it be worth for all the information I just showed you that's in the course, not to mention knowing how to trade the market the way I just showed you, knowing how to put smart money at risk, knowing how to increase your gains, 50% fold versus 10%, putting less at risk? What would that be worth to you? I'm just curious. I'm going to tell you the price. The price is what it is. Some of my other students are already taking the course who got early access to it. But I'm just curious. What would that be worth to you? For those of you who can still hear my voice, just type it in the box. What would that be worth? Don't worry, I'm not gonna jack the price up if you say a price that's more than what it is. Interesting. Sheila said 250. Ethan said 500 to 1,000. Marlon said 1,000. Caesar said a gazillion. Marcus says the course is well worth it. Took it 3 times. You must be in our foundations course because we pre-released it early to the foundations members. Alex says 500. Bob says 750. Dave, you said $49.95. To be honest, I would tell you to kick rocks for $49.90. Maybe you meant $495 because I would say kick rocks for $49.95. If I could show you how to take $3,000 and possibly make $1,500. That was a recent transaction. All right, so let me just give it to you guys straight. I'm going to show you on my screen. If you're, and this is no sales pitch, this is more up to you. If you want to learn how to trade options, I put this course together and I made it very affordable. I'm going to scroll down and I'm going to show you the super low price, but I could have charged $1,000 for this. I could charge $1,200 for this. Other people do, but for me, it's important that everyday average people can afford this, because when I bought my first course, I paid $4,000 for it and I had to put it on a credit card. I had to apply for financing to do that. And I thought, how many people will never be able to take a course like this because A, they don't have $4,000 to just put on credit. B, they're scared to even take that risk, even find out they don't like it. So my course is $197. And because I'm confident in my teaching and my material, I also offer a 30-day money-back guarantee because if you don't want to be in the course, I don't want you in the course, right? I don't fight with people and argue. Please keep it. I don't have time, right? I'm trying to make this stuff reasonable and affordable for the everyday person to learn the tricks, tips, and the trades that the average, that the professionals won't share with the average person. So there it is. The course is $197 and it comes with a 30-day money back guarantee. So we're going to be, Dave said, the knowledge is invaluable. Wendell says, I love it. Michael says, great. David says, well worth it. Yeah, I think, David, you took the course. But, you know, you can go to powerstockoptions.com and check out the course. That's where it's at and where you can buy it. We're going to be holding a private coaching session for those. I believe we're hosting that the first week in October, but we're going to be doing a private group coaching for those who have the course to kind of answer some questions, make sure they fully understand options and make sure that they're getting the most out of the course. So we're at the top of the hour. I'm going to take a few questions, but again, you can head over to powerstockoptions.com and pick up the course. And I'm going to hang out and take some questions from those who have questions. Rupa says, do you take weekly webinars? I'm not sure I understand that question. Do I take weekly webinars? I'm not sure I understand that. Dwayne says, I'm definitely going to purchase options. Hey, pick it up and go ahead and get inside of our private coaching that we're going to do, for those who pick up the course. Sheila says, please email the link to the course. All right, I will email it to you, Sheila. Keith says, Jason, excellent presentation and offer. Hey, I appreciate it. Someone says it's 2 a.m. in London, but oh, nice. Well, thanks for joining us from London at 2 a.m. I appreciate it. It's only like 9:13 Eastern Standard Time here in Detroit. Michael says, Jason, how do you take profit from options? Basically, the same way you bought an option, you basically sell the option back to the market. So, when I showed you an example where you can pay $3 for an option, well, if the option rises in price, you can sell it back for like $6, or I'm just using it as an example. So you basically do the opposite of what you did to get into the trade, which we talk about in the course, how to unwind. Rupa says, if I register for the course. Oh, if you register for the course, we're going to do like a one-time group training, but I do have a private coaching group that if you filled out, let me go to my website and show. If you're looking for to be part of our group coaching session, if you go here and just click work with Coach Brown, you click that, there's a coaching application for you to fill out. And once we reopen it, which will be sometime in October, we're going to reopen it back up. We do weekly webinars where we jump on line live for an hour on Mondays, and we go through stocks and charts and stuff like that. Dave says, thanks for the webinar. I appreciate it. No problem. Bob says, I will purchase options. Hey, I appreciate it. But more importantly, you'll be a better and a more confident trader. Again, that's powerstockoptions.com. Or if you're on my website, you can go to Stock Market Courses, and you can go right there as well and just click Options Explained. It's going to be right there. Rupert says, me too, but I would like to attend the live class, as you mentioned, the first week of October. It will be only available for those who purchase the course, because we're going to be talking about stuff that you need to have an understanding of before you get in that live class. Gabby says, you mentioned you like to go deep in the money for stocks under 50. Is there a certain amount of prices in that you go? Yeah, Gabby, I talk about that in the course, but I usually like to go about 2 to 3, usually 2 strike prices in the money. And there's a certain reason why. Sometimes when you start to go 3, it gets too expensive, but there are some things that you need to look at that'll tell you how much the option will move if the stock will move, because that's really what we're looking for. How much will this option move per $1 movement in the stock? So that's really how you determine what option you're going to get. Sheila says, do I get to keep all the courses? Yeah, they're all online. So once you pay for it, you can watch it as many times as you want. And trust me, you're going to probably need to watch the options course once or twice. You may not get everything the first time. You may not fully understand. Marcus says, do I have an opening for coaching? Not yet. I'm going to send an email out when we open that back up. But I wanted to launch the Options Explained course, because you'll get more out of the coaching if you understand, if you took foundations and you understand how to read stock charts. And then when I start saying buy the $10 call or look at this, you won't be like, what's a call option? I won't have time to stop in a live webinar now and do a training on what's a call option. So that's why there's a sequence to taking these courses and then getting into the private training, because it's not fair to the people who understand what it is and they're paying for expert coaching for me to come in and start saying, well, here's what a call option is, and here's what, all right, so hopefully that makes sense. Cynthia says, I will purchase as well. It is on the bottom of the foundations module. Yes, I think if you're in the back end of foundations, you can purchase it as well to use it. Gabby says, or certain ratio of strike price to option price that you look for. No, it's not a ratio. It's more about, Gabby, about how the option is going to move in relation to the stock. That's really what I'm looking for. Bob says, can I trade options in my IRA? You can. You normally have to get approved to trade options in an IRA. So you have to check with Fidelity or whoever you have. But normally you can, yes. Chase says, is there a minimum amount of money you have to fund an options account? I believe with Options Express, you need, don't quote me, I want to say it's $2,000, but that's only if you're going to use margin. If you're not going to use, well, you can't use margin with options anyway. If you're not using margin, there is no minimum with Options Express, which is normally the broker that I recommend. Dwight says, how much is coaching? Oh no, I'm not going to go down that rabbit hole right now. It'll be a reasonable price once we reopen it back up, but any price is too expensive if I don't build value for what you're going to get. So, but trust me, I mean, you can see from if you took a previous course or this course, you can see I'm not out here trying to price gouge. It's just, I have to pay for an internet connection, a microphone. I have to pay for internet storage. I have to pay for web software to allow you to log in and this stuff. So that stuff's not free. That's what you're really paying for, because the information is priceless. But I always try to make it a reasonable price, right? But GoToWebinar charges me to pay to have these webinars. So that's why we have to charge for the stuff, to be honest, and obviously my time, or else I could be asleep right now, right? Just like you. Gabby says, also already took your options course and love it. Going to refresh and take it again. Awesome, Gabby. Cool. I'm glad yes, I saw your name come through when you purchased it. Marcus says, you just answered my question. Keep up the good work, sir. I've learned a lot from you over the past few months. Hey, awesome, man. I appreciate it. I'm out here trying to share the stuff that the big boys aren't willing to share with the little guys, right? Because if a bunch of us little guys get this knowledge, What happens if all of us collectively have $100,000 to put into a stock trading account, right? What happens if all of us take the money we make from the stock market and go buy real estate somewhere, right? I mean, it's bigger than just the stock market. Once you start making this money, what's to stop a group of us from going to buy a couple of franchise restaurants, cash money, right? So, I mean, you just don't understand where my thinking is at with this, right? The more people we can help, you just don't know how far that money can go and what we can do collectively as a group, as a team. But that's I'm going off on a tangent, but that's how I think every day. So that's why I love sharing this information, right? It would mean so much for me for a year from now for you to jump on a webinar and say, hey, because of something you taught me a year ago, Mr. Brown, I put my kids through college cash money. None of them have college debt. That's what this stuff is about, being a smarter trader so you can use stocks and options as a bridge to get where you want to get in life, right? I'm going to try to run through these questions. I see a couple more questions. Michael says, great job. I'll contact you, and I hope you present me with the link of your offer through email. Yeah, if for some reason you need to email me, just email info@thebrownreport.com. Sandra says, I have been reviewing Bollinger Bands candlestick charts and recently learned about oscillator. Aaron, is there any single technical fundamental you use, or do you use several? I mean, I use Bollinger Bands, I use MACD, I use stochastics, but that's for a whole nother webinar. But I use a lot of different things. Do you post your webinars on YouTube? Not all of them, but I may post this as a replay. Marvin says, thank you, Marvin, for joining. Liddell says, do you day trade or teach on day trade? I got a free course on day trading. If you want to take that, look at the screen right now. It says the good, the bad, the ugly of day trading. I mean, it just kind of teaches you what it's all about. I used to day trade, but to be honest, I don't day trade anymore because when I looked at my life, I got into this so that I didn't have to sit in front of a computer for a boss or sit at a desk every day. When you start day trading, you kind of start sitting at a desk every day watching the stock market from sun up to 4 o'clock when it closed. That's not a lifestyle to me. You just bought another job. So I personally don't day trade anymore, but I used to, and I was successful at it. I just don't. You're basically trading time for dollars when you're day trading because you're in front of a computer all day long. At least that's how it was for me, and I'm just not interested in anymore. I'm more about 30-day trades, 60-day trades, making 5,000, 10,000, and I don't have to look at it every day. I just need to look at it once a week. Rupa says, we have access for how long to the web course after registration? Once you pay for it, you have access to it, I mean, forever, for life. So it's on the web. As long as I'm paying for my web hosting every month, which I do, it's just there for you to take the course. All right. Rupa says, till what time period? I'm not sure I understand that. It's just on the web until you take it. Have I ever heard of fixed index annuities? Yes. Mateen said, is it basic or intermediate to advanced level? The options course is really intermediate. Advanced level would be talking about spreads, iron condors, some of that stuff. I don't really get into that in the course because you have to have a foundation and an understanding of how options work. If I start talking to you about buying one call, selling another one on top of it, and then buying a put, selling one on top of it, and that's an iron condor, you'd be like, what? Where's my profit? What's the stock? You'd be confused. So I do teach some intermediate strategies, but there's another level to this of sophisticated strategy, and that'll be a whole nother course if and when you're ready for that. Is Options Express available for Canadians? Last time I checked, I'm not sure. But if they're not, check with Fidelity. I think Fidelity works with Canadians. Wendell says, thanks for the webinar, and I bought both courses, and they are great. I got to keep studying more and more the Options Express platform. Awesome, man. And if you're a part of our private Facebook group, post questions in there. Dwight says, took foundations course. Great. Plan on taking the options course. Great work. Thank you, Dwight. Matthew, the online broker is higher in options. The online broker is higher in option than stock. I'm not sure I understand your question, Matthew. Sorry. Jason Shepard says, thanks, he enjoyed the webinar. Thank you, Jason. Roop says, cool. Marcus says, yeah, I need the advanced stuff. Looking forward to October. Hey, I'll be there if you need the advanced stuff. All right, guys. So tell you what, if you got any other questions for me, don't hesitate to reach out on Facebook. If you need to email me, reach out at info@thebrownreport.com. I hope I answered all your questions. I appreciate you guys spending some time with me. And whether you take the course or not, I sincerely hope you got a lot out of this. My goal is always for my free content to be more valuable than other people's paid content. So I hope you got a lot out of this. So have a great night.
Okay, so welcome to the Ultimate Stock Trading Course for Beginners. So who is this course for? Well, if you are someone who is totally new to the financial markets, you want to learn more about stocks, how it works, then hey, this course is for you. Or maybe you're a trader, right? Maybe you trade the forex or crypto markets, but you have no idea, what stock is about, and you want to, dive in deeper. Then hey, this course is for you as well. Or perhaps you're someone who wants to use the stock markets to help you, generate another source of income, to help you beat inflation, or to just grow your wealth over time. Then hey, this course is for you as well. So before I get started, my name is Rainer. I am the founder of tradingwithrainer.com, and here's what I want you to do right now. Hit the thumbs up button, right, and subscribe to my YouTube channel. The link is all below. Hit the thumbs up, subscribe to my YouTube channel, and this way, whenever I publish a new video, you'll always stay up to date. Never miss another training from me again. Sounds good? Then do it right now. Hit the thumbs up button and subscribe to my YouTube channel. The link is below. So with that said, right, let's begin.
What's up, everyone? All right, so for today's episode, I want to do something special for you guys. I want to time travel as much as possible back to when I was first getting started trading. And what I want to do for you is I want to really break down one of the challenges that I had, which was I was trying to find an alert service. And I bet a lot of you guys have tried to do this before. An alert service is a service that sends you a trade alert via email and text, and you get it, you buy the stock, it goes up, you make money, and you don't even have to learn how to trade. Sounds amazing, right? Well, obviously, it's too good to be true, and it didn't work out for me. But I spent a lot of time going through alert services and getting frustrated. And so what I want to do in this episode is I want to give you a critique of the different types of alert services that I subscribe to, and talk to you about where they worked, where they failed, and what I had to do to really move past alert services and become my own trader, to develop my own strategy. Now, because during this episode I'm going to be throwing some shots, I don't want to post it on YouTube. So what I'm going to do is I'm going to host this over on my own website, and there's going to be a link right here in the description. Click on that link, and then you'll jump over to the website, and then you can stream this episode. I think you guys will really enjoy it. You'll get a lot out of it, and you'll learn a little bit about.
So have a look at this, right? This is Apple. Okay, so Apple. Okay, so there's a slight mistake over here, right? So at the time when I did these slides, right, Apple was worth 731 billion, but as of today, it is slightly higher. The stock market, it goes up and down. So this one is a little bit dated, but they're about 700 plus billion market capitalization, right? This stock. So Apple, what does it mean to buy a share of Apple? After all, you want to learn stock trading, right? You're going to buy shares. What does it mean to buy a share? So when you buy a share of a company, whether it's Apple, Facebook, Amazon, whatever, it means that you're a part owner of the company. It might sound weird. What? I'm an owner? Yes, you're an owner, but just a very small minority owner. So let me explain. So if you go down to this website over here, right, it's finviz.com, a very useful website. It gives you a lot of financial data, stock prices and stuff like that.
All right,
and you'll see that right now, Apple, the market cap, okay, it's $793 billion. That is the market capitalization of Apple, the value of Apple. Okay, almost 800 billion. And right now the price is about $165 per share. So if you're gonna buy one share of Apple, right, you need to fork out $165. And you can see that, earlier I mentioned that, when you buy Apple, you're a part owner of the company, right? And you can see that your ownership stake, right? Let's say you buy one share of Apple, right? It's $165. divide by this market cap, which is
I'm gonna try to change the stream real quick here and see if I
billion.
can get
Okay,
stock
once
charts and
you
have
divide
Jack
this,
watch
right,
me
then
use
you know
stock
how
charts,
small
so
your
just bear
stake
with me here.
in Apple
I'm hoping the
is.
audio will stay.
Okay, does it make sense? So 165 divided by $793 billion, that is your stake in Apple. If you can't, just
Not that
imagine
my
the kind of,
stock chart,
minuteness, right? Then,
charting is worth
okay, let me just
watching.
break it down to
We're gonna
another way.
look at
Let's say somehow you're a really rich individual, right? You buy.
We want to help make right now sound a little bit better. So we're opening up SiriusXM for you. Stream now for free until May 31st.
So what I was
Go to SiriusXM.com/StreamFox to start listening.
Just have
Let's get back to our markets as we head to the final hour of trading. We've got Crescent Wealth Management's Jack Ablin and Walzer Wealth Management President Rebecca Walzer. Guys, great to have you here.
Great to be here.
All right, Rebecca, first to you. Looks like we're going to have a down week for the Dow if these numbers hold at this point. A lot of it based on earnings, Amazon and Apple. Your last thoughts on the trading day?
Yeah, I was with you, Cheryl. I wanted to see it come back, but obviously the GDP this week, we expected it, didn't help, but and 30 million is a big number to digest, right? So obviously the market is saying, oh wow, we are in for the long haul here. I expect us to have some volatility in May back and forth with some positive numbers on reopenings, and that's going to give us positive uplifting news, but then we're going to have the negative earnings coming out that we are going to be hampered down by. So expect a volatile month for May, and it makes sense.
Jack, where do you look for opportunity in these markets? Jack? All right, I don't think Jack can hear me right now. The fun Rebecca of technology and Skype and everything. But Rebecca, it's interesting because, again, we're going through these earnings, but a lot of analysts have said that some of these earnings don't necessarily matter because the pandemic and the country shutting down didn't really kick in until, in earnest, March 20th. How do you read these earnings reports? Because we're right in the middle of a very heavy reporting season.
Second, the guest
I
maybe
think
Skype or
actually,
something
if we look at
else.
Alphabet this week, I think that
Let's try this. Yeah, bear with me here.
We want to help make right now sound a little bit better. So we're opening up SiriusXM for you. Stream now for free until May 31st. Go to SiriusXM.com/StreamFox to start listening.
Let's get back to our markets as we head to the final hour of trading. We've got Crescent Wealth Management's Jack Ablin and Walzer Wealth Management President Rebecca Walzer. Guys, great to have you here.
great to be here.
All right, Rebecca.
Still with me. So scene 2. Oh. Coming back to the host scene here. I could have sworn or somewhere before it was asking me if I wanted to show a second monitor. Add source. Here we go. Screen capture, monitor capture, desktop 2. Okay. Well, that's my other desktop. So far, so good. There that goes. Okay. Cooking a little bit. And then earlier, I was able to make this other screen the full screen. Oh, shoot, no. Okay. All right. That'll do. That'll do. Let's get Thinkorswim up. Of course, it's going to take about 2 years. That's my old computer. It would take that long to get Thinkorswim up. Alright, so now, it was full screen. How do I get it back? Alright, so but it wants to go up there. So it wants to go up there. We'll move down here. So this was called Xstream, this program, if anybody's listening. And you have to figure out, I mean, I'm like pretty good with just figuring out, I mean, you know, if you just give me a program, like, you know, I'll just dig around and it'll be frustrating. And I'm still obviously getting frustrated, but I mean, I just started learning this program a couple hours ago. Obviously, so far, so good. Learning it decently because now my dad just texted me. Let's look. I want you guys to look at Benzinga. Boom. And then there we go. Full screen Benzinga. There's the chat. Beautiful. So that means we'll be able to easily do charts. And I'll be able to look over at the Benzinga chat. It's about a 10-second delay, maybe 5-second delay. Let's see. Mark 1, 2, 3, 4, 5, 6, 7. So 7 seconds. Pretty cool. Uh-oh, I don't know if is this going to be able to handle Thinkorswim and the streaming. We'll see. So that's going to be CGC, Canopy Growth up there right now. Definitely slowing down the computer. See if we can close some stuff down. Oh, I didn't mean to close that one. Shit. OPK. So this overnight declines. Don't look at that. So OPCO Health. No, this was a big. So this thing jumped out of the gate. Somebody pumped and dumped. Poor bastards. Then right back up a little bit. Let's take a quick look. So those are our fibs for if we're going to play the range on the stock for, I have to get this bottom bar thing out of here. In order to get this out of here, I have to click on every chart. And then let's put, yeah, once we click the chat, don't worry about that. There we go. So top of this fib chart, 233. And that's not the top of the fib chart. So this has more range than that. So we're going to back this up a little bit. Great. And the fib doesn't appear on this chart. So this is a 23.6 on top. So you have room above this. There's a fib line up here at the top somewhere. All right, I had to just send out a message or two there. So, looking at OPK Health, this was a request from somebody in Benzinga. Just wanted to take a look at the chart. So real quick, you have your 50 and your 15 moving averages. Your red one is the closer one. So the red one should be the 15, and the blue, which they don't really have going here, would be your simple. I don't get too much into the simple. So what we've seen in this stock is some range here during the week. So this is trading for the last 5 days. The high of the week would be this topping tail. When you draw trend lines, you want to do the top of the tail, but then also the fat part of your candle too, because the topping tail is, it doesn't reflect on the 15-minute chart. It reflects a limited amount of transactions in that range. So, and actually, I don't like to connect topping tails for descending trend lines. What I like to do for descending trend lines is connect the bottom of your selling tails. So, as you connect these bottom tails, you're going to extend, from the very bottom of the tail, and then also you want to go to the fat part of the candle too. And you're going to connect your two candles. And you see how these channels then, or the trend lines, do not set up parallel. And you're never going to respect that channel because stocks don't make higher highs and higher lows at the same time. I mean, they can for a very limited amount of time, but it's just never how it happens. So inside this range, you can take your bottom tails here, connect those, and take the fat part of your candle too, connect those, and see if you do have any kind of development that you can recognize. And we'll back this up. So we were looking right in here. I knew that was going to happen. So the reason that you want to just look at these sell-offs, it's going to give you an idea of just the potential of the stock when it does begin to sell off. Luckily, when you hit these trend lines, you will tend to slow down. So, that's why in this particular stock with a lot of chop, you're not going to bother drawing trend lines in this range. Because that's just going to fill your chart full of red lines. And, it's in the range anyway. That's when you can look at your fib charts here to the right. And, that's basically when your stock is in like a small range, your fib lines are going to take care of that for you. And you're not going to have to fill your chart full of red trend lines. Your stock's pretty much going to respect these fibs. If you want to set up a trade inside these fibs, that's great. I've lost a lot of money doing that because you're just bouncing side to side, and you eventually get tired of being in there, and you eventually want to get out of your trade, and you're willing to take it at a loss. So, really when you get inside these fib lines, that's where I'm kind of more of a breakout trader or, a momentum trader. I want to see a stock ride through these trend lines or these fibs, and obviously on these trend lines too. Most of your time, your trend lines aren't going to be steep like that. You just had a lot of movement on OPK, and moving forward, you're probably not going to see this type of volatility. But the reason you draw these trend lines is that if you do see these volatility, you're going to know kind of your exit point. Like, where's the stock going to slow down? So when you're flying up, if you happen to be trading and you buy in these fib charts, as you go up, this is where the stock may slow down and may reverse on you. That's why we draw these lines. Is it gives you, for me, it gives you entry and exit points. Typically off trend lines, you're going to look for reversal trades. So the stock's going to hit your trend line. And I always watch 15-minute charts because if you watch a 1-minute chart, you're just going to whiplash. Like here's a 15. And here for the same day, it's a 1, and you're just going to lose your mind drawing, following 1 minute. So you can do 5 minutes maybe. But when I didn't know what I was doing, I was watching 1 minute charts and it was driving me nuts. And then I eventually started to ask people for advice, and it definitely helped me calm down with trades, where you're just gonna have to sit and watch a losing trade sometimes for a few minutes and be willing to take a few extra dollars, because you have to let these candles complete. Like, for example, if you were coming down on this trade, all right, and you bounced off the bottom here, if you were short on this stock, it's starting to move away from you here. But this is why you look at the 15-minute chart, because you're going to be able to see that these topping tails, you're still making lower highs, all right? Even when you reach this candle, you're still making lower highs. So this is the first time. So despite the price of the stock going up, you have to understand that the momentum is not going against you. So when you get to this candle here, this is where you give it 15 minutes. You probably bounced a little bit, but you still didn't even tease the opening. And your next candle was just straight back down. And you could have stayed on your short, well into here. I don't know if your target would have been so low. This is where you have to look at a range of a stock, and it's not really going to get down here. So, again, I forget who is asking us to draw OPK. I'm just going to put another link in the Benzinga chat to see if anybody wants to come in. Again, guys, I'm charting. Take a look. Someone here had requested if I had it charted. Why did it do that? That's interesting. All right, so just real quick here, I don't spend too much time. Also, don't try not to chart in your overnight ranges. That's really just dumb. You're not going to give yourself an accurate reflection of transactions on the stock. So we really want to try to do some ascending, and this stock has just been so volatile early this week, and this is why we're looking at it. I mean, the stock was very volatile. It settled down, much like the market was kind of quiet most of even the second two the Thursday and Friday, but we did have obviously your points in the afternoon. We saw some heavy selling both Thursday and Friday, but certainly did slow down. Didn't really carry. We did have a gap down into Friday. And made it all the way down to, like, I don't know, 282 on the ES perhaps. The VXX and the just try not to get too off topic here, but volatility. If you look at the VIX and the VXX, they really Thursday and Friday started to go up, and those are your volatility indicators. I don't trust them to trade, and I'll tell you, I've talked about it in the chat where I totally got screwed on a trade where I only made like $500 and it should have been $5,000. It was in stock options on the VXX, and I had a friend who was also in on stock options, and this is going back like a month ago, and we both were in calls on the VXX, and it jumped from like I was in like the 41s. Or even the 36s, and it jumped to 44. So, like, I was expecting like a $1,500 return, and I'm talking to my friend who's a pro trader, and he's like, "No, dude, these are going to jump, really high." So then I started. So this was all pre-market. I started talking to other traders, and they're like, "Oh my gosh, we're all going to see 1,000% returns." And first, it was fishy that the VXX didn't even open. The stock market did crash that day. It was one of the days that the market crashed. And the market didn't crash, though, until 9:36 a.m., and the VXX never opened. So, like, I'm watching the price, and I had my order. I'm waiting to get filled. I set up a trail stop, and I knew I was, in the, like, my trail stop, my limit was inside where the options were trading, but they never opened. So then the stock market crashed at 9:36. It didn't reopen until 9:51, and or is it a 10-minute? It's 10 or 15 minutes when the stock market crashes. And so when the market reopened, the VXX. So I think the market reopened. So maybe the stock market crashed at 10:30, 9:34, because I want to say like it reopened at 49. So whatever. The VXX did not start trading until 10:15. So they were immediately asked for explanations by all kinds of traders. It wasn't just me who was in on it. and their explanation was that they were worried about liquidity. So that's an ETF that's worried about liquidity. Like right then and there, I called Shadow Trader it wasn't that day. I couldn't get through, but I called Shadow Trader within days and gave him the story. I talked to Brad, and I told Brad the story. He looked into it, and he's like, dude, don't ever trade VIX, VXX, or VIX options ever again. They're a complete scam. So even then, and he's like, wow, and you know what? I'm never even going to trade the underlying anymore. So I was like, dude, I couldn't believe it. I got totally shafted. And I'm telling him, oh, again, don't do the top of, that's my mistake. Don't do the top of your red candles. Do bottoms. They're sell-off trends, not buying trends. So, yeah, he's like, he goes on the show like 2 days later, and he's like, oh, my God. It was a Monday. So he gets on Monday. He's like, yeah, dude, by the way, you know, that dude Chris in Florida who called, I looked into it. He's like, those VIX options are just a complete scam. And I'm like, dude, a pro trader on a stock show actually is saying this. And stop doing the top. And it's for real. Like, the thing is a complete scam. Don't trade even the underlying on VXX and VIX. Look at them for you. I mean, you know, God bless. But look at them for they're your volatility and fear indexes. All right, so this is just actually prime for volatility, this stock. We're not going to look at this day, nor this one. So now we're going to go back and check the week prior. You know, the good thing about this, I mean, this is a penny stock. It's trading at $2.13. I don't like to trade penny stocks. But I'm just going to see if it has options. And options on penny stocks are even worse because, you know, where the hell is the stock going to go? 25 cents? How are you going to make money on options? Yeah, the options are a joke. Wow, this stock trades 8 million shares a day, 9 million shares a day. This is no joke. This is one that if you trade, you don't buy this and hold it. I mean, maybe, I guess, because I don't know who was asking about this. Are they online right now? Was that you, Radic? Oh, shoot. I put POK. Ha! Probably POS. OPK, not POK. Alright, so again, this thing's just prime for volatility. Look, you could have jumped in. So this is why I don't trade penny stocks, because I don't like tying up, you know, let's say if you want to trade 20 shares. I mean, I don't like putting in more than like $50 into penny stocks. And I can't even tell you the last time I traded a penny stock. It was iBio, I think. Maybe I should get back into it. I mean, I figured I lost my shirt this week, and I should have stayed in Lyft. Sold Lyft. I shorted Lyft on Wednesday. I did pretty well. Thursday went against me, and then Friday completely tanked. I missed out on $150. I mean, what you're going to have to play for on this stock is volatility. So, again, we're getting back to the 5-day chart from last week. And what you have is, I can't even, like, get, like, a 2-day channel on this thing. I mean, I guess, okay, let's connect the low. So, okay, let's connect our low green candle to our low green candle. So let's do these two low green candles. So you may have some direction here because you're going back to Monday's opening. And you trended in this direction. Something happened, so you had 2 bad market days. And this thing completely puked Friday. Just, you know, the market, I remember the market opening bad, right? It opened at like 287, went right down to 283.84. And remember, Thursday was a complete chop fest in the market. Okay. And again, I'm giving you SPY numbers here, so that's SPY. It's just reflection in the S&P 500, which we all know. We all follow the SPY. So, yeah, I mean, here's your general overall trend, and early in the week, the stock respected it. Now, what you just have to remember is that when you open, look, the stock will open, it's going to jump, and then it's going to settle. I mean, on this day, it kind of did the opposite. But look, you open, you settle, you sell. You open, you settle. You open, you sell. So you have the. If this were something that, I mean, this is only what, 1 Monday, 2, 3, 4. So this is a 4-week chart. So if you bought 4 weeks ago down at 118, awesome. Let's look at the yearly. This thing is just volatile. This is what penny stocks are. And, you know, here. Let's say you bought here and you wrote it, you know, so here's a fib chart. This is why you draw them because, well, and this thing just exploded through the fib. So this would have been something that at the bottom of your fib, this is a reversal trade. You buy here. You have to have a little bit of stomach for loss down here because you could have bought right here. You may have had to have waited a day. And then as this thing starts to go, unless they spooked you, so this is a 1, 2, 3, 4. So this is probably 1 week right here. Unless you got spooked on this 5th day, I mean, wow, just boom, boom, and it exploded the whole way. And I mean, if you were that up that fast that quickly, you probably wouldn't have even sold here and just would have held. And here we are. So this thing is on a tremendous run. It's up 100% since March 30th. So a month. The stock's doubled, but we haven't even reached the 1-year high. So the 50% retracement is where we're at basically from the high to the low. So here's the problem. Look, last time we were at this level, we got blown up. Let's see if there was any news. So mid-October. OPKO and Pfizer announced positive, so that's October 21st. So that's after they got killed. Oh, man. So, could have been an offering. No. How? There's nothing in Benzinga? How is there nothing in Benzinga about what the heck happened on October 20... Wait, no, there is. October 21st. So there is. So October 21st, this thing gets puked. In the morning, Benzinga says, OPKO and Pfizer announced positive phase 3 top-line results for somatrogon, long-term HGH to treat HGH deficiency. Has to be an offering. So there's nothing that has to be an offering. There it is. $100 million offering. The underwriter, I never heard of. Piper Jaffray, I think I've heard of them. So, I mean, no big deal. They had an offering. We all know what happens to stocks when they have offerings. They get puked because generally the offering is a money-raising deal, and the offering is usually stock, and it's typically at a price that is not favorable to the current shareholders. So let's just see if something happened at, like, right here on March the 6th. So March the 6th. Another offering, I can feel it. You have insider buys. Okay. Yeah, that's probably what drove the stock. You had a bunch of insider buying March 3rd, March 2nd, March 4th. Call sweep. Call sweeps, call sweeps. This would just be a criminal if in the face of all these call sweeps they had another offering. I don't see one, so it's just a pump and dump. Class action, but that never means anything. This just looks like a pump and dump. That's all it was. All that insider buying, and they probably all dumped here. It's just what happens, man. When you gotta watch out too far, too fast. When your stock doubles in a day, it's just like when I'm in options, and I always forget, like, man, I bought into a stock option for 50 cents and it's trading at $1 within an hour. Get out of the trade. You'll be able to get in it cheaper. Trust me. So I'm just reading at news for this, was this just a pump and dump? And that looks like exactly what it was. They held the stock for 48 hours, give all those insider buyers a chance to get out. Wow. That's just a shame. Watch these penny stocks when they move like that. You're like, oh, man, it's going to be at 12. Yeah, right. I rode iBio from like 50 cents to 240, I think. And even then, I've sold a lot along the way. So like I said, the last time we were at these levels, you got puked. Twice. Once made it all the way up here. Maybe we're going to get back up there. I mean, that's your 1 year high. If you were in the stock and you got up here, I'd sure sell. Well, that's what I would do. I'm not going to tell anybody to buy or sell a stock. I'm just going to, you know, kind of, I can't tell you which way we're going, but I can give you a pretty good idea of along the way what's going to happen, because stocks respect trend lines. And if you guys, if this is fuzzy, make sure you're turned up to maximum, you know, pixelation, or, you know, what is it called? 480p or 780p. .720p should appear perfectly if you change YouTube to 720p. So this is, anyway, I'm going to watch this stock now because I can see how volatile it is. Unfortunately, the only way for me to play it short would be for stock options. We have a nice trend from the year low, so I mean, unless this is a pump and dump. So here's how you could play it if you thought you might be in another situation where it dumps. Is you could buy an option on Monday, don't hold it overnight, you could buy a put. And if you're going to day trade options, you have to play pretty close to your expiration date. And let's see. You know, if you're going to invest with options, you buy longer out. If you're going to invest in a stock via options, pick a target price, know your chart, know your charts, know your stock's ranges, and know where that stock might be if you have to hold the option. You never have to hold the option to expiration. I don't. I can't afford generally to buy 100 shares of the options, you know, of the stocks that I buy. I mean, sure, OPK, I could buy 100 shares, but Microsoft, no. I'd like to trade Microsoft, though, quality names, stuff that, you know, I can predict the news and how the stock's going to go. This thing is like it'll be down $2 before you even realize what the hell happened. Not $2, but 50 cents. And if this thing goes down 50 cents in one day, if you're invested in options, like if you're invested in a stock via options, you have to be 21 days out minimum. So you're going to have to roll as you, if you don't want to execute, or you know, you can execute your option if you're in the money when it expires, but you're going to have to buy 100 shares. Always though, try to be 21 days out, because if the option goes against you, oh man, that thing goes, and then your option's cut in half, so then you don't want to sell because you want to get something back, and then you never get even close, and then, you know, you expire in 3 days, you're down 80%, and you're just going to watch it expire worthless. I do it all the time. You try not to. You want to get rid of your option and get something for it. So on this, I would be encouraged to see OPK ride here, because this channel looks like, yeah, this is a closing channel. Now, and you have a lot of room here. And you're going to run across these trend lines. This thing, so this is where you have to watch, because this thing is either going to want to jump into one of these channels real quick, okay, and, you know, kind of sell in that direction. It's going to lose its momentum at some point, and then just hopefully it continues along a trend line. This is why I don't hold penny stocks. You can trade them. But unless you want to throw in, you know, you just totally believe in this company, you know. I mean, I don't really have any examples of penny stocks that really made it. that I traded. INO was cheap once, but they're going back to 0. Yeah, I remember trading INO down in here. And then with all the Corona rumors, just take a look at iBio. They're another one that's just, you know, they just totally inflate themselves. I was involved in it. This is, I bought iBio like here. I rode it all the way into this area. And, you know, when it bounced, you just expected these bounces and for it to come back. And you had another little Corona rumor. It's just, you know, these health stocks. mRNA is another one. We talk about mRNA like every second of every day. So, but you can see though, looking at a 1 minute, you can kind of just take a quick look at the trends. And now you have your trend set up. Don't ever set up trends on a 1 minute. But you set up trends on a 15 minute, and they will appear on your 1 minute chart. I'd like to know where I missed this possible bounce. So you do want to get in and look at your reversals and then figure out what you missed. So you had a reversal right here, and I'm going to add an alert because we're below it right now. So I want to know if the stock gets above this reversal point. And now I just want to figure out what caused it. Was that a trend line? Was it just something else? It's reversal right here. Interesting. I mean, without even drawing a trend line to cause this reversal, I can't plot. I mean, you have your, here's a low, okay. Monday low. And the reversal was here. Okay. Which, remember, you want to connect the top. So your bottom green is going to be right here. Nope, that didn't do it. The other thing you can do here, let's take a look here. So fat part here, fat part here. Sugar. We might have something. It's not like this is going to, like, you know, solve all your problems to figure out why that, you know, this might not even been the reason for your reverse. And again, we want to find the fat part of the candle, so we're right there. It's not like, you know, this isn't going to solve the world, and that didn't. So shoot. I mean, you had it basically. Oh, we just don't have it here. Why did it reverse here? And the other possibility is intersecting descending trend lines. I mean, you don't have to drive your. I'm not going to drive myself nuts on why it bottomed out here, and we don't even see like a typical double bottom. I would call this a false low. Shoot, I think it is a false low because that doesn't look like a good low to me. You want to see like a solid, like two solid candles. You want this thing to have. Look, we had volume. I don't understand what I'm really looking at and why these candles, unless for 15 minutes every single transaction they had basically occurred at $2.06 and then here at $2.07. That's possible, and you could just see these algos. You know, I call it ping pong. Yeah, you know, this is what I would call it. I hate it when the algos, you know, when the computers just trade back and forth like this. So this is what we're kind of looking at. This is a 1 minute. This is a ping pong in a 1 minute. If you just go back, when it looks like this, a barcode, it's just not even. Don't even get into a trade until you get out of this, you know, barcode, because you just sit there and you're going to drive yourself nuts. I mean, it's so annoying. So here's the thing. This thing could definitely still, and this is why I call this a false low, could definitely respect this sell-off right here. And as I've talked about in other charts, the stock will try to catch up to trends that it left off. And a lot of times your trends will, kind of quiet down as, like, for example, here what happened was the market reversed on Friday. And we started to push a little higher, after we bottomed out. So it kind of took this stock with it. I don't see a lot of strength to a lot of these candles. And your moving averages are another thing that are basically trends. You will often see the stock bounce off or fight with the moving averages. So here you have them both. A lot of times your 50 and your 15 will be close to each other. The ones, you've got your 50 and your 200 definitely have meaning. Again, we're looking at our 50 and our 15. This is a 1 year, so your candles are going to look different. So and this is another thing. So as you draw a bunch of trend lines on your 15, your 1, your 5, and again, don't do it on your 1. You can do trend lines on your 5. When you come here, they're going to start to disappear on you. But sometimes other types of things become somewhat clear. This stock since April 20th has traded at from $1.74 to $2 and really hasn't come down below $2. So from this point here, you'd be looking for probably a 50% retrace from your high, which would be at this point 240. 240, so 170. You might as well call that a 70 cents. And so that's obviously 35 cents for your 50% retracer. From 240 is going to be 205. And when you know it, I already have a mark there. So that looks like a pretty key level. This thing wants to get back to 205. So we want to get back to 205. And you do have a trend in that direction. So this is the problem, is that even if the stock belongs at a certain level, you have the stupid computers that trade, okay? So you have a 50% retrace from an April 20th opening that the algos are going to watch for, and they know that if you go through this, you have the 38.2% retracer as your next point, and then you have a pretty long fall to the 170 from April 20th. So if you fall through 205, you've got to stop. I don't think I have a fib set up. Yeah, I do. And then 175 is a retrace from 158. And then if you hit 158 and fall, you're going to 130. Well, no, I mean, that's based on another fib retracement program. I don't have one for where it's at right now. I mean, if you played 190, 192, I'm not going to look at it like that. I'm so scared of this thing flopping from that level as it did in the past, that from 205, and look, you're at 213, so that's actually a pretty good range. At 205, So if you were going to short because of what I would call the overall trend of the stock since, well, for Thursday and Friday, because it kind of carried with the market, I would think that the market, so you just have to watch this thing. If it breaks 205, the computers are going to trade this thing down. You could buy in at 205 and put a stop at 190, okay? Then you have to be willing to lose 15 cents. Okay, if you put any stop, if you put in a stop, I mean, the other thing you could do, okay, put a more narrow stop, and then the minute that it comes back to 205, buy it again, play it up to 212, and just be careful from there, because now as you get, if you're going to trade from the 212, you're going to have to fight all these fibs, unless, you could trade right through them in the early, from 9:30 to 9:45. But if you do that and you buy in and you watch this thing fight through one or two of these fib lines, you buy in. I bet you it goes up to 224, starts to come down, and you stay in your trade because you're like, okay, it's just breathing. It's going to make it to the 232. So this is where you want to collect partials on the way up, and then maybe as you get to a breakout point, you can add on. And then just have a close stop from there. Because if you went back down from there, you're still going to have profit from your base buy-in. So you could set a narrow stop, let it fall a little bit, and then buy back in, and then sell it if it keeps going. But you still have a pretty good profit. And that's how it's not just penny stocks that are going to work like that. Now here's the thing: is that if this thing jumps up into these trends, it's going to follow this trend. I mean, I can tell you that. And it's going to jump into these channels, and it's going to follow them because it does not have much resistance above it. But as you make all-time highs, especially with these penny stocks, you could puke out for no reason at all. People just going to collect profits. This thing was down at like $1.20. So you got people that have made some money on this one. So for Monday, I'll be watching this thing to fall through 205, because I think from there it's 190 and 170. And if I look at the delta on my put options, I can put this thing for 12 cents. I can put this stock let's see. I could put this stock for 12 cents in the $2 strikes for Friday, and I just need to know the delta. The delta is negative 355. If you happen to get $1 out of this stock, supposedly your options trade should go up $300 for every contract you have. Let's see. I don't know about that. See, I don't trust those numbers sometimes. No, it wouldn't be. Because if you're in the 4s, you're in at $2. This is where I have to look at why Ameritrade. Let's look at the deltas on Robinhood, the friggin' worst broker there is. I hate my Robinhood account. So if you were looking at the 2s, if you thought this thing could go under 2, here's your deltas, negative 34 cents. So 67 on that one. So you could double your delta, but you have to triple your buy-in. More than that, quadruple it. And the implied volatility, I don't believe that's 67 delta either. Well, maybe I do. If we went 3, that would put you at 90. And half of that. Yeah, I mean, okay. That delta sounds about right. So, if you got 50 cents out of this stock, your 13 should turn into about 39. But that's just Monday. These numbers are going to change Tuesday morning. So that's not a bad idea, because if you bought into these puts on Monday, as long as you could sell out of them. So this is where I use a cash account on TD, because if you do if you're on Robinhood, you can only day trade 3 times a week or 3 times every 5 days, no matter what. I don't think they offer cash accounts. So if you have a cash account on TD, you can sell in and out as much as you want to. There's no restrictions, but the only problem is that you can't reuse that money until the next day. So when I day trade an option, but if I bought into this thing on Friday and sold it on Monday, I can reuse that money right away. But if I try to day trade this on Monday, and even if I make a profit, I can't use that money again until the next day, which is somewhat actually useful, because if you make a nice profit on a trade and you go in that same day typically and get back into another trade, you're going to lose, because the market just doesn't trade the same way as we go later in the day. So I mean, on the call, if you were going to play this long, I wouldn't see. You should just play the equities because it's so cheap. On the long side, 250s are only 8 cents. So the juice on the premiums is on the, what's this thing, 213. So at $2, you're 13 cents away from the money, and you're getting 23. Ah, so the juice is on the calls? No, if you need this thing to go 13 cents your way for this contract to be good. You need to go 13 cents badly for this, so you need it in this direction. It's hard, unless that thing is like split down the middle, it's hard to really calculate where the juice is. When I mean juice, I mean the higher premiums, like where do the options traders expect this to go? Sometimes you'll see 2 to 1 on one side as opposed to the other, so it's kind of like, paying, a vig. It's kind of like instead of betting the spread, you're betting a team to win, and the casino charges you a lot more because you're not having to put into, calculation the point spread. You just have to win. So on the call side, you got delta 28 here, so 66. So you got to be the 13 cents in the money to get the 66 on this side. To get the 66 on this side, you got to be 38 cents in the money. So you got to be way in the money to get the 66, 67 delta on this side. You only got to be 13 cents in the money to get the 66 on this side. So that tells me that the puts are juiced for the stock to go down. Because, let's think about this. No, the better delta should be in the money. Okay. So the better delta should be in the money. And on this side, you have to be way in the money on this side to get the same delta. So that's the put side. So you got to be way in the money to get the good delta on the put side. 38 cents. You only have to be 13 cents to get the 67 on the call side. So they want you buying puts. They don't want you buying, right? When I mean they want you, you know, you always fight in the house on the options. If it's easier, no, if it's easier to get the premium on the call side, they want you to buy the calls. That's what the house wants. But you can't trade like that. This isn't the casino. They can't always control the direction of the stock. So if you can get the better delta out of the call side, obviously that's the better purchase, because you only have to be 13 cents in the money to get that good delta, and you're already in the money. And that delta should get better as the stock goes up, because you're so much in the money that if that contract can execute, it's going to be really in your favor. What's the break-even point on this one? Does it tell you here? I think one of these numbers tells you it. Oh yeah, break-even's up here, 223. So this is your weekly trend. You kind of rode along the low, a little bit of a high here, a little bit of a reach. Are you going to get into this channel? If you do, you have your trend line here. I would not hold the stock anything above here. And I'm going to treat this as a topping tail. I don't think this trend line is going to come into play anyway. Let's go back to the monthly. So what this does is it's giving you a lot of channels. There's a lot of room, a lot of paths for this stock to go up. A lot of trends going up. A lot of different buying tails. So look, I think I see on this chart more green than I see red, except for the last 2 days. And this is showing you 2 weeks worth of trading. And here's the thing is, you know, the moving average is caught up with us. Well, you know what? I mean, look, we traded above the moving averages. Came below them, barely. Traded above the moving averages again. Came a little below them, barely. Maybe we get back above the moving averages, especially if we have a good market. Right? Remember this huge rip? I think it was on the SPY. I don't know if that was the same time or not. So as I talk about, this thing's going to want to try to get back into this channel, and these are your kind of paths. You can see it go there quickly. But you just have to be careful, because then the algos, they get angry. And those computers get angry. They don't know why you traded so high so quickly. They want to get out. Because, you know, they don't want to see the stock up here. They want it, the computers want it riding these trend lines. They get scared. You know, they jump on and then they get out. Because they know they can get in and out quicker than you can. And this thing obviously has this very quick, you know, sale candles, very quick buying candles. So this is, OPCO is very interesting looking for Monday. So I've got a lot of alerts set up here. And like I said, I'm not going to say, everybody's like, is it going up? Is it going down? Well, you look at the chart. You tell me. What's it going to do on Monday? How the hell do I know? I think, do I know everybody wants to buy this thing or not? I don't know. But this is why the trend lines, the stocks will like the trend lines. So the only problem is I've tried to do a lot of descending lines here, and there just isn't much support. All these trend lines that I'm going to draw are going to be steep. When this thing sells, it sells. It's no joke when this thing sells. And let's check these ones out. Well, there's one that's not horrible. There's a non-apocalyptic trend line there. And we can do a trend line from this low to the next day's low. But look, you're still way underneath the current ask price. So the intersection of these two trend lines is somewhere down in here, in the low 190s. So, like most penny stocks, this one's a roller coaster. And, well, I mean, that's probably the best I can do on this one. Got a great looking channel for weeks. And just, this thing's going to buy, maybe go down on you, and you may have to hold it for 2 days. So it's maybe one of those deals. You have a losing trade for 2 days, and they rip it to the upside. You got a big gap up over here. And, there's like gap rules. Look at the shadow trader gap rules. You got a big gap up over here. Thing tops off, sells down. Then it sells hard, and then you're like, okay, I held it here, and then kaboom. This is when they shake you out of your trade. That's what they do. That's what the Dukes do. And then you're out, and now this thing's right back on it, and you're like, oh, you know what? I'm not going to chase this thing, and then they gap it up on you. Then you buy in, they rip it up again. You're in, you're feeling good. They start ripping it down on you, ripping you down. Now you're back down on your trade again. Maybe you get out, and then they rip this thing to the upside. It's just beautiful. It's just what the stock market does. It's here to create maximum pain. I'm really starting to figure that out. And this is why you get out of trades. If you're a trader, you can't just, your trade isn't always going to go in your favor. When is your trade always going to, I can tell you something, that 99% success rate on your trade. Buy it and then look at it again in 4 years. Boom. There is, I've got your 99% lock. All right? Because 99% of the time, four years down the line, your trade is higher. And that other 1% is maybe, your company blew up like USO's going to, or going bankrupt, unfortunately, like JCP and a few other of our favorites. So I'm going to take down OPK. Let me see what we got here. Anything on the educational side? It's a full interview with Warren Buffett, right when the stock market began to crash. But let's see if there's anything with Buffett and the airlines. Three weeks ago, that's all 3 weeks ago. So nothing from the last couple days. Let's see if Elon has addressed bizarre tweet. I'll look at another chart. I think I just got to put something in the oven here, get some dinner. Frustration about economy. All right, you know what? Let's take a quick look at this. Elon's bizarre tweet may be result of frustration with the economy. All right, perfect. So actually, let's take that down. Let's bring this back up. Okay, this was on CNBC during the day. When I saw them put this on, I was like saying, "Oh my God, these guys are being irresponsible," because they, obviously this tweet was, was a hack. We were all saying that. So now I'm in a situation I can't reduce this thing again. Oh, I forget exactly how to do that. Oh, okay, hold on. There we go. Let's bring this up.
Hi, I'm Rex Moore with the Motley Fool in front of BMW's self-driving exhibit at CES in Las Vegas. Now, have you ever wondered how to invest in this revolutionary technology? Well, I'm going to give you the top 5 things that you might want to know about. And I hope you remember.
All right, so what do you make of these earnings, Tony? They were seems better than expected, but for the most part by everybody.
Yeah, they were better than expected. I think.
Let's watch this one real quick. I gotta
folks believe that there would be more supply chain disruption, and Apple basically said that was very limited in the quarter. And as a result, really, results were dictated by demand trends, and were not as bad as feared. And I think on net, my numbers went up a little bit for the year for revenue. EPS stayed about similar. But it was certainly better than people expected in the quarter, and it was also encouraging that Apple said in the second half of April they had seen some improvement in their demand trends as well.
You didn't raise your price target, though, on the stock. I mean, if I'm just wondering if Apple can pull this off in what is this hellish situation that we're all in, and you don't raise the price target then, even though you take your numbers up, when would you?
Well, our EPS was largely the same for this year and importantly for next year.
Good line, I said.
We adjust our price targets based on 2 things. One, if our estimates change, and secondly, if the market has changed. And the market's changing a lot every day, up and down, and so we do that periodically. We did that a few weeks ago. The market had bounced off the lows. We raised our price target commensurately. But those are really the 2 reasons. But to your broader point, look,
I'm going to turn off my mic.
The encouraging thing, if you step back about Apple, is for this fiscal year, we now think that revenue and EPS will be largely flat during what is obviously a major economic shock. And that is encouraging. I think it speaks to the fact that through building services over the last 5 to 7 years, they have created a lot more profit and revenue stability to the company than they would have had a decade ago, and that's encouraging. And then there is this hope that if the economy sort of gets back to normal, starting at the end of this year, that we could have a strong 5G cycle for Apple going forward.
Isn't all that? I mean, how is this stock, in your estimation, not a must-own name?
Look, I think the investor debate is focused on 2 things. One is the multiple. It's a good story, but everyone knows it. So Apple historically traded at a discount to the market. It's trading at a 40% premium to the market on fiscal 20 earnings and a 17% premium to the market on fiscal 21 earnings. So even if you believe a strong cycle for next year, you're still paying, relative to history, a dramatically higher relative multiple for the stock. And that's the debate. What do you really pay for this? And I know we've been talking about this on the show for the last 15 minutes or so about broader tech. What is the right multiple, and when do you reach limits on that? I think the second question is, are we back to a normal economic environment next year? Because the iPhone, there's some discretion to when people can upgrade. They can hang on to their phones for longer, or they can choose a lower price model, both of which would impact next year's results. And so there is economic sensitivity clearly in Apple. They're more resilient than they were before, but iPhone were still down 7% this quarter. We thought they were going to be up 13 to start the quarter. And those are the 2 key factors. what's the price that you pay for this stock, and do we feel confident enough that the economy will be close to normal next year, such that we won't have discretionary pullback in iPhone spending?
I mean, even if you have discretionary pullback, if you have any kind of spend, it's likely going to be in names like this, right? If you're still going to have some level of remote working, you're still, I hope not, but there is a possibility of having remote learning in some respect in the fall if the virus comes back. All of that is beneficial towards a company like Apple. I mean, Tim Cook was talking about iPad and Macs were up more dramatically than maybe many anticipated, including you, as a result of those two, what may be longer-term trends.
Certainly, I think for Mac and for iPad, those longer-term trends are favorable. But especially on the consumer side, the wallet size is only so big, Scott. So if I'm a consumer at home and my wallet is X, and I'm working at home more, so I've upgraded my monitors or bought a new home PC, that could certainly come at the expense of my iPhone and keeping my iPhone a year longer. And this is exactly what we saw in the 2007 to 2010 timeframe. Folks had been replacing their PCs regularly. The PC market was growing. And then the iPhone came out, and folks started spending their discretionary technology or consumer budgets on iPhones, and we saw a decline in PCs going forward. And part of that was a usage and wallet shift. And right now, on a relative basis, working at home with a larger monitor on a PC is probably more important than upgrading your iPhone. And so on one hand, Apple will benefit from some of these trends. On the other, it may somehow come at the expense of itself.
So let me pivot real quick before I let you go. I wasn't intending to have this conversation today, but Elon Musk changed that for us, Tony. Are you on Twitter?
I am not on Twitter because we have to be careful as analysts about what we can publish, but I'm aware of the tweets today.
You are? Okay. So what do you make of them? I mean, from anything from I'm selling almost all physical possessions. I know this is the preface that this wasn't hacked, that this is exactly Musk doing this. I'm selling almost all physical possessions, will own no house, stock price too high, in my opinion, and the stock price gave a heck of a lot back after that. So how do you as an analyst respond to this?
Yeah, I mean, look, there still is an open question about whether these were indeed sourced from him, and the company hasn't confirmed it one way or another. But assuming it is, look, there was a lot of frustration on Elon's behalf on the earnings call on Wednesday night about lockdowns. He's obviously been in a battle with the state of California about the ability to operate their manufacturing facility there or not. So, my guess is that part of this is continued frustration at, a different belief he has about how the economy should be opened up in the face of coronavirus. Now, that said, if we kind of step back from the comments, I would say that Elon Musk has been on, quote, better behavior over the last 6 or 12 months. Investors have appreciated that. And so to the degree that this represents Elon Musk deviating from that, which has gotten him in trouble in the past, that is probably what investors are most worried about. That, all of a sudden, he's putting himself in a potentially compromising situation that happened in the past. Many investors deemed the stock uninvestable because of how predictable some of his actions were. And so when you see tweets like this, I think investors get worried, are we starting that phase again? That isn't great. And you're seeing that reflected in the stock.
Are you asking yourself the same questions that you just suggested that investors may be asking themselves? Is whether this is investable right now?
Look, I think I've always believed that, Elon Musk is uniquely brilliant, and unique brilliance often brings other trade-offs. Brilliant people aren't the best managers. Brilliant people often are eccentric. And we could argue that that is the case with Elon Musk. And collectively, he brings tremendous value to Tesla. But for many shareholders, any potential transgression, making comments on the stock, talking about potential buyouts are just make it too difficult to invest. And I think that is, something that individual and institutional investors have to make their own minds up on. But as far as Elon Musk is concerned, you get the whole package. You get the brilliance, and associated with that, you get, potentially some eccentricities, and that's what we're seeing today.
So this one tweet of the Tesla stock price too high, in my opinion, is that material in your mind, and would that violate the agreement that he had, and could that be problematic?
I don't, look, I don't know if it's material because he's voicing an opinion, and we've heard, people in the past, I think, Reed Hastings at Netflix has commented on the stock price in the past. Other CEOs have commented usually favorably that they think their stock price is inexplicably inexpensive. So it's difficult to, there is some precedent for CEOs commenting on their stock price.
Sure, but not one maybe who's already had some issues regarding, tweeting and the material nature of certain things, right?
Absolutely, and I think that's where the broader question is raised. He does have some some guidelines that he's effectively agreed to, and whether this violates them or not, I don't have a strong opinion on at this point.
You don't, but what happens if he did violate that? Wouldn't you have to have an opinion on that, Tony? Wouldn't it factor into the way it has to have some sort of bearing on how you would think about modeling the company, wouldn't it?
Right. Look, it would to some degree, I guess.
Steve and Dave use eToro to trade cryptocurrencies. Steve does extensive research in order to find the next Bitcoin. Dave does research on how to become a level 60 user. Steve follows the feed for the latest crypto news.
Truly a violation. And
Dave follows the feed for the latest cat videos.
And let's say the SEC came after him and said you violated this agreement. There would likely be a he said, she said phenomena that would take time to play out. And my guess is because he is not commenting on material company information, which was really the focus of what he agreed to, that the likelihood of there being a very severe consequence, i.e. that Elon, would have to change his role, that Tesla would have to pay a enormous fine, I think is low.
Yeah. Tony, I appreciate you coming on. We'll talk to you again soon.
Well, who knows what the hell Elon was thinking. I was comparing him to Howard Hughes. I think he's the next Howard Hughes, the current Howard Hughes. Let's look at another quick discussion.
Elon Musk is back at it, the Tesla CEO, tweeting today, Tesla stock price is too high, IMO, in my opinion. And that tweet, no surprise, sank the stock and raised a lot of eyebrows. Let's get to Phil LeBeau with the fallout. Phil, you got to wonder if the eyebrows over at the SEC are raised right now.
Well, we reached out to them, and they declined to comment today. They rarely comment immediately after something like this happens if there is an issue. So they could come back down the road and say something. But again, let's take a look at that tweet. When it was sent out, I think it was like 11 a.m., somewhere around there. Shortly after that, the stock tanked. He wrote, Tesla stock price is too high, IMO, in my opinion. And that made people say, well, geez, how much market cap have you wiped out? My producer, Megan Reeder, did a calculation here. Wiped out about $13 billion worth of market capitalization. Tesla itself is not commenting on the tweet from Elon Musk. So there were a lot of people earlier in the day, Melissa, who were saying, well, clearly his Twitter account was hacked. Look, if it was hacked, we would have heard about it from Elon Musk and Tesla. By the way, Musk and the SEC, remember back in 2018, they reached a settlement regarding his tweets, any financial communications. They are supposed to be approved by a committee at Tesla. But there's broad interpretation there in terms of what's a financial communication and what he can or cannot say. So guys, again, I think everybody's looking at this and they're saying, why did he say this? And we still have no answers.
I think that if there's any question as to whether or not this is a financial communication, I mean, I think you're nuts, right? I mean, he's saying that the stock is priced too high at that point. I mean, putting aside all the tweets that he sent surrounding this tweet and after this tweet about selling all those possessions and this and that, whatever.
Star Spangled Banner was in there.
Exactly. He can say all that. That has no impact. If I'm a shareholder, I don't care. But if you're going to come out and say my stock that I own is too high, that's harm to the shareholders. And that specifically is what the SEC had issue with the first time around when they had the settlement with him, right?
And that's why they were supposed to set up this committee that is in place, that is supposed to be the one that signs off on any of his financial communications. So more questions than answers, which is not surprising when it comes to what Elon Musk is tweeting out.
Gotta leave it to Elon. Phil, thank you. Phil LeBeau in Chicago, specifically, this is what the SEC said in their press release. The resolution is intended to prevent further market disruption and harm to Tesla's shareholders. That's according to the SEC release, September 29th, 2018. Harm to shareholders would seem to me to be down 10% on the back of a tweet. BK, what do you say?
Yeah, I think cabin fever seems to be getting to Elon Musk. I don't understand the upside here. You know, the SEC is generally trying to prevent people from pumping up their stock. I don't know, maybe he's being antagonistic, but there's no upside to this. And I think it does call into a little bit of question what's going on with him. And I wouldn't be a buyer of Tesla here.
Guy, what would you say?
I'd say the thing that, I mean, other than the obvious, I didn't know he lived in Gene Wilder's house, and it got me thinking about my favorite Gene Wilder movies, which is clearly Young Frankenstein. What was yours?
Willy Wonka?
Yeah, Willy Wonka's up. No question Willy Wonka's up there. I mean, if, you know, we could run the whole thing if you want. We could finish the show with this. With that said, I mean, the board of directors, you have to sit the man down at some point and, give a cease and desist. I mean, because his Twitter account, I mean, you should own Twitter just on the back of what Elon Musk is putting out there. It's priceless stuff. And then on Monday, if he says, you know what, it was too high on Friday, but it's perfect now, what happens then? I mean, I really just don't get it. Clearly, I don't get it.
Steve Grasso.
Yeah, I think BK brings up a really important point on this, that the SEC is usually involved or gets concerned when somebody pumps up their stock. So I don't know if they do anything in this scenario, but as Phil said, he lost $13 billion the last time he got fined. He got fined $40 million from the SEC. I don't think he cares. But to make it tradable, support in the stock is around the 650 level, and resistance is 767. That's the last place where they raise money. It's a trading vehicle right now.
It is ironic that the SEC would get in if somebody's pumping up the stock, but if somebody talks down the stock and that's actually causing harm and loss to shareholders, they may not even step in. I don't know, that's an aside.
Learning how to trade stocks was one of the best decisions of my life. When I began earning more in just a couple...
Back on August 7th, 2018, Elon Musk sent out a tweet that just frankly shocked the stock market community. We thought we'd never see a tweet like this again, talking directly about Tesla's stock price. It was an unbelievable tweet. And considering taking Tesla private at $420, funding secured. I mean, the craziest tweet probably in stock market history. I have yet to see a tweet as crazy as that, it shocked the stock market world. It was the talk of the stock market world for weeks, and honestly, probably several months, and it's still a day people reference to. And it's been exactly 633 days since Elon Musk sent out that tweet. And I guess Elon Musk decided that day 633 was the day he shakes things up once again. Here today, Elon Musk tweets out, Tesla's stock price is too high in my opinion. Holy smokers, just 3 hours ago he tweets this. And this tweet just comes out of nowhere. Like, no one's expecting this tweet, and he just sends it, okay? It's a full send, and it's like, what? Elon, seriously, you really just tweeted that, okay? Oh my goodness, okay? And look at the effects this is having on Tesla's stock price here today. It's having a very negative effect, needless to say. Tesla's stock price is down about 10%. Okay, that's within like 10-15 minutes of Elon Musk sending that tweet. Tesla's stock price had already started to drop significantly from where it was at, and it's just gotten worse and worse and worse. I mean, obviously the markets are down today, but literally Tesla's stock is down over 3x what the Nasdaq is down, and it is for no other reason than simply Elon Musk sending that tweet saying basically he believes that Tesla's stock price is too high, okay? So, in this video, we're going to discuss if Tesla's stock price is too high. Does Elon Musk have a point in regards to this? I've been doing company valuations for around 11, 12 years now. This is what I do. This is what I love to do. I love to figure out are stocks overvalued, are stocks undervalued. Sometimes you just have to figure out based upon where the market's trading at a particular time. Sometimes you have to compare them against peers. And in this video, we're going to compare them against some of their peers out there and really get to the bottom of if, Tesla stock is overpriced or underpriced, okay? Let me be very clear. Just because Elon Musk says he thinks the stock price is too high, it doesn't necessarily mean the stock price is too high. He could be right on that. We'll find out in this video, okay? I hope you guys enjoy this. Don't forget to go ahead and smash that thumbs up button. As always, that lets the algorithm know that you guys enjoyed this video. For every one thumb up, that will hopefully be one share of Tesla you will own in the future. And leave a comment on what your opinion is on this. I love reading through your guys' comments, in regards to, a subject like this, if Tesla stock price is overvalued, undervalued, okay? All right, guys, let's get started, okay? So, Elon Musk, he's a brilliant businessman. He's got a lot of things in common with, some other great businessmen out there, Bill.
Now, there's an event of biblical proportions happening on May 20th, and it's nowhere seen on the news. Fox News isn't talking about it, CNN isn't talking about it. None of these news events are talking about the event that's happening on May 20th. Now, this event is going to cause a tsunami-sized wave of low-risk opportunity for the ordinary man to turn $1 into $121 in a short period of time. And there's a reason that the news isn't talking about this event. It's the same reason why billionaires, the government, Wall Street are lying to your face about this event, but going ahead and making billions on the back end behind your back and lying right to your face about it. Now, I created a video report for you to educate yourself on exactly what's happening on May 20th. Who are these people that don't want you to know about this event? Why they're lying to your face about it and not talking about it? And on top of that, I'm going to show you exactly how to position yourself the right way to profit from this upcoming event of biblical proportions. Now, historically, this event has caused a huge wave of low-risk opportunity for people who get in right at the right time and who get in are going to profit greatly. I'm going to show you exactly what this event is, what this asset class is, and who are the people who are hiding this information from you. So go ahead, watch this free video report right here, click that button, and we're going to show you exactly what this secret asset class is and exactly what event is happening on May 20th that's going to cause a tsunami-sized wave of low-risk opportunity for the ordinary man to turn $1 into $121 in a short period of time. Everything that I refer to on this video report, you can go ahead and double check it for yourself. The reason you're seeing this from me and not from the news because they don't want you to know about this event that's happening on May 20th. So go ahead, click this button right over here, and watch the free video report.
Learning how to trade stocks was one of the best decisions of my life. This holds true even during these turbulent times. In fact, market volatility brings greater opportunity for profits in a shorter amount of
Bill Gates, Jeff Bezos, what do these guys have in common? All have very different businesses, but they're all worth tens of billions of dollars or more. They're what we call super billionaires, okay? They're not just like a regular billionaire that's got like 1 billion. No, these guys have tens of billions, if not 100 billion plus in wealth, okay? It's unbelievable. These super billionaires, they're known for being what? Great businessmen, right? They create, one business or maybe even a few businesses that are unbelievable, game-changing businesses that get, unbelievable valuations because they're some of the businesses that change the world, right? Microsoft, one of the, most important companies of the last, 30, 40 years. Tesla, on its way to becoming one of the most important companies in the world over the next 10, 20 years, right? Along with SpaceX and some other companies Elon Musk has started. Jeff Bezos, obviously with Amazing's on, right? Game-changing company. That's what these guys do. They are not stock pickers. They do not do company valuations. That's not what they do. That's not what they're known for. They're known for being great businessmen, and there's a big difference between being a great businessman and creating a business that's worth $1 billion or many billions of dollars and being a stock picker, someone that looks at a stock and says, this is a fair valuation, this is an undervalued valuation, this is an overvalued valuation. There's a big difference between that, okay? Mark Zuckerberg, if we took a lot of the young billionaires on the come up, right? Well, Zuck's in his 30s now, right? Evan Spiegel, I believe, still in his 20s. He's the one that founded Snapchat. He's worth many billions. And in terms of Zuckerberg, he'll likely be the richest man in the world probably within the next 10 years, right? You look at these two guys, man, great businessmen. They created some unbelievable companies. They're not stock pickers. So just because you're super rich and you created an unbelievable business that's worth billions or tens of billions of dollars or hundreds of billions of dollars, obviously in FB's case, right? Just because you did that doesn't mean you know anything about how to value stocks, okay? People just assume like if somebody's rich, they know everything, and that's just completely false, okay? It's just completely false, okay? There's really only one guy in the world that, in my opinion, has proven he's the GOAT at business and the GOAT at stock picking, and that is the great Warren Buffett, right? Warren Buffett has proven he's phenomenal at running business, which is Berkshire Hathaway, and phenomenal at stock picking. If you just look at his history over the past 50 years, literally you got 50 years to look at least of business and stock performance, it's amazing what he's done. It really is. He's done an amazing job with building business and picking stocks and understanding valuations, and that's why, I look up to Warren Buffett as really the GOAT, because he's really the only guy that has proven he can do that. Absolutely amazing, okay? So Elon Musk could have came out today, he could have said, Tesla stock's as expensive as a Louis Vuitton bag. He could have came out and said, Tesla's cheap like a McDonald's McDouble burger, okay? He could have said either one of those things, and I don't care, man. I literally don't care. I'm not buying or selling a Tesla stock based upon if Elon Musk says Tesla stock is cheap as dirt, or if he says it's as expensive as a Tesla Roadster when it comes out next year, okay? Literally, I don't care. Because at the end of the day, Elon Musk did not get to where he's at because he can figure out stock valuations. I can promise you that. Elon Musk got to where he's at here today because he's phenomenal at raising money, literally the best person in the world at raising money. Second thing is, amazing man at building businesses. That's why Elon Musk is super rich, not because he's successful at stock picking, okay? I can tell you that. There's just kind of self-explanatory there. So literally, I don't care, what Elon Musk has to say about that. I care about what Elon Musk has to say about Tesla's business and what's going on with the underlying business, okay? But at the end of the day, maybe Elon Musk does have a point. Is Tesla stock too expensive, okay? So, here's Tesla's numbers before the tweets, okay?
Are you looking to step up your stock trading strategies? My name is Charlie Moon and I teach people to trade stocks. I went from playing poker professionally to trading stocks professionally by using 3 simple patterns. And for a limited time, I'm holding a free webinar to teach you these 3 easy strategies that I've taught to over thousands of my students. These are the same strategies that have got me featured on Fox Business, BNN, and TD Ameritrade Network.
Charles Moon is joining us. He's a strategist at Prosper Trading Academy.
Charles Moon of Prosper Trading Academy joins us now.
We'll bring in Charles Moon, who's joining us, senior market strategist of equity.
Listen, if I can learn these strategies as a poker player with no college degree, then you can too. I pride myself on being able to simplify stock trading so that anyone can learn these strategies and patterns and be successful. So what's so special about these 3 strategies that makes them so successful? That's why you'll have to sit in on this. Now, market capitalization of 130 billion, that doesn't really tell us much, okay? And whether a company's got $1 billion market cap or $1 trillion market cap, it doesn't really tell us too much, okay? We need to look at numbers such as forward P, which is my favorite number to kind of look at in regard to if a company is overvalued or undervalued. You also got to think about growth rates likely for a company, and then you got to look at something like a price to sales ratio, okay? And these numbers are all before the tweet was sent out, okay? These aren't like adjusted numbers now that the stock's gone down a bunch, okay? Because I want to give, obviously Elon Musk the benefit of the doubt. So it would be kind of unfair for me to, look at numbers that are now numbers, based upon the fact that the stock's fallen 10% since he sent out those tweets, okay? So, before tweet numbers, Tesla stock's trading at a forward P of 123, and just if you look at that raw number, it seems really elevated, right? Most stocks in the stock market trade at forward P's in the 20s. So to trade at a forward P, and keep in mind the stock market might be a little rich value as it is right now, which I'm 100% in that camp, right? But 123 definitely looks expensive on the face. We'll dig a little deeper, okay? Price to sales ratio of 5, okay? Now, so let's go ahead and write those down. Tesla, price to sales ratio of 5, which basically means that the price of the stock versus their revenues, forward PE, that's their likely EPS versus their stock price, okay? 123, right? So, somebody might say, well, let's compare it to something like an Apple, okay? I think it's a bad comparison. I don't think they should be compared to Apple. I mean, Tesla's going to way outgrow Apple in future years. Apple's an amazing business model, an amazing company, but the fact is, Apple's massive growth days are behind the stock, okay? But, somebody might say, let's compare it to Apple, okay? So, Apple trades at a forward P of 23, a price to sales ratio of 4.6, 4.7, somewhere around there, okay? Let's go ahead and jot Apple down, price to sales ratio of 4.6, forward P of 23. Obviously, if you compare those two, especially on forward PE, Tesla looks really, really expensive, except for the fact that Apple's been making crazy profits for a long time, and Tesla's just starting to reach profitability. Once again, don't feel like those are a good match, but whatever, okay? Somebody might say, let's compare them to General Motors, okay? GM. I think this is a joke. I think this is an absolute joke to compare General Motors to Tesla, in my personal opinion. I understand some people want to do it, but in my personal opinion, they just shouldn't be compared. GM, we don't even know if they're going to be around, to be completely honest, in 10 years from now. They have to try to, convert over to electric vehicles, which is a whole new wave. They have to nail self-driving vehicles, and they have to try to keep up with the pace of innovation that Tesla has. I don't know if General Motors is going to do it. I'll be honest. We'll see. But anyways, okay? If somebody wants to compare GM, whatever, okay? But GM trades at a forward P of 9, about 9.5, and a price to sales ratio that looks insanely low of 0.23 on GM, okay? This stock looks dirt cheap on its face value, okay? So let's go ahead and write GM down. Price to sales ratio of 0.23, it's unbelievably low, and a forward P of 9.5. So obviously, if you're comparing Tesla to GM, Tesla looks ridiculously overvalued, okay? But one of these businesses is increasing their business massively and disrupting the entire industry. Tesla, and one of these businesses has real questions if they can even, be around in 10 or 15 years, and that's General Motors, okay? So I don't think those are really good comps, but whatever, okay? So what stocks should Tesla actually be compared to, okay? And some of the companies that will come up in a situation like this will be Amazon, Netflix, Shopify, okay? Companies that have big growth ahead of them and are changing industries. Those are the stocks that a lot of people are going to want. These are the type of stocks you got to compare Tesla to, because Tesla is what? Growing massively, will likely continue to grow massively, but it's not just that. They're changing industries. They're changing literally, Tesla's changed the game when it comes to automobiles. Every single auto manufacturer out there now is having to create electric vehicles. Every single one of them is like, oh, we're investing heavy in electric vehicles of the future. If it wasn't for Tesla, I wouldn't be that way. Believe me, okay? So let's start comparing them to some of these companies. Amazon.
Learn to trade stocks was one of the best decisions of my life. Yes, this is true even during the current extreme market conditions. This global crisis has been a hard shock to our economy. The Dow went from all-time highs to losing 35% of its value in less than 30 days. Unemployment rates are soaring. Analysts fear a looming depression. Everyone has a right to be concerned. The talking heads on financial news only agitate the situation. Allow me right now to be a steady, hopeful voice during this crazy time. Hi, my name is Pete Renzulli, and I've been trading stocks for over 20 years. I ran my own firm on 34th Street in New York City with over 300 traders reporting to me. Together, we traded over 500 million shares per month profitably. If you were paying attention during the 2008 stock market crash, you know that level-headed investors made a fortune during this time. Understand that market volatility brings greater opportunity for profits in a much shorter amount of time. Despite what is happening in the world right now, I don't want you to miss out on a window of opportunity to possibly gain a small fortune for yourself. Now more than ever, I want to use my 20 plus years of experience to be your guide during these uncertain times. So today, I'd like to invite you to join my community. Each morning, 2 hours before the stock market opens, I send an email with my personal game plan. Each issue tells you exactly which stocks I plan to trade and how I plan to trade them. It's easy to follow along.
Amazing company. That's why I call it Amazing Zone, right? Changing the game across the board, not just in retail, obviously, they're seeing a lot of retailers, but they also own platforms like Twitch, okay, live streaming. They own Whole Foods business. They have their Amazon Web Services business, which is a cloud company that's just completely changing the game. And so when you look at Amazing Zone, and obviously it's led by Jeff Bezos, one of, arguably the best businessman in the world, when you just look at it, it's an amazing company doing amazing things. And it's a pretty fair comp to somebody like a Tesla. So if you're looking at Amazon trades at an 83 forward P, which once again, that's going to look super rich if you're comparing against the stock market in general. Amazon shouldn't be compared against the stock market in general, though. Keep that in mind, okay? And the price to sales ratio of 4.3, okay? Let's go ahead and write those numbers down. So, price to sales ratio, they're pretty dang close. Amazon's a little cheaper, but not that much. And 4P, Amazon's quite a bit cheaper, but it's not like crazy cheap. It's an 83 versus 123, okay? So, that's Amazon. What about Netflix, okay? Netflix, ticker symbol NFLX. Obviously a company that's been changing the content game and, has put, cable companies and satellite companies in a real problems, put it that way. And they're a company that, everybody's gunning for. Yeah, Apple, Google, Disney, all these companies, all these big dog companies are trying to have what basically Netflix has. It's an amazing company, right? 4P on this one of about 66, price to sales ratio of 8.9. A game changer in their industry, absolutely. So if we look at Netflix compared to a Tesla, price to sales ratio looks pretty dang rich, okay? Once again, Netflix at an 8.9, Tesla at a 5. Okay, Tesla's actually cheaper there. But on a 4P, Netflix is about half as expensive as Tesla, obviously, with Tesla being at 123, Netflix being at a 66, okay? So, you can make arguments kind of both ways on that one. Shopify, okay? Ticker symbol SHOP. You want to talk about a richly valued company, okay? Let's look at Shopify. Forward PE of 3,333. Holy smokers, okay? 3, okay? That's a lot of threes in there. A price to sales ratio of 44.44. You know what? You guys know I love when it's a bunch of numbers together. Maybe that's a sign that I should buy Shopify stock. I don't think so, okay? I don't think so. That valuation is one of the most insane valuations I've ever seen. You know how much Shopify has to grow in the future just to begin to justify that valuation? It's insane, okay? So if you compare Tesla to Shopify stock, Tesla looks like the cheapest stock in the history of mankind, right? Tesla trades at a 5 price to sales ratio. Shopify trades at a price to sales ratio of 44. My goodness. And Tesla trades at a 4P of 123. Shopify trades at a 4P of 3,300. The most insane thing I've ever seen, okay? So here we are. We have all the numbers now. We have Tesla, Apple, GM, Amazon, Netflix, Shopify. Here's what I kind of think about this, okay? So in my...
No matter your financial fingerprint, we'll help manage your investments in the way that's right for you. TD Ameritrade.
opinion, most of these companies we just went through are bad comps, okay? Apple we talked about. You can't compare Apple to Tesla. Tesla's gonna way outgrow Apple, okay? GM, give me a break. Like, just give me a break, okay? Netflix, I don't think they're really necessarily the best comp if you're comparing them against Tesla, because remember, Tesla's disrupting several industries on several fronts and will likely continue to. I'm not so sure Netflix is kind of a more of a one-trick pony. There's nothing wrong with being a one-trick pony. They do it amazing, right? But at the end of the day, you sign up for Netflix service, and that's it. There's like no other products on top of that. There's no other type of experiences. It's just a one-trick pony. Once again, nothing wrong with being a one-trick pony, but the fact is, Netflix is a one-trick pony, okay? And Netflix's best days are honestly right now, right? With obviously Rona going around, Netflix is kind of, they're having their best situation possible going on right now, right? Shopify, I don't think you can really compare Shopify to Tesla once again, because Shopify is one of those stocks that is really focused on disrupting one industry, which is e-commerce, right? And also Shopify, the valuation, it's so ridiculous on Shopify. I don't even think it should be compared to Tesla. Like, that valuation is just crazy, okay? So at the end of the day, I think Amazon is I think it's the best one you can really compare to Tesla, right? Disrupting multiple industries, as we spoke about. Tesla doing the same thing, right? Electric vehicles, autonomous vehicles, right? Solar business, battery business. They're disrupting on many different fronts, and as Tesla continues to grow, they'll be able to add more and more employees and add more and more managers and be able to basically disrupt more and more industries, because that's what Tesla is at their core, okay? So I think Amazon's the best comp, and once again, you look at those numbers, yeah, Tesla might be a little richly valued, especially if you look at the 4P, price to sales is pretty in line with each other, but at the end of the day, although Tesla trades a little rich to Amazon, I think honestly Tesla's going to well outgrow Amazon over the next 5 years. I'm talking revenue percentages, and I'm talking net income percentages. I'm fully confident that Tesla will outgrow Amazon. Keep in mind, Tesla's just starting to get to profitability. Keep in mind that Tesla's just starting to really scale their business, right? Model 3 launched a couple years ago. That's the first product that's really allowed Tesla to start scaling their business. Model Y is ramping this year, right? Obviously, the Shanghai Gigafactory just opened like a few months ago. Berlin Gigafactory coming at some point in 2021. So when you look at Tesla's business model, this is really just starting to, get to a place where it's going to start hitting like mass levels, and the numbers they're going to start putting up are amazing. Where Amazon's been putting up amazing numbers for a decade now, and they've been putting up some very impressive profit numbers over the last few years. And so when I look at Tesla, I just see kind of a younger version of Amazon at the end of the day. So although Tesla trades a little rich to Amazon, I just think Tesla's going to well outgrow Amazon over the next 5 years if you're looking at revenue growth, and especially if you're looking at net income percentage growth. And so for that reason, it's hard to look at Tesla as, the super richly valued stock at the end of the day, okay? Now, obviously, Tesla is a growth stock, and when you're investing in growth stocks, you are taking a level of risk that growth could go away. But when I look at something like Tesla, for their growth to completely go away, I think they would honestly need some massive competition to really get in their face, and we haven't seen that in the space, okay? So that's just something to kind of keep in mind there, but it is more risk than buying Coca-Cola stock or something like that. Let's be completely honest about it. Coca-Cola, good luck growing your money. Tesla, should be pretty interesting. Good news, folks, okay? I have some good news for you, okay? If you're somebody that has been looking to get in Tesla stock, or you're somebody that has been wanting to add more shares of Tesla stock, you might get an opportunity this summer, okay? I would say there's a pretty high probability we're going to see a big fall in the stock market. It's not for sure. It might not happen, but if I had to put odds on it, I would say I would put at least a 70 to 80% probability we have a big correction, if not another stock market crash, in the market this summer, okay? And if that happens, likely Tesla stock will get hit along with it, especially when you add on fuel to the fire like Elon Musk tweeting today that he thinks Tesla stock is too high. So if you're looking to potentially get in, you might get your opportunity. We'll see. Nothing's for certain, but we just saw where did Tesla stock head when we had that last stock market crash, which was 2 months ago. Tesla stock fell very quickly from the 900s to it was actually trading under 400. It was actually trading in the 300s. It was only for like a day or two. It did that, but it did get down to there. So Tesla's one of those stocks that's just unbelievably volatile. Now, do I ever think Tesla could potentially get down to the 200s? I average cost in the public account is $227 for my Tesla shares, the 150 shares I have in there. Do I ever think it's going to get down there again? Probably not. I'll be completely realistic. Like, even if we have a stock market crash over the course of the summer, I don't think Tesla stock will get down to 227. You know, all things are possible. It is a stock market. Prices are crazy, but I don't think it'll ever get down there again. But could I see a potential where Tesla gets down to 300, 400 a share? Absolutely. If we get a really weak stock market, we get a lot of panic in the market, and you're adding fuel to the fire with Elon Musk tweeting out something like this today, I think there's very much a possibility, at least, Tesla stock could hit those prices again. And so that's kind of exciting news for a lot of folks out there that have, not added Tesla shares, but have wanted to, or added some Tesla shares, but they just didn't invest heavy enough or something like that for what they wanted to actually hold in this company. Because I can certainly understand if people don't want to buy more Tesla stock in the 700s, 800s, or 900s, because, when the stock was just at 180 a year ago, to all of a sudden pay 700, 800, 900, it's not the easiest thing to do out there, and I can definitely understand that. But I want to hear your guys' opinion down there in that comment section on Elon Musk's tweet and Tesla stock in general. Let me know if you think the stock's overpriced, underpriced, anything across the board. I'd love to hear from you guys. Always don't forget to smash the thumbs up button. That makes me feel good, okay? Thank you for watching. Have a great day.
Steve and Dave use eToro to trade cryptocurrencies. Steve has a watch list for promising breakout coins. Dave has a watch list too. So why is Dave just as good at
Alright guys, we're finishing up earnings madness here this week, and we're going out with a bang with my 3 largest stocks in my entire portfolio. So that's going to be number 1, Microsoft, my absolute largest favorite stock out there. Number 2 is going to be Amazon, which they just actually announced that they're going to be spending their profits to fight that global issue. So that should be very interesting. We'll cover that. And then number 3, Tesla, who actually has some controversy in their last earnings call. So we're going to be going over the earnings of all these 3 companies, and I'll be sharing some additional thoughts on each one of them. But should make for a very interesting video. I hope you guys enjoy this. We got a lot to cover. So let's go ahead and kick things off with Microsoft. By the way, I'm recording this on Thursday night, and I will be posting it on Friday morning. But when looking at Microsoft, they reported their earnings yesterday after the bell, and initially the stock was climbing in after-hours trading, but they ultimately ended the day today about flat after climbing over 4% yesterday before the earnings release. And I think part of that has to do with the fact that the overall market was down today after climbing almost every day this past week, because in all honesty, Microsoft absolutely crushed their earnings. In fact, not only did they beat current estimates, but they actually beat the numbers that were expected before this whole global issue even started. And I've been saying this all along, that Microsoft would be benefiting heavily from people using their services as they're forced to stay home, which we'll talk about more in just a second. But when looking at EPS, the new estimates were for $1.26. The old estimates were for $1.33, and yet Microsoft actually beat them both, reporting $1.40, which is a beat on the new estimates of 11%. But it doesn't stop there. When looking at revenue, the new estimates were at $33 billion, the old ones were at $34 billion, and Microsoft came out and beat both of them again with $35 billion, which is very impressive. You have to keep in mind that Microsoft is already a gigantic company doing over $125 billion in sales and almost $40 billion of net income last year alone, and yet year over year they still managed to grow their sales in the quarter by 15%, operating income by 25%, net income by 22%, and EPS by 23%. That is insane growth for a company this size. And again, despite the economy being in the toilet right now, a lot of that damage was offset by the services that people are using at home. According to Microsoft, they claim that these last 2 months saw a digital transformation that would normally take 2 years to happen. That's pretty crazy. As a result, they stated that their commercial cloud revenue grew by 39% year over year, and that the global health issue had only a minimal impact on the quarter, with productivity services and cloud usage increasing, specifically in areas like Teams, Azure, Virtual Desktop, and security, all of which are used heavily to work and learn from home. They did, however, mention that towards the end of the quarter, they saw a slowdown in licensing from small and medium-sized businesses, which does make sense as so many of them are just trying to basically fight off bankruptcy at this point, along with a reduction in advertising spend on their LinkedIn platform, which is something that we also discussed in the Google earnings when we talked about how advertising spend is almost certainly taking a big hit right now as the economy continues to crash. They also stated, though, that they will probably not see the full effect of this global issue until future periods, which is just their way of saying that nobody really knows how all of this will play out. But as of right now, there's supply constraints in the country where this issue started that I'm not allowed to name directly here on YouTube. Those supply chain constraints, though, are improving, and the quarter overall was a major success, with parts of their business seeing explosive growth, like Office 365 growing at 27%, LinkedIn, which I think will be huge in the future and was one of the smartest acquisitions I've ever seen, growing at 22%, Dynamics and Cloud Services growing 20%, Dynamics 365 49%, Server 32%, and then check this out, the second largest cloud platform in the entire world, only behind Amazon, Microsoft Azure, growing at 61% still. That is very impressive to still be growing at those rates. Of course, that success has led to them trading for almost a record high with a very rich valuation that is significantly higher than the sector on almost any metric you look at. And at these higher prices, the dividend yield is also pretty low at just over 1%, although it does still carry some very nice growth metrics. But that's ultimately the story with Microsoft, is this amazing company that does trade for a premium price tag. Now, I probably won't be picking up any more shares at this time because it is already my largest stock, but during those March lows, that was a great time to be buying this amazing kind of foundational, very solid, very stable stock. But let me know down below if any of you guys did pick up any shares during those March lows, or if you're kind of thinking about buying right now. If I didn't already own it and I was buying at these higher levels, I definitely would only do so in very tiny amounts, and I'd probably be waiting for an overall market drop or market correction to kind of drag it down and then buying heavier, because it is trading at a pretty high valuation. But over the long term, I think this is a really great stock to own, and I'm definitely holding on to all of my shares for the foreseeable future. Alright guys, moving on to stock number 2, and this is my second largest stock in my portfolio, and that is of course Amazon, ticker symbol AMZN. And they just announced Q1 earnings after the bell, and they also gave some surprising news that they're actually going to be spending their second quarter profits to deal with this global issue, which did take a lot of people by surprise. So let's take a look at what they had to say and everything that happened, and I'll share my
Motley Fool issues one stock for the Self-Driving Revolution report. Sign up now and get free access. Hi, I'm Rex Moore with the Motley Fool in front of BMW's self-driving exhibit at CES in Las Vegas. Now, have you ever wondered how to invest in this revolutionary technology? Well, I'm going to give you
thoughts on all of it. Well, first of all, Wall Street doesn't seem to be too happy with the news, as the stock actually dropped after the release. Still, this currently leaves them trading for just a little less than a record high after climbing by over 26% so far this year alone, given how much they're benefiting from people staying at home and therefore shopping online, which led to a great quarter and will likely lead to a gigantically stronger Q2 than almost every other company out there right now, which we'll also talk more about in just a second. But going through the numbers, profits are definitely down right now, as they not only missed EPS estimates, but they also shrunk by almost 30% year over year. Now, part of the reason for that is because Amazon has been investing heavily into one-day shipping, along with their growing international business and other initiatives too, and they're even increasing their workforce and paying higher wages with everything going on. But this is just typical Amazon to me. They do this all the time to reinvest in the business, stay competitive, and even pay less in taxes sometimes. But when you look at the actual profitability of the company, they generate plenty of free cash flow every single year and will likely continue to do so well into the future, in my opinion. Now, sales were the complete opposite of the EPS results, as they not only grew by 26% year over year, but also beat estimates e-commerce by a couple $billion as well. Meanwhile, Amazon Web Services, which is by far the most profitable part of their business, grew sales by 33% year over year to a new record high, while also growing its profits by close to 40% year over year, which is very impressive for already being the global market leader. And clearly that was boosted by the stay-at-home movement, as it even helped the NFL host the first ever remote draft. Now, looking forward, they did provide some guidance for Q2, saying that they expect sales to increase between 18% and 28%, which is just insane to think about, since most other companies out there will almost certainly see gigantic declines, with economists projecting a GDP drop of as much as 40% in the quarter, which is by far the largest decline that we've ever seen in our entire history. And yet, Amazon is still expecting to see huge growth of as much as 28% for a company that already did close to $300 billion in sales. That's billion with a B in just the last year alone. That's really impressive. But going back to that guidance, they also noted that despite the large growth in sales, they actually expect an operating loss of as much as $1.5 billion compared to a profit of over $3 billion the year prior in the second quarter. Sounds pretty alarming, right? Well, in the press release, I'm not joking, they literally wrote, if you're a shareholder, you may want to take a seat, which I thought was a little dramatic, but the reason they said that is because they plan to literally spend all of their second quarter operating income on dealing with the global issues. So that would be around $4 billion or more, and they would use it to build their own lab and develop their own testing capabilities. I'm guessing to be able to test all of their workers very quickly, but perhaps to also help the general public too, maybe selling them or providing them, I'm not sure. But they did also say that they will be sharing anything that they learn, so that could be a benefit. But it will also go to funding higher wages, more protection equipment, better cleaning protocols, and allow for more social distancing at their distribution centers. And look, if you want to know my feelings on this, Jeff Bezos basically summed it up for me when he said in the report, there is a lot of uncertainty in the world right now, and the best investment we can make is in the safety and well-being of our hundreds of thousands of employees. I'm confident that our long-term oriented shareowners will understand and embrace our approach, and that in fact they would expect no less. Okay, now let me translate what he just said. The world economy is getting destroyed worse than we've ever seen in history, and yet we're actually growing at unbelievable rates for our size, and we just hired another nearly 200,000 additional workers because of it. And by the way, we're still hiring more, as we said in the press release. So the best thing to do right now is make sure that our factories don't shut down because of carelessness. Our employees are literally putting their lives on the line to keep this company going, so the least we can do is skip one measly quarter of profits that in the long run nobody will even remember, and in turn we can provide much better safety and even better wages for our workers to ensure that nothing changes. And I 100% agree with that, and I think anyone who doesn't is really just being short-sighted, because right now we really need to do something to save the economy that just continues to get destroyed. And if some of these big companies want to go out and spend some of their profits to make sure that a lot of people get to keep their jobs and can also work safely, then I think they should absolutely do that. I think it's a great investment, and I think they should be applauded for it. Having said that, now this is again my second largest stock, and it is trading at really high levels, record highs. I just can't be a buyer at these levels, but on a market-wide dip or drop, I definitely would be interested in buying more of Amazon stock. Over the long term, one of the greatest companies out there in my opinion. Okay, moving on to stock number 3. This is my third largest, and that is of course Tesla, who a lot of people are talking about right now for, in my opinion, 3 primary reasons. One is that they just announced earnings that, in my opinion, were absolutely amazing earnings. Number 2 is that Elon Musk did share some personal opinions during the earnings call that a lot of people found to be controversial. So I'll share my thoughts on that too. And then number 3 is that a lot of people are kind of wondering how this global issue will affect Tesla going into the second quarter and through the rest of the year. So I'll do my best to kind of quickly touch on each of those. Points. Okay, starting with earnings, as Barron's puts it, Tesla just keeps surprising everyone, and the bears hate it while the bulls are loving every minute of it. When looking at EPS for the quarter, last year they lost almost $3 a share. This year, analysts were expecting another loss of 36 cents per share, and instead Tesla came out and crushed those numbers with $1.24 of profit per share. Turning to revenue, they not only beat estimates, but they grew those sales by over 30% year over year, which is very healthy growth, especially considering all the headwinds that they've had to deal with, like the temporary shutdown of their Shanghai plants, the horrible first quarter that specific country had as they were on lockdown, with their reported GDP actually shrinking for the first time in nearly 3 decades, the fact that here in the States, the Fremont factory had to eventually close down, which led to less deliveries at the end of the quarter, which is typically when Tesla actually tries to make a push to meet those estimates. They typically try to increase their deliveries there. And on top of all of that, they continue to move away from the more expensive Model X and S over to the cheaper 3 and Y, and the result is that their average selling price obviously takes a hit because of that. So to beat on both the top and bottom line and also be profitable while doing it was very impressive. Now, a couple other things that they touched on in the earnings. One was that they continue to make progress on the Fremont and Shanghai plants with incredibly ambitious plans to start delivering Model Ys from the new Germany plant that hasn't even been constructed yet, and they want to do that by 2021, which is crazy. And speaking of the Model Y, I've always said that I think it will do bigger numbers than even the Model 3 because of the potential market size, and they showed even more evidence of that with this chart here of the market potential versus the numbers that they're currently doing, and you can see that there's just huge room for growth there on the Model Y for it to become a massive player over time. They also showed a chart on how they continue to improve battery technology and range while the competition just continues to fall behind. And there were honestly a ton of other things worth talking about, but I don't have enough time to dive into them in this video, so I'll just leave that for a future video when I discuss their progress. But just to finish up here, I want to quickly cover those other 2 points about the earnings call and what the rest of the year will look like. Well, as far as the comments for the earnings call goes, you can't really take seriously what the media is saying about this because they're incredibly biased and are willing to do anything they can to make Tesla look bad. But here's a ridiculous article from CNBC that tries to make it seem like Elon was practically foaming at the mouth while cursing and ranting during the earnings call, and it's so stupid. All I can say is listen to the call yourselves and form your own opinion on this. But in my opinion, he was actually very calm and was just voicing his frustration with how the economy is getting destroyed right now and how that's also going to destroy lives, and that's a fair point. And I'm not saying that I agree or disagree with everything he said, but to act like people can't have their own opinion on this or that they shouldn't be allowed to is absolute madness. We're all in this together, and to pretend like the economic impact of all of this shouldn't be considered or at least even be talked about, in my opinion, is kind of crazy. But again, that's just my opinion. Let me know what you guys think down below. But anyway, I don't want to touch on that too much because I know people get very heated on this one. Anyway, moving on to the other point, what happens to Tesla going forward this year? Well, seasonally, we typically see vehicle sales recover after the first quarter, but that's very unlikely to happen this time around because of the situation that we're in. If we take a look at U.S. vehicle sales for the past year, we can see that they just completely fell off a cliff in March, dropping by millions of units just in the past month alone. Now, you could argue that that's because of the lockdowns, and once they're lifted, sales will return. And yeah, there might be some truth to that, especially in the second half of the year, but you still have to keep in mind that we've seen a record 30 million new people file for unemployment in just a little over a month. And if a lot of those jobs don't come back soon, I'm not sure there's going to be a big market out there for new and expensive vehicles, at least not until maybe next year, where I think we'll really start to see a bigger recovery. But because of all this uncertainty, Tesla was forced to put any guidance on cash flows on hold until the second quarter, where they'll obviously get a much better idea of how badly they're going to be affected by the weak environment and what the governments are saying about opening up the economy throughout the year. Now, you might recall that their previous guidance for deliveries was 500,000 this year, which would be a 36% increase year over year. But after having delivered 88,000 units in Q1, they will need to deliver close to 140,000 on average in each of the remaining quarters just to hit that target, which, by the way, those would all be record quarters. So considering that Q2 will very likely be much worse than Q1 because of the shutdowns and the lockdowns, I just don't think that we'll see that high of a number for this year. And as a result, Tesla did choose their words very carefully in the Outlook section of the release, and they just simply said that they have the capacity to deliver that many vehicles, but aren't willing to actually commit to it yet. But thanks to their high liquidity, which we have talked about in previous videos, they're still investing regardless on the product roadmap and capacity expansions. So overall, I just really don't think that anything has really changed for Tesla's long-term story, despite everything that's happening here in the short term. Now, I do think that this will be a very rough year for them, especially in the second quarter, and I wouldn't be surprised if that gets all the short sellers to come out of hiding from their caves and start screaming that Tesla's going to go bankrupt for the millionth time just because they don't make a profit. But again, over the long term, this remains one of the most innovative, one of the most exciting companies out there, in my opinion. And if the stock was to crash during this year, which I'm not saying it will, but if it does, I'll definitely be there to be picking up even more shares. But as it stands, my third largest stock, I'm still very much so a long-term believer, and I have no plans on selling my out of my position anytime soon. And again, if it drops, so be it. I'd like to pick up shares at lower prices anyway, because this is really a very long-term story for me and for my portfolio. Anyway, that does it for today's video, guys. What did you think about all these three stocks and the news that came out? I'd love to hear all of your thoughts down below. More videos coming for you guys, so stay tuned. Thank you for all the support. Hit the like button if you enjoyed the video, and I'll catch you guys in the next one. Stay safe out there, and let me know how you're doing down below, health-wise, financially. I'd love to hear everything that's going on. Hopefully you're doing well out there, and all of your families as well. But with all that said, I'll catch you guys in the next one.
$50 into $15,314 in 4 months. $200 into $114,272 in 2 months.
Good day, fellow investors. Over the last week, I must have received more than 100 questions from emails, from Facebook, from comments here. Sven, the market is likely going to crash over the next 6 months because there is the biggest economic recession since ever coming, insolvency issues, debt issues, so greatest economic collapse. We are at the end of the debt cycle. Everything is wrong with things that can go wrong. Stocks are going to crash and we should sell. What do you think about it? And everybody is so scared about what's going to happen. Well, I have no idea what's going to happen. What's going to happen depends on what happens in the future, but I can tell you what is the market pricing in now. What are the positives and the negatives, and why the stock market is up 30%. I can tell you that, and we're going to discuss that by discussing the current news, the potential future news, the financial markets, the bond market, the stock market, the Fed, ECB, Bank of Japan, in between, balancing interest rates and doing whatever it takes. And then at the end, you will see how this data that summarizes what the market is pricing in fits your strategy and what you can do it about. What can you do about it? After all, it's all about you. It's not about the markets. And then you might find, okay, what's the best answer for me? Before starting with the content, if you enjoy this analytical discussions on markets, the risk and reward, please click like and consider subscribing to the channel. Thank you. Alright, so let's start immediately with the news. Bad news, unemployment fillings crossed 30 million over the last 5 weeks. That's really terrible news. On the other hand, let's look at the better news. If we look at the new coronavirus cases over time, we have prevented the exponential curve when the lockdowns started, and we are already seeing flattening line and the declining line, which is positive, and I might even get a haircut next Monday as the lockdown is easing. Further, also very interesting from Google Trends, what are people searching for now? When will flights resume in the UK? In Italy, they are wondering, okay, when we will have summer, when we can travel again. And if we look at the situation on Google Trends, coronavirus research, search terms, has peaked exactly when the market had bottomed. So we are there 21st, 22nd, 23rd of March, peak panic, peak negative thinking, and since then we see high improvements globally. This is worldwide Google Trends. But keep in mind now, what was the news a month ago? This was the news a month ago. So panicking, what can happen, how many people will die in the United States, in Great Britain. That has fortunately been prevented, and therefore the market is pricing other things, is pricing differently, and a little bit of panic. And we are 30% up since the doomest days a month ago, a little bit more than a month ago. And then when you look at the positives, the US stocks post best month since 1987. So gloomy outlook, depression, recession, whatever, best month in 30 years. Isn't that insane? Well, let's see what is the market pricing in. That's the...
There's a medical tech company called HeartFlow.
Yeah.
If you invested $1,000 in that one, you could have turned it into $1.7 million. And don't even get me started on this one. One of the biggest ones out there, Carta. You probably never heard of it, but if you took $1,000, you could have multiplied that into $4.3 million. Imagine that. If you took $1,000 out of your bank account, just put it in one of these companies, a few years later, you could have turned it into over $4 million.
Sounds great,
yeah,
but obviously overwhelming. A lot of people feel like they can't get in the game. We put together a book here. You want to tell us about it?
Yes, 6 startup sectors that are going to dominate the market in 2020 and for the next decade coming up. I mean, these are the sectors that every investor needs to know about. You need to get in early on these things. Not only where these opportunities lie, but how can you invest in them? That's one of the most important things. How can you actually put your money into it?
Get your hands on this booklet. Simply click the link below, enter your email, and we'll ship it off to you right away.
Learning how to trade stocks was one of the best decisions of my life. When I began earning more in just a couple of hours than I did in an entire month, that's when I knew my life would never be the same. Wouldn't it be awesome to see exactly how I do it? I'd like to give you my best trades each day, delivered straight to your inbox, no later than 7:30 a.m., absolutely free. Each Monday through Friday, I send an email detailing which stocks I'm going to trade and exactly how I plan to trade them. If you'd like to receive these Smart Money alerts, just click the link below. Here's a few testimonials from current subscribers. We get success stories like this every day, and it never gets old. Hi, I'm Pete Renzulli, and I've been trading for over 20 years. I owned and operated my own firm in New York City. 300 traders managed my capital, and on average, we profitably traded over 500 million shares per month. But it wasn't always that easy for me. Before the stock market changed my life, I worked at my family's deli in Long Island. Just feeling trapped every day, I knew I was underachieving. Maybe you can relate. But in April of 2000, I left the family business and I headed to Wall Street. And that's where I started to accomplish some amazing things. Flash forward to early 2007, and fate introduced me to a man named Sweaty. No joke, that was actually his name, Sweaty. What happened next was the collaboration of a lifetime and the birth of a revolutionary trading system. Sweaty was a veteran broker on the floor of the New York Stock Exchange with decades of experience. Together, we developed a process that's now known as the New York Method, a system that's netted me a small fortune. To this very day, I still use the New York Method to generate income without needing to be glued to my computer all day. Now I'm living in South Florida on the water, and life couldn't be better. I've helped thousands of men and women achieve stock market success, and today, I'd like to add your name to that list. Just click the link below to get my Smart Money alerts for free. Each update is emailed 2 hours before the stock market opens. And as a special fast action bonus to the first 50 people who sign up today, you'll receive a free starter kit that ensures you'll be ready to make your next trades with confidence. Don't delay, click now.
Key. Government action. We recently had ECB, Lagarde, making a press conference and you see, okay, boom, government action on top of monetary action. And even if the ECB president says euro area economy might shrink 12% this year, stocks we see have gone up. Why are stocks going up? Well, look at this. Pelosi says states and cities seeks $1 trillion in next stimulus. So the markets are expecting next stimulus, next more pumping money into the system to keep the employment high, economy as stable as possible, and to get out of this crisis as good as possible. So that's what the market is pricing in now, and that's why we are seeing the 30% recovery from the March 22 bottom. And that's something we have to think about and see, okay, what can happen next? Let's start looking at what can happen next. Alright, so what to price in? High stimulus, zero interest rates, extremely important for financial markets, improvement with the virus situation, easing of lockdown measures, so that's the positive to price in, versus 12% GDP decline for a year. That's really terrible. Holes in income and balance sheets from private, from corporate, from governments, fiscal deficits, huge fiscal deficits that might lead to insolvency, and a liquidity crisis like 2009. So these are the positive against the negatives, and we might also see, and hopefully not, a second wave with the virus. But then again, we have news like vaccines, and what will be the future news? It might be, okay, 3 million new jobs, 2 million new jobs as the economy eases out, gets out of lockdowns. We might see positive news. And the market always anticipates, so the market now is anticipating not the news, isn't focused on the news now, but on the future news where things improve, especially thanks to the money coming in from monetary and fiscal policies that we'll discuss in a moment. If we look at the Federal Reserve statement released 2 days ago, what are they discussing? Well, this is extremely important. The Federal Reserve is committed to using its full range of tools to support the US economy in this challenging time, thereby promoting its maximum employment and price stability goals. So they will do whatever it takes to promote maximum employment, which is at 3% of unemployment, not at the current 15-20%. So they will do whatever it takes to bring back employment, which means a lot of good news coming ahead. On the economy, the disruptions are there, we all know about them, have impaired the flow of credit to US households and businesses, and they are covering on that by stimulus, by giving loans, by giving money to banks to give loans to businesses. They are keeping their target range at 0%, let's say, and again, achieve maximum employment and price stability is their goal. And to support the flow of credit to households and businesses, they will continue to purchase treasuries, all other residential and commercial mortgage-backed securities, even junk bonds, whatever, they will do whatever it takes to support smooth market functioning, thereby fostering effective transmission of monetary policy to broader financial conditions. In addition, the open market desk will continue to offer large-scale overnight and term purchase agreements, and the committee will closely monitor market conditions and is prepared to adjust its plans as appropriate. So whatever it takes, they are there, they are ready, and that's something we have to keep in mind. What does it mean, whatever it takes? Well, we can simply take the example of Japan. So the Fed is looking at how the Bank of Japan printed trillions of yens over the last years, bought 75% of the ETFs outstanding, and how they can perhaps do that too. They have a monetary policy, purchase of ETFs and J-REITs. And if you look at that, they have more than 77% of ownership of the ETF market in Japan. The Bank of Japan is the top holding of the biggest Japanese stocks and businesses. That's a tool, and they might be following that. And this is something that is also a positive risk versus the negative risks that we have been discussing. We don't know what will happen. We have to be ready for anything. And now let's look at something even more important, yields. When it comes to pricing assets, it's all about the yield versus risk-reward. And then you can see these big fluctuations. And when the interest rates are so low, small changes in yields have a big impact on asset prices. As Warren Buffett says, if interest rates stay at zero for longer, and we have seen practically 10 years of zero interest rates now, then the value of assets is infinite. And that's something we have also to keep in mind as a positive. If we look at the yield curve, so 2013, if you lended the money to the US government for 10 years, your interest rate was 3%. Now, if you do that, it's 0.7%, or at 30 years, you get 1.35% per year. So you should be really crazy to give money to the government for 1.35%. This is why the Fed has intervened and they are buying the bonds. And then the money is switching from the bond market to other markets because this is the real yield. You have the nominal yield at the 10-year treasury, and you see here it is at 0.7%, bottom down right corner. But if you look at the real yield, accounting for inflation, it's minus 1.67%. So if you invest in treasuries, you are certain of one thing. You're losing money day by day, and you will lose money in 10 years, especially according to even normal purchasing power government measured inflation. That is insane, and therefore those that are smart are starting to look for other options to invest. If we look at negative yielding debt, it's more than 20% of the fixed income market globally. So we have government debt in Japan, government debt in Europe, and also corporate debt negative yields. Can you imagine negative yields? And breakdown of government bonds by yield, we see that 0.7 US 10 Treasury yield is among the better yields you can expect by lending money to governments. That's really insane, and that is why they are looking for other options to invest. On the left, the global bond market is 110 trillion. On the right, the global equity markets, with 57% of it in the United States, are 98.4 trillion. So imagine that these guys owning bonds simply say, okay, negative yields is not something for me. I'm going to switch my few trillions into stocks. And who will cover the whole? You have the Fed that will buy your bonds, that is happy buying your bonds and putting liquidity into the system. And then you say, okay, we have negative yields on the left side with the bond markets, better yields on stocks, or infinite value with stocks on the right side. And therefore, if you look at cumulative flows, a lot of flows went into bonds, a little bit less into stocks, but if you count that just 1 or 2 or 3 or 4 trillions go into the stock market, that's already a big plus, and that is why stocks go up or have been going up over the last month, because bonds are, like Ray Dalio said, a ticking bomb that pays you while you are sitting on it and while it's ticking, but when it blows up, it might blow you up too. 110 trillion to be blown up. Hopefully the central banks will cover for the holes so that it doesn't blow up. And that's also something to price in. We don't know what will happen, but this is extremely important to understand and give it a risk-reward perspective on the markets. If we look at interest rates, 0% interest rates, compare it to 2% dividend yield of the S&P 500, 5% long-term likely earnings yield, 2% growth, stocks could be priced to infinity, real financial assets. Also, to show you how the hole is being filled with the Fed, look at the balance sheets. The Fed's balance sheet will go to likely 10 trillion. ECB is also pumping money. Bank of Japan has been pumping money for the last 10 years. And this is what's impacting the markets now. And now what are your options? Nobody has the answer because we don't know what the markets will think in 3, 6, 9 months. The situation now is that we have had the best month in the last 30 years because there is so much money going into bonds. From monetary policy, from bonds, people are looking at yields. I have negative, I'm losing 1.5% of my wealth in bonds. Given the inflation, given the low interest rates, okay, let's switch to real assets, be it stocks, and as the Fed says and everybody else says, we will do whatever it takes to bring back unemployment to the level of stable prices and everything, 3%, which means that they will do whatever it takes to push that, to bring back all those jobs, all those 20 million jobs back, and that's the forces that are governing the market. Yes, there can be insolvency. There will be especially insolvency in the peripheral areas, but that is something that we will see, and we have to always weigh what are the positives and the negatives. Nobody knows what will happen, and if somebody tells you this will happen, run away. Just try to assess, okay, this can happen, this can happen, this can happen. How can I position myself that whatever happens, you end up well? It requires work, but you have to see how whatever happens can hit you, and what does that mean for you? We don't know what will happen. We know that we are in high uncertain territory, uncharted waters. The Fed, ECB will do whatever it takes. They will cover for the huge government deficits to try to save us from a very, very bad situation. Keep in mind, 1930s, it took 4 years to react with the New Deal, from 1929 to 1933. Now it took a month and a half, or even less, a month for people to start reacting from monetary policy. Immediate reaction, global spreading, very fast, a lot of money. So that's something we have to keep in. To say it again, I don't know what will happen. I try to be ready to whatever scenario and then see how to take out the most for me as a long-term investor. And this is something very important. Also about timing the market, will we see a crash or not? So, been investing for 18 years now, I've seen it all, the dot-com crash, I've seen the financial crisis, and these are the crashes that were hitting. We had 2010, the markets were up 100%. Everybody was saying it's overvalued. We had the flash crash, oil spill, issues in Europe, Greece, really, really bad things. And a lot of people sold. The market is still up 300% since then. Then we had US downgrade. US debt was downgraded. Greece was a really, really bad position. The market went down 20%. Many were expecting a second recession, a second crash. Didn't happen. The double dip in Europe, taper tantrum. 2014, we had Ebola. Also something to keep in mind, and many have sold, especially in 2015, 2016. We had a double dip on fears of China slowing down, China entering a recession, commodity crisis, oil crisis, lower oil prices. But then again, we had 2018 trade issues, whatever, rising interest rates, peak growth cycle, and now we have the collapse and the recovery due to the coronavirus. The thing is that you never know when you can time the market, what will happen to the market, when will it crash. So that's something impossible to know. And even if we look at the long-term charts here, so there have been recessions, there have been market declines. Big recession 1982, the market declined only 20%. Okay, different valuations, and that's also my message. My message is simple. As investors, we have to see, okay, what are the fundamentals of the assets we are buying? What is the yield? And are you happy with that yield? That's it. The S&P 500, I keep telling to people, and they ask me, okay, is that a good investment or not? The business yield is 5%, the earnings. There will be likely growth. It protects you a little bit from inflation due to pricing power. And if you're happy with that yield now, then you have to see, okay, what are the other options that I have? Pay back your credit card debt with a yield of 19% or something like that, and put things into your personal perspective. If you are trying, okay, markets will crash 50% over the next 3-6 months, good, you're timing the market, that can happen, but try to put it in perspective. Okay, I'm not happy with the 6% yield from the S&P 500, I want a 12% yield. Then you wait for the market crash because you have other opportunities. But as investors, you know that over the long term, if you're investing, the dividend, the earnings is what creates your return. Inflation is what creates your returns. So you have to be positioned in a way that inflation doesn't eat you up if you wait too long, and that you gain the rewards of what the market is giving, what businesses are giving over the long term. So see how that fits you. I'm looking at businesses, I have great businesses, will pay a dividend, double-digit dividends somewhere, with relative safety over the long term. Will be volatile, I know that, but I'm used to volatility. I was born in a frontier market communist country. We are crazy. We don't, another crisis or something like that. So we feel it differently. That's what I do. And I'm looking at the market, okay, if it goes down 50%, I know what I'm going to do. I get dividends. I have still some ammunition in the form of leverage for the one portfolio that is fully invested, or I'm adding each month money to the portfolio that is structured in a way that I add money. I will invest, I will accumulate more wealth over the next 5-10 years. Even if there is a crash now of 50%, I'll end up better. Why am I not selling everything? Because I don't know whether the crash will happen. I'm looking at the businesses, I'm happy. If it happens, okay, I'll increase my exposure as much as I can, buy better assets, and then enjoy the upward trend. But selling now and timing a crash, that's too risky for me because I don't know what will happen, and it's, let's say, the same probability that it goes, especially my businesses, that they don't go up in a recovery or go down. And when the probabilities are the same, it's better to own businesses for the long term, in my opinion. And this is something very important to conclude with. This is the return on investment for different classes, according to JP Morgan, and for the average investor. So don't be the idiot here. Don't do stupid things at the wrong moment in time. Because when investors start timing the market, they are focusing on what the market will do, not on what the businesses are doing. Then you see people selling, and there has been a lot of selling the 20th of March, and everybody, or those that have been waiting, kept waiting, and therefore they miss out on 30% increase over the last month. The average investor, therefore, over the last 20 years has annualized returns of 1.9%, because the investor thinks, okay, we have a crash, I have to sell, and that happens every 2-3 years. They sell, they miss the upturn, they miss the dividends, they miss the exposure. And that's why, unfortunately, the average return of people is much lower than that of the S&P 500. So see what is your strategy. Okay, you can time the market. One time you will be lucky, the other time you won't. But at the end, it's proven that investing through thick and especially thin is what works best, if you are not George Soros or whoever the magician at the time is. Again, so a lot of people send me an email, okay, I'm waiting in cash, this is the crash, but did they deploy the money they had in this crash? No, off a little bit, and they are waiting for the next crash, hoping for another crash this summer, and therefore YouTube videos predicting a crash this summer or in May will likely get a lot of views. I'm buying businesses, long-term fundamentals. When I see something that will likely increase my wealth over the long term, I buy that, I hold that for the long term, allow for compounding. That's pretty much it. Thank you for watching, looking forward to your comments. Subscribe if you like this mindset. We'll be analyzing a lot of stocks in the next month, and we'll be discussing Warren Buffett's shareholder meeting tomorrow. Thank you, and I'll see you in the next video.
Well, here we are, recording this on April 30th. It's a Thursday, here at about 4:05 p.m. in my humble abode here in Las Vegas. Some people would call this the most lit city in the world, man, but not when the strip is closed, okay? So recording this video, and what we're going to talk about here today is, will the stock market crash in May of 2020? Are we setting up for a stock market crash in May? And what about through the summer? Okay, I want to give you my perspective. I'm going to give you the facts first, Then we'll get into my opinion and we'll go from there, okay? So hope you guys enjoy this video. As always, make sure you smash the thumbs up button. Leave me a comment on what your opinion is on the state of the stock market. I would love to hear from you guys as well down there in that comment section, okay? Now, if you've been in the stock market for any amount of time, you've probably heard this expression before. It's sell in May and go away, okay? And it's an expression, I don't know when it got popular, but, you know, I've been in the stock market for the last, 12 years. And they always talk about this. Every time when you kind of go into May, they talk about sell in May, go away. And it basically means sell your stocks, come back after the summer, rebuy stocks, okay? I don't believe in this. I've never done this, okay? But it's a famous expression. And, you know, it is what it is, okay? But what we're really going to talk about is the stock market crashing. That's our focus for this video. So let's start with the facts, okay? The facts. NASDAQ is down less than 1% year to date, okay? Keep in mind, the Rona, once in a 100-year event, and the NASDAQ's down less than 1%. The S&P 500 is down less than 10%. Once in a 100-year event has hit the world economy, and the S&P 500 is down less than 10%. Okay, let's go through some more facts. Another 3.8 million people lost their jobs in the U.S. last week as the Rona continued to batter the economy. The pace of layoffs appear to be slowing, but in just 6 weeks, an unprecedented 30 million Americans have now sought unemployment benefits, and the numbers are still growing. The latest figures from the Labor Department released on Thursday showed a fourth consecutive week of declining claims. While the trend is encouraging, the rate of losses means U.S. unemployment is still on course to reach the highest levels unseen since the Great Depression of the 1930s, okay? Let's go ahead and look at this chart here. So this shows you December unemployment, the actual number right around 3.5%, January number around 3.6%, February 3.5%. We had a very healthy economy. Things were looking pretty dang good. Let's put it that way, okay? Strong, strong, strong. It was a year to be excited for. And then things started to falter as Rona took off, the economy started to close. March unemployment hits 4.4%, which is quite a substantial, move up from February, but it's nothing, okay? We're looking at April unemployment likely to come in at 20% plus, okay? Real unemployment rate of 20% plus. May, and this is assuming that at some point in May, whether it be in the middle of May or the end of May, some companies get back up and running. The economy starts to open back up. Even if that happens, likely the real unemployment rate will be somewhere around 25%, if not more than 25% in May, okay? And assuming the economy restarts at some point in May of 2020, then likely June and July could see some sort of declines in unemployment rate. But the key word is it does have to restart in the month of May at one point. We still don't know how that's going to shake out. And the other key thing is we don't know, how fast things come down. If let's say the unemployment rate's at 25% when the economy starts back up, does it start to fall to like 22%? Does it fall to 20%? Does it fall under 20%? How does all that shake out, okay? So that's just what we know. And what we also know.
Can I give you this proven income trading blueprint right now, today, for free? Inside it, you'll discover a powerful, little-known income trading method that uses just one super simple little trading strategy that has the
hey, if this happened in the United States of America, people are losing jobs massively, right? Businesses are seeing declines, obviously because of Rona, then this is happening likely worldwide. It's not like this is just the United States and this is all in one hit. No, this is likely happening worldwide, every country in the world. And keep in mind, a lot of these corporate earnings, a lot of these companies that are global companies can get 10% to sometimes even 30% of their EPS and their revenue from countries outside of the United States, outside of Europe, and outside of China. So which means some of these other countries, they don't have as good as systems in place to kind of handle a situation like this. So those countries and those job losses and the possibility of those countries struggling a lot of the next few years could absolutely hurt corporate earnings for several years out, okay? So there's some more facts here. U.S. GDP shrank 4.8% in the first quarter amid the biggest contraction since the financial crisis, okay? And keep in mind, it's almost a guarantee that the number we're going to see next quarter is going to make that number of 4.8% look like just a small, insignificant number. Like almost every economist out there has the GDP going down between 20% and 40% next quarter. Negative GDP numbers like we've never seen in modern history, okay? Google McDougal to cut marketing budgets by as much as half. Directors warned of hiring freezes. Man, oh man. I mean, when you see Google pulling back, you gotta get a little bit scared, okay? When you see a headline like that, there aren't that many headlines that could really strike some fear in you. But goodness, when you see Google McDougal say we gotta pull back a little bit here, we gotta cut our marketing budgets by as much as half, and we're gonna think about, hiring freezes. You see stuff like that from Google McDougal, you should be a little worried, okay? A little worried. That's Google we're talking about. Arguably the best balance sheet company in the entire world. One of the strongest companies in the entire world. One of the most profitable companies in the entire world, okay? What about Jeff Bezos, the richest man in the world? What did he just tell his shareholders? Jeff Bezos tells shareholders to take a seat, okay? Take a seat. He says, don't even worry about profits here, over the next year or two. Don't even worry about them, okay? Because we're not gonna focus on profits for a while, okay? And when you see Amazon going into invest every dime we have back into the business, that basically means there's opportunity that Amazon sees out there because of a lot of weakness in a lot of markets, and they say, we got to go ahead and take advantage of this, okay? And Amazon did this for years until really past few years. Amazon started to focus more and more on profits. But now, here we are in a really tough situation, and what is Amazon doing? They're going to invest every dime that comes in on this business right now. They're going to worry about growth and growing during some tough times. Jeff Bezos is like, shareholders, take a back seat for now, okay? Don't think about profits. We're not going to be having the profits coming in anytime soon, okay? 9 out of 10 companies in S&P 500 are being hurt by this. So let's be very clear. Maybe for every 1 out of the 10 companies in the S&P 500 that is somehow benefiting from the Rona situation, there's 9 companies that are they're going through some struggles. Some of these companies are seeing revenue declines of 10, 20, 30%. Some of these companies have had their businesses completely shut off, where they're going to actually see revenue declines of 50, 80, 100%. This is massive. Now, if it wasn't bad enough that most of the stocks in the stock market are likely going to see their earnings, their revenue, everything decline massively, on top of that, you got to add on to the...
Steve and Dave use eToro to trade cryptocurrencies. Steve does extensive research in order to find the next Bitcoin. Dave does research on how to become a level 60 wizard. Steve follows the feed for the latest crypto news. Dave follows the feed for the latest cat videos. Steve has a watch list for promising breakout coins. Dave has a watch list too. So why is Dave just as good a trader as Steve? It's because Dave used eToro's CopyTrader to automatically replicate Steve's trading activity. Whenever Steve makes a trade, Dave does too. Trade like a Steve with eToro, the world's leading social trading platform.
Trading books? Forget that. I'm going to give you my best trading ideas every day for free. Hi, I'm Brian.
Fact that most of these companies out there, most of these public companies that you and I are invested in, right, or we could invest in if we wanted to, right, their debt loads have gone where? Up massively. Almost every single one of these S&P 500 companies has added massive amounts of debt to their balance sheets, okay? They've either issued more shares out there, they've taken out bonds, they've taken out bank debt, they've basically drawn down their credit facilities because they're just trying to make it through to the other side when their business can actually open back up, okay? So meanwhile, all these companies you're buying into, they've all got worse balance sheets than they did before. Unless it's some special situation where some company that just, like an FB, like maybe a Google McDougal, like an Apple, something like that, where it doesn't matter, they're going to make a lot of profits no matter what, they just won't make as much. Unless it's one of those special situations, a Costco maybe, a Kroger, a Walmart, something like that, one of those special situations, outside of that, All these other companies are increasing debt massively, and most of these companies in the stock market are seeing their credit ratings go down, which means it's going to become more and more expensive for them to take out debt. And keep in mind, this is another thing, not just that a lot of these companies have taken out debt, a lot of these companies have been desperate to take out debt, so which essentially means the interest rates they're going to have to pay on the money just to get through to the other side is substantial, right? I saw that, the biggest example of this was, a company, unfortunately, I was involved with and still involved with, CCL, right? They had to take out debt just to make it to the other side at 11.5%. That's ridiculous, okay? Before they could have probably taken out debt for 4 or 5, maybe 6% would have been high for them. Then all of a sudden you have to pay 11.5%. You have to do it because you're desperate. So almost all these stocks in the stock market are have worse balance sheets than they had literally 2 or 3 months ago. And that makes them, what? Not as attractive, okay? Growth of the Fed's balance sheet slows, hitting new record of $6.7 trillion in latest week, okay? The Fed's balance sheet is now at a record of $6.7 trillion. We know the Fed's trying to backstop everything. We know, the Fed's is trying to do everything in the Fed's power to basically try to help this situation. The only thing is, at the end of the day, what's going to have to happen is the economy's going to have to open back up, and everybody's going to have to go spend money at all these businesses and corporations again to get things back on the right track. The Fed can't make somebody go and want to go to the baseball game and go spend money and do that. The Fed can't make somebody want to buy a new, $1,000 flat screen TV or something like that. The Fed can't do that. They're trying to do as much as possible to help, and they're adding to that balance sheet ridiculous. And I know a lot of you guys have probably seen this meme. Let's put this meme up, okay? The J Powell, this is popular in the stock market community right now. And it's, they're trying to do everything possible to help out with the markets and help out with this situation. But the fact is the Fed's balance sheet is just getting to ridiculous levels, and it's probably going to continue to climb. There's a lot of talk that it could go to 10 trillion with a T. It's unbelievable, okay? So, let's do a little scenario here, okay? Let's say I fell asleep for 2 months. I don't know, I went into a coma, or I went to bed and I just couldn't stop sleeping. And I was asleep for the last 2 months. And here it is, it's April 30th. You wake me up and you just tell me everything that I just went through on those slides. You tell me about unemployment, you tell me about GDP, tell me about all the debt that companies have taken out, how the fact that corporate earnings are down massively. You just run through all those slides we just ran through, okay? And the first thing I'm going to do is I say, I'm never sleeping again, okay? What the heck? I go to sleep for 2 months and just the world falls apart, okay? I'm never sleeping again, okay? And then you go ahead and you ask me, you say, Jeremy, how much do you think the stock market is down? I just gave you all that information. And so I'm like, dang, I've been asleep for 2 months. Let me start, probably 50% plus. Yeah, based upon what you just told me, I would say the market's down 50% plus. The Dow was at, 27, 28,000 when I went to sleep. So I don't know, it's probably at 14,000 now, maybe 15,000, somewhere around there, roughly. That sounds about right. Okay? And then you say, Jeremy, here's the situation. The Nasdaq's down 1%. The S&P 500's down 10%. I would laugh at you and say, quit playing with me. There's no way. Based upon what you just told me, there's no way possible the NASDAQ is down 1% and the S&P 500 is down 10%. You're like, Jay.
Steve and Dave use eToro to trade cryptocurrencies. Steve has a watch list for promising breakout coins. Dave has a watch list too. So why is Dave just as good a trader as Steve? It's because Dave used eToro's CopyTrader to automatically replicate Steve's trading activity. Whenever Steve makes a trade, Dave does too. Trade like a Steve with eToro, the world's leading social trading platform.
Here, let me pull it up on my tablet here, okay? NASDAQ down 0.93% year to date. S&P 500 down 9.85%, okay? I said I'm going back to sleep because nothing makes sense anymore. If nothing makes sense, I might as well just go back to sleep at this point because that's just ridiculous, okay? Absolutely ridiculous, okay? So that's the facts. Let me give you my opinion, okay? The market needs a rough summer. We need to see the market go down. I'm going to be quite frank with you. We need a rough summer. We need volatility to come back. We need worries. We need the doom loop to get going again, the negativity out there. It's what's actually needed in the market. Usually I say that's, we don't need that stuff in the market, but right now, I'm 100% on the train that we need negativity in the market. We need the market to go down, stock market. Not just because I want to buy stocks for cheaper, but just because these valuations, they don't make any dang sense on a lot of these companies right now. And the fact that the market started to price in a best case scenario is a little scary. Here's my opinion on this. Unemployment's probably going to stay up, up above 10%. For 1 to 3 years. I think 1 year from now would be best case scenario that unemployment gets under 10% again. I think it's going to be really hard to see. Well, keep in mind, when the economy starts back up, it's not like everybody's going to run out and spend all this money all of a sudden. And it's like, oh, everything's back to normal. That's not the way this is going to work. A lot of people, especially if they have any type of negative health condition or they're just worried in general about getting rona, they're not going to go out. Especially if we start to see cases go up and up and up. A lot of people are going to say, no. So unemployment, in my personal opinion, the best case scenario is it gets under 10% in a year from now. In my opinion, it's more like 2 to 3 years out, and we could see unemployment under 10%. It's going to be a while. And when you're talking about double-digit unemployment for 1, 2, 3 years, you're talking about a really weak economic situation, okay? That's going to, keep in mind, during the great financial crisis, unemployment was above 10% for only, a few months. Like, it wasn't like it was an extended period of time. And in this situation, I'm looking at least 1 to 3 years, in my personal opinion. I would be shocked if magically, the economy opens back up and all of a sudden unemployment is back to, 5, 6, 4% again. Like, that would just be ridiculous. And it just doesn't make any dang sense, okay? Corporate earnings, I think they're going to take at least 1 to 3 years to come back. At least, okay? And keep in mind, this is just coming back to where they were at. I think it's super unrealistic. If people think all these companies in the S&P 500 are all going to have amazing earnings when the economy does open back up, okay? I own some stocks that are hit severely by this. Wynn Resorts would be a great example, right? Macau, GGR is awful right now. Las Vegas Strip is still closed. Wynn Resorts is not going to see earnings, in my opinion, back to 2019 levels for at least 2 to 3 years. And I'm fine with that. I'm willing to hold that stock. But do I want to go buy the stock here today? Heck no, I don't. I'll hold it, but I need the stock a lot lower based upon the fact that it's going to take, probably several years, if not longer than that, for the company to get back to where it was. So, I think the stock market thinking corporate earnings are just coming back here overnight. It's unrealistic. It's not going to happen, okay? Dividend payments. We know.
There's an asset class that I want to talk to you about. Everyone is saying that this asset is worth nothing. It's completely worthless, and it has no place in a wise man's portfolio. Now, the banks, the companies, the wall.
A huge portion of the market loves their dividend payments, and they invest for those dividends, okay? And what do they go ahead and do, usually with a lot of these individuals and funds that get the dividend money? They go ahead, take that dividend money, reinvest it for more and more dividends, right? But here's the facts. Dividend payments are going to be limited for the next 2 to 5 years in a major way by most of these companies. Yes, you're going to have those special situations like an Apple stock that will continue to up their dividends because it's Apple, okay? And you'll have other companies as well that have really low payout ratios and are still going to be very profitable even if we have a recession in the last, few years. You'll have definitely some companies that, they're paying out dividends, but most of these stocks, they're going to have limited dividends. A lot of these stocks have suspended their dividends and probably won't bring them back for at least 1 to 2 years from now, okay? At least 1 to 2 years. And when they do bring them back, they're probably not going to fully bring them back. Meaning that if they were paying, let's say, 50 cents a share, when they bring that back, they're probably not going to pay 50 cents a share. They'll probably pay 25 cents or something like that. So dividend payments limited for the next 2 to 5 years. Why is this? Well, earnings for most of these companies are going to be down for a significant amount of time. I just don't see any way around that. There's no way these companies' earnings just, for all of them, just fly back. It's not happening. For most of them, it's not happening. Okay? And debt loads have gone way up, which means interest payments on the debt have gone way up. And if a company wants to pay off that debt, especially if they have taken out any high interest debt, they have to go ahead and do so with the profit money that will be coming in rather than pay out dividends, okay? Earnings down, debt up, that's just a bad thing for corporations, and that's going to limit dividends. And keep in mind, some of these industries that have taken some actual government bailouts, some of them are going to have limits on how much they can pay out dividends, just like the banks do, right? You know, a bank can't just pay out anything. JP Morgan just can't pay any dividend they want. They have to get government approval to do that. Goldman Sachs just can't pay out any dividend they want. They have to get government approval to do that, okay? And you know, the airline industry and some of these other industries that are getting bailouts from the government, you know, if you're expecting huge dividends in the next year or two, don't bank on it. Maybe 5 years from now you can. Maybe 10 years from now you can. But not today, not tomorrow, not next month, and not next year. That's just facts, okay? Money velocity has never been turned off like this in modern history. Money velocity, what I'm talking about essentially is, you know, you spending money at the local restaurant, and, you know, the restaurant makes money off that. They can hire more employees. They can expand to another location, right? The busboy makes money off that, right? The server makes money off that. The producer that sells food to the restaurant, they make money off that, right? Maybe they got somebody that sings at the restaurant. They make money off that. And so there's all these people that make money just based upon the fact that you and other people go to this restaurant, right? And then all of a sudden, they're shut down, and you're just turning off the money velocity. We've never had this happen in modern history, where you just turn off money velocity for an extended period of time. It's just dominoes rolling the wrong way in a massive way. And at first, when the Rona started, it was like, okay, maybe if we shut down the economy for a few weeks, things will be okay. And then it went for a month. And now we're approaching, you know, going to be approaching 2 months. And talk that we could have a third month before the economy reopens. And so money velocity has never been shut down like this, guys. And this is something you really should worry about, and it should be something that we all are thinking about, like, who knows how this starts back up? There's not, you can do projections, you can hope it all comes back fine. That's just hope, okay? That's unrealistic. Now, we're also starting to get some early signs that the stock market might be ready for a big fall very soon, okay? We're starting to get some early signs here. Amazon stock. So,
hey everybody, my name is Kyle Dennis, and I'm taking 15,000 into over 5 million trading stocks. But once upon a time, I was actually down $8,000 when I first started. And that's because I made a ton of rookie mistakes. I have now made a checklist that I call the 7 deadly sins of trading. It has the 7 mistakes I made that led me down that rabbit hole to negative $8,000. Now I fixed all those problems, and I'm sitting on $5 million in profits. The key here is that one of those sins, if you just fix one, and I'll tell you what it is in the ebook, your trading will turn around immediately. So to get this trading manual, all you have to do is click, put in your information, and it'll be in your inbox immediately. I'll see you there.
Hi, I'm Rex Moore with the Motley Fool in front of BMW's self-driving exhibit at CES in Las Vegas. Now, have you ever wondered how to invest in this revolutionary technology? Well, I'm going to give you the top 5 things that you might want to know about. And I hope you remember this short list, because I believe it's especially important if you're even thinking about investing in the promise of this exciting technology. Number 1. It's probably going to be bigger than you're even imagining, and that's great for investors. Here's what I mean. You yourself might be skeptical at the moment. Maybe you've been hearing about self-driving cars for years, but haven't seen any proof that it's going to happen. But I know through my sources that dozens of companies are working non-stop on all aspects of getting these cars to mass market. I've ridden in several of them over the past few years, and I know how safe they are. Here's exactly what I think is going to happen. As soon as they become available, people will see a great reduction in accidents and fatalities. Insurance rates will fall as a result. Traffic will become much smoother and commutes shorter. And that's why I see extremely fast acceptance and adoption of this technology. And that's why the time is now to think about investing while skepticism is still high and before short-term oriented Wall Street wakes up to it. Which leads me to point number 2. fortunes will be made. Think back a few years about some of the other life-changing